My name is Heitor Almeida. I'm a professor of corporate finance at the University of Illinois in Urbana-Champaign. I've been teaching corporate finance to MBAs, PhDs, and undergraduate students since 2001. And I also spend a lot of time researching corporate finance topics that we will discuss in this course, such as liquidity management, corporate investments, and mergers and acquisitions. I am originally from Brazil, so this explains the song that I was playing in the guitar in the beginning. It also explains my accent, right? I came to the US in '95 to work on my PhD in economics from the University of Chicago. I managed to graduate in 5 years, so I graduated from the University of Chicago in 2000. My first job was at New York University. I spent 7 years teaching and doing research at NYU before I moved to Champaign-Urbana in 2007. Why did I get into corporate finance? As with many paths in life, it was a little bit by accident, and I want to share the story with you. Okay? This was about 1998, January of '98, and I was, at that point, I had finished all my coursework, I had finished my exams in the PhD, and I was thinking about, what am I going to do for my research? What is my dissertation going to be about? Remember, I was an economics PhD, so I wasn't really studying finance at that point. Finance is one of the topics we study in economics, but there are many other topics, macroeconomics, labor economics, and I was really trying to think what I was going to do. Corporate finance was not even crossing my mind at that point, okay? What happened is that I decided to take a course, and a course that really changed the course of my life, okay? It was a corporate finance course that was taught at the Chicago Business School by a professor named Raghuram Rajan. If you are from India, you probably heard his name. He's currently the central bank governor of the Indian government. Okay, so I'm sure you heard his name, or other people might have heard about him as well. He was the IMF, the chief economist of the IMF some years ago. But in any case, that course was great. I really enjoyed learning about corporate finance, and it got me thinking about how companies make financial decisions, how companies make investment decisions. I became fascinated with these topics, and in particular, I became really interested in understanding why corporate finance matters for the economy as a whole. What is the link between corporate finance and macroeconomics and issues like that? Okay? After that course, I never really looked back. I started researching corporate finance, I got my first job, I started teaching corporate finance, and I've been doing that ever since. The moral of this story is that a single course can change your life. So this is my office. This is where I do my research and where I prepare my classes. It's the typical office of a professor. It's not very special, not particularly organized. The real reason I brought you here is because the office of a professor is like a visual resume, right? You can look up my resume on the web, but it's nice to actually be here so I can show you some things. So here's where I have the prizes that I won for my research and for my teaching. For example, I have this prize that I won in 2008 for the best paper published in the Journal of Finance. That year, the Journal of Finance is the best, considered to be the best journal in our profession, so I'm very proud of that one. I have the medal that I won when I became a chaired professor at the University of Illinois. You can see that it's a very heavy medal, so people don't go around wearing that medal. We just keep it here in our office for people to see. And I have this really cool prize that I like. It's a basketball, as you can see, that I actually won a year ago from my executive MBA students when I was elected the professor of the year. And as you can see here, it's signed. All the students signed the ball. In that program, we have about 40 students, so it fits in a regular basketball. And as we are starting this, I was thinking about if we're doing an online class, there are like maybe thousands of students. I was thinking how big the ball should be if all the students would have to sign it, right? Would probably end up being bigger than this office. In this course, we will learn how companies make financing and investment decisions that create value for shareholders. Okay? Some of the issues that we will study are how to use accounting statements to measure the financial health of a company. We're going to learn that accounting is the language of finance, and we're going to learn that language. Then we're going to learn how to manage a company's short and long-term need for liquidity. We're going to cover models that allow us to forecast and manage a company's liquidity needs. Then we're going to learn tools that are going to allow us to measure the contribution of a new project or a new acquisition to shareholder value. We're going to learn the very important concept of net present value, which is the tool that is going to allow us to do that. After we do that, we're going to learn how to incorporate risk and uncertainty into investment valuation decisions. Okay? And finally, we will learn how to measure the performance of existing investments or divisions of a company. We're going to learn tools that are going to allow us to measure whether a division or whether an investment is generating value for a company or not. This course is divided in 4 modules. Each module has certain topics, right? So in module 1, we're going to talk about goal of the company, financial ratios. Then we're going to do financial planning in module 2. We're going to talk about investments in module 3. Module 4 is about mergers and acquisitions, risk and performance evaluation. So here you know all the topics we're going to cover in each module. A very important point that I want to discuss is that each module has 3 sets of problems, and they are a little bit different from each other. The practice quizzes are simple, direct questions that allow you to practice the concepts that we learn as we learn them. So as you see, the practice quizzes are going to be introduced within the module and are going to cover certain topics that we just learned. All the practice quizzes are going to come with solutions and immediate feedback. So as you do a question, you get immediate feedback whether it's right or wrong, and you get a solution as well, so you can understand why your answer was right or wrong. Okay? Then at the end of each module, there is a quiz. The difference is that for this quiz, you will get feedback on whether your answer is right or wrong, but there will be no explanation. There will be no solution to the end of module quiz. Okay? If you want to understand why your answer is right or wrong, what you should do is go back and look at the practice quizzes. Okay? The end of module quizzes are going to be very similar to the practice quizzes. And then at the end of the module, there is going to be an assignment. The difference between the quizzes and the assignment is that the quizzes are simpler, more direct questions, whereas the assignments are going to be more complex, deeper questions that are going to allow us to dig deeper into the concepts that we learn in the course. So for example, the assignments are going to have some mini cases that I wrote, the cases where you're going to have to analyze real-world companies and do qualitative analysis of some of the topics we discussed during this course. Okay? Make sure you work on all of them, right? It's important to do all of the assignments. After all, practice makes perfect, both with guitar playing and with corporate finance.
Too often, smart, hardworking, busy people miss out on education because of traditional linear learning. So learn on your terms. With stackable online content from Geese College of Business, you can take self-paced classes, earn transcriptable credit, pause, earn a degree, switch and stack coursework, earn a certificate, or learn however you want. You'll get expert-led education in big or bite-sized increments. Wherever you are in your learning journey, the right time to start at Geese is your time.
This first module is about the goal and the language of corporate finance. Okay? Being from Brazil, I thought I had to start the course with football or a soccer ball, depending on where you come from, right? Unfortunately, though, the language of corporate finance is not Portuguese like I learned when I was a kid. The language of corporate finance happens to be accounting. Okay? So what we will learn in this module is how to use financial statements, how to use accounting data to really understand what's going on with companies. Okay? We're going to use financial ratios to measure concepts like liquidity, profitability, leverage, and we're going to try to understand how companies are generating and spending cash using the cash flow statement. Okay? In terms of the goal, the important thing to realize is that in corporate finance, we're going to be studying financial and investment decisions that are made by companies. Okay? As opposed to studying investment decisions made by people, we're going to shift the focus and talk about companies. Okay? So before we can think about these financial and investment decisions, we have to discuss the objective of the corporation, right? What is their goal? When they are making these financial and investment decisions, what are companies maximizing, right? So in this model, we're going to discuss this really important idea of shareholder value, right? The concept of shareholder value maximization, right? Why does this make sense, right, to maximize shareholder value, but also the problems, right, the potential problems that companies may encounter when they are maximizing shareholder value, okay? Specifically, we will talk about why maximizing the stock price is a reasonable goal for companies and it's better than alternative goals such as maximizing current profits, okay? But we're also going to talk about the potential problems that this may create, okay? So there are conflicts between stock price maximization and social responsibility with stakeholders such as employees and with the government, so we're going to be talking about those as well. Really drill down and try to understand this concept of shareholder value maximization, okay? And then finally, we're going to talk about the agency problem, the fact that managers may not necessarily maximize shareholder value and how corporate governance practice can help with that, okay? Then we're going to move on and talk about the language. We will learn how to use information from the accounting statements to measure key corporate finance concepts such as liquidity, solvency. Then we're going to look at the income statement to measure profitability, and we're going to look at the cash flow statement to understand how a company is generating and spending cash. Finally, we're going to talk about valuation ratios from a corporate finance point of view, right? So valuation ratios such as market to book, value over profits. We're going to calculate and discuss what these ratios mean. In this course, we'll talk about many corporate decisions. Investment decisions, financing decisions, acquisition decisions, okay? So at this point, it's very important for us to discuss what is the objective of the firm, right? What is the objective of the company? If they're making these decisions, which variable are the companies maximizing? Which variable are they looking at, okay? You know, an idea that seems to make sense is that since companies are owned by shareholders, they should be maximizing shareholder wealth, or in other words, maximizing the stock price. Okay? So maximizing the stock price is the objective of the corporation. What I want to do now is to really discuss this idea with you and think about whether that makes sense or not. Okay? The first thing that you might be thinking is that maximizing a stock price seems to be a little bit short-sighted, right? The stock price is a current measure. It's a measure of the current value of the firm, whereas, you know, if you're concerned about shareholder wealth, you might also be worried about the future. What's going to happen in the future? If we maximize the current stock price, perhaps we're not maximizing shareholder wealth, okay? But think about the following. What determines a stock price? This is something that you might have covered in a previous course, or if not, that's the right time for us to discuss this. It's a very important idea in finance, okay? The stock price should be the discounted sum of all future cash flows. So the stock price of a company today should depend on everything that is going to happen in the future, okay? So the stock price should reflect all the consequences of any decision that a company takes today. It's a forward-looking measure, okay? So that is why, if you think about it, you know, even though it's a current measure, it also reflects the future, right? So it makes more sense once you think of stock prices as the discounted sum of future cash flows. It starts making more sense that companies can look at stock prices, okay? let's think about this idea. Do stock prices really reflect information about the future? Okay? So that is the idea we just posed. Is there a way we can look at data to see that? A very useful example to consider is the market reaction to merger announcements. Okay, let me give an example here. That is an example we're going to talk about more in our module 4 when we discuss acquisitions. Okay, so on the September 4th of 2001, Hewlett-Packard announced that it was going to buy Compaq. Okay, so it's an announcement. It announces to the financial press, to analysts, that this merger is going to happen. The merger hasn't happened yet. In fact, this merger was highly contested. Okay, the shareholders of Hewlett-Packard were not happy about that merger. Okay, and the merger ended up being completed almost a year later. Okay, but check this graph. Right on September 4th, when the merger was announced, this is what happens to stock price. Okay, so this is the data for September 4th. Okay, the stock price immediately dropped. Okay, it is a current measure, but the moment that this new information came into the market, the stock price reacted to that. Okay, why did the stock price drop? The stock price dropped because, as we just discussed, shareholders did not like the merger, right? They thought that the merger was not going to add to the value of the company. What the market does is the market reacts immediately to that piece of information. So you're not waiting for future profits to come in. The market's not waiting to try to figure out what's happened. You're immediately reacting to any corporate decision. Okay? So that is, this supports this idea that stock prices really reflect future, and it's a variable that managers should be looking at. Okay? An important notion here is the role of efficient markets, right? So this idea that we just posed, that the stock price reflects all consequences of any decision that a company takes today, it relies on the assumption that markets are efficient, right? If the market is efficient, then the stock price should be exactly equal to that. Of course, markets are not perfectly efficient, right? So the stock price is not always going to be a perfect measure of shareholder value. There is going to be a discrepancy between stock prices and shareholder wealth. So at this point, we have to think about, are there good alternatives? Is there something else we can look at? Okay? Let's talk about earnings per share. This is a commonly reported measure of profitability for companies. What it is, it's just the current earnings, the current net income of the company divided by the number of shares outstanding. Okay? So you're looking at current profits and dividing current profits by shares outstanding, right? And the question I want you to think about is, can that replace a stock price? Okay? Will maximizing earnings per share maximize current shareholder wealth or not? Or are there problems with earnings per share? If you think about this for a while, you will see that the answer is no. Okay? Now we're going to have a problem of short-termism, right? Earnings per share are only going to measure current profits. Okay? So if you're maximizing current earnings per share, then you are completely ignoring the future. There's no way you can capture future profits just by looking at earnings per share. Okay? Later on in this module, we are going to talk about profitability measures, right? And actually, one concept that we're going to learn is that there may even be better measures of profitability. There are problems with earnings per share that make it, in my view, that make it a problematic measure of profitability. Okay? So on top of this problem that it ignores future, EPS is also problematic as a measure of profits. So it's definitely not an adequate alternative. And here's an interesting example, again from the merger world. Okay? So that's a more recent merger. On July of 2015, the Celgene, which is a biotech company, announced a deal to buy another company called Receptus. Okay? And this deal was welcomed by the market. So the market liked this one. Okay? The stock market reacted positively to the deal. Celgene stock price went up substantially. okay, $115 to $135. But at the same time, the management announced that the deal was going to reduce earnings per share. For several years, for 4 years, it would take 4 years for this deal to generate profits. Still, the stock price went up, okay? So think about that. What does that mean, right? It means that the market really is considering these long-term effects of the merger in order to figure out whether this merger is adding value to the company or not, okay? EPS, the fact that EPS is going to go down now seems to not matter as much when the stock market is trying to estimate the value of this deal, okay? So that's an example of a situation where stock prices and EPS are really departing from each other. Another alternative you might think about is the book value per share, okay? So the book value of equity, you know, one advantage may be that this is an accounting value, right? So it's it goes to auditing. It's a number that is easy to verify, okay? The problem, of course, is going to be similar to earnings per share. The book value of equity does not reflect future profits, okay? The book value of equity reflects mostly what happened in the past, not the future. So if we maximize the book value of equity, again, we're going to be completely missing this future, you know, it's going to lead to short-termism. It might lead to wrong decisions, okay? Bottom line is that, you know, maximizing stock prices is the lesser evil. Even if markets are not perfectly efficient, at least you have a hope that the stock price is capturing information about the future, okay? That doesn't mean the stock price is a perfect measure. As we're going to talk now, there are problems. These problems arise mostly because maximizing shareholder wealth may not be compatible with the welfare of society as a whole and other stakeholders in the firm. So that's the next topic we're going to discuss. Let us now think about these conflicts, right? We just discussed the notion of shareholder value, right? Shareholder wealth, maximizing the stock price. That seems to be a reasonable objective for the corporation if you're thinking strictly about shareholders, right? But what about society as a whole? The first issue that we can talk about is social responsibility, right? And before we get into the problems, let's talk about a few actions that companies make that are actually socially responsible, right? So you know, there aren't necessarily conflicts all the time, right? For example, companies invest in human capital, right? If an employee works in a company for a long time and learns new skills, right? Some of these value is not going to be captured by the company, but it's going to be captured by the employee. So investments in human capital is something that benefits society as a whole, not only the company, right? Sustainability is another issue. Many companies are trying to develop products that are better for the environment, right? And that make the environment more sustainable. Again, that is an example of a socially responsible corporate action. Okay? And philanthropy, right? Many companies engage in donations and actions that benefit the communities and the society as a whole, right? So there are examples of socially responsible corporate actions, but of course that doesn't always happen, right? There are conflicts as well, and it's very easy to think about situations in which maximizing shareholder wealth may not be consistent with social responsibility, right? For example, right, if you want to take some time to think about some examples, you can, but let's just go on and talk about a few, right? There are some products that are bad for health, right? Some companies produce tobacco, junk food. It is well known that these are not great for people, but people value them, right? So companies can create profits by selling these products. This might be this is good for shareholders, but it may not be good for society. So there are some conflicts here, right? Pollution is another classic example, right? companies' incentives are to reduce costs, right, to produce things as cheaply as possible, to increase profits, and therefore to increase shareholder value. But this may not be the best thing for the environment, right? Technologies that are cheap but pollute the environment are not going to be great for society as a whole, right? Another example you might think of is outsourcing of labor, right? Hiring employees in other countries, of course, is going to be great for those countries, but it might not be good for the local labor market. So this is another issue that is being discussed a lot these days. One issue that you might not have thought of as an example of a conflict is taxes, right? Should companies minimize their tax bills, right? The answer seems to be obvious, right? Minimizing taxes increases profits and therefore should increase stock prices, right? If taxes go down, both your current and your future profits are higher, right? But there is a downside. Minimizing taxes is also going to reduce tax collection, right? The government is going to receive less money, right? The government will have less money to invest in infrastructure, to invest in social projects, right? This is going to increase budget deficits. It might be bad for society as a whole, okay? One example that the financial press is talking about these days, okay, is the fact that multinational companies around the world really, but this is example uses US companies, are holding a lot of cash abroad, okay? So US multinational companies are holding a large amount of cash in countries that are outside the US. So here there is a chart for you to look at. You can see the example of Apple, for example, that holds $157 billion of cash outside of the US. Okay? You might have heard about this before. Let's talk about this for a while. Why is this related to taxes? Okay? It's because of this notion of repatriation taxes, right? So suppose, take Apple for example. Apple has some operations in Ireland, okay? The corporate tax rate in Ireland is just 10%, okay? So if Apple generates $1 billion of profits in Ireland, you're going to generate a tax bill of $100 million, okay? That's the Irish tax. The US corporate tax rate is much higher, it's 35%, okay? So the US firm, Apple in this case, in our example, would have to pay an extra $250 million to bring the cash back home. You know, guess what? They are not bringing, right? The cash is staying abroad, okay? Why is this a problem? The problem is that this foreign cash cannot be used for dividends and also cannot be used for investments in the US without generating this repatriation tax. So if Apple wants to invest the money in the US, it has to bring the money back to the US and pay that tax. Guess what? You know, these multinationals are not bringing the cash back home. So even the government has got into this. The current US President, Barack Obama, is trying to come up with a plan to force multinationals to bring the cash back home. Of course, that is not something that is easy to do, okay? And that shows a general point. You know, every time there is a conflict between shareholder value maximization and society as a whole, there is a potential role for the government to try to improve this situation. Okay? I'm not saying that it's right for Obama to tax US companies on their profits held abroad, but the general point is that these are situations where typically the government comes in, tries to intervene and improve the situation. Pollution, for example, can be regulated. Outsourcing of labor can be regulated if the government wants. So there is a potential role for the government to play a role here. Okay? Next topic. Let's think about conflicts between shareholder wealth with other stakeholders, right? This is related to what we've been talking about, but now let's think more specifically about stakeholders like employees, suppliers, and debt holders, bondholders, okay? Does a high stock price also benefit these other people? That's the question I want you to think about for a while, and then we'll talk about it in a second. And the answer is yes, right? There isn't necessarily a conflict if you think about it in the following way, right? a more valuable firm, a firm with a higher stock price, is going to be able to pay higher wages, right? It's going to improve career prospects, right? If you're a manager working for a successful company, that is going to improve your CV, right? It's going to be good for the employee as well, right? It's also good for suppliers because it increases profits for suppliers, it makes the company more stable, and it lowers the risk for debt holders, okay? So there are many reasons why a stock price is also good for other stakeholders. The problem, of course, is that this congruence does not always hold, okay? A very commonly discussed example of a potential conflict is actually mergers and acquisitions, which we discussed a little bit already, and we will discuss more later on in the course, okay? M&A can, of course, make some jobs obsolete, right? If two companies merge, some jobs may not make sense anymore. So there is some evidence that M&A is related to employment cuts, right? If you work for a company that has undergone M&A activity, that is always a very stressful time for employees, right? In the name of improving operating efficiency, it is common that M&A will result in lower employment, right? And something you might not have thought about yet is that M&A is sometimes financed with large amounts of new debt, okay? This is the leverage buyouts that we are going to talk about in Module 4. This new issuance can, of course, hurt existing bondholders, right? If you hold a bond in a company that undergoes a leverage buyout, you know, it's very likely that the value of your bond is going to go down because leverage is increasing so much, okay? So this is an issue we will discuss later in the course when we talk about mergers and acquisitions and leverage buyouts. Let us talk now about corporate governance, okay? The idea then that we've been discussing is that companies should try to maximize shareholder wealth. The problem is that companies are managed by managers, right? Managers have to make this decision. Shareholders may not be able to make the decisions on their own. They have to rely on managers, right? And the problem is that managers, of course, are going to maximize their own wealth, right? Managers' incentives may not be to always maximize shareholder wealth, right? And there is a name for this in corporate finance. We call this the agency problem, okay? Managers, the fact that there may be a conflict between what managers are maximizing and what shareholders want, okay? So this is a different problem. Notice that this has nothing to do with social responsibility or stakeholders. It really is a problem that is that belongs to the company, right? It's a conflict between managers and shareholders, right? What sort of conflicts are we thinking about here? Okay, for example, stealing. You know, stealing is not common in a developed economy like the U.S., but it does happen, right? Even in the U.S., and it happens in other countries as well. Sometimes managers steal from companies, right? Employing family members, right? A family member may not necessarily be the best manager, right? But if you are the CEO, you probably have a lot of power to decide who you're going to employ, especially if you own the company as a whole, right? So if you own a lot of stock in the company and you are the CEO, you might decide to employ a family member instead of hiring a manager in the labor market that might be a better manager, right? That's going to be bad for shareholders, but it's going to be good for the CEO. Not working hard enough is another problem, right? Shareholders, of course, want managers to work hard, create value, but managers may be lazy and not want to put on the hours, right? And overspending the company's money, right? Which is sort of related to stealing, but a more soft version of stealing. You know, one issue that we talk about is corporate jets, right? So corporate jet might make sense, but in some cases the usage of corporate jet may be a little bit excessive and not be great for shareholder value. Okay, so these are just some general examples of what we think of as agency problems. Okay, so how do companies solve agency problems, right? So how can you align incentives of managers and shareholders? The answer is very simple. It's probably something that you have thought about before. It's compensation, right? If you want managers to maximize the value of the stock, the easy way to do it is to give stock to managers, right? That is why, managers own so much stock in companies. Top managers like CEOs, CFOs, the top 5 to 10 managers of a company will typically be owning a significant chunk of the stock, okay? And if you think about this practice, it does make sense, right? Because if you want managers to maximize the stock price, it's a good way for this is a good way to do it, because even if managers are maximizing their own wealth, they are going to end up maximizing the stock price, right? So this is the idea. However, this practice of giving stock to managers has been the object of a very heated debate recently, okay? There are many observers, analysts, academics who claim that stock compensation might have gone too far, okay? This is just some data for you to think about. CEO pay in the US has grown by a lot more than the average pay of an employee, right? So the average pay of an employee in the US in the period of 1980 to 2004, which is in this graph, hasn't grown by much, whereas a CEO pay has grown by 8.5% a year. Okay, it's also higher than the GDP growth rate and higher than the growth rate in corporate profits, which is 2.9%. Okay, so this kind of data, we know that executives get paid a lot. CEO pay has also increased a lot in recent years. So this kind of data has generated this debate, on whether top executives are paid too much or not. Okay? There are two sides in this debate. Some academics claim that this is a market outcome, we shouldn't mess with it. Okay? Companies want to pay. If companies want to pay a lot to hire a CEO, they should be able to do it. High pay is just a consequence of a demand for talent. Okay? But on the other hand, the people who want to curb CEO pay, what they claim is that this argument doesn't really work because pay is determined by the board of directors, and the board of directors does not always work independently from the CEO, right? The board of directors may be composed of people who are friends of the CEO, who are not truly independent, and that may lead the CEO to get paid too much, okay? A possible solution for this problem is to rely on corporate governance, right? To rely on other governance mechanisms other than compensation, right? So we think of corporate governance as any sort of mechanism that companies have to solve this conflict between managers and shareholders, okay? For example, having a truly independent board of directors may help, right? If the problem is that the board of directors is not really independent from the CEO, what companies can do is to get some independent directors, right? A very common and recent trend in the US is the role of institutional investors, right? Institutional investors have large stake in firms, and they can come, people who own a lot of stock in firms can come and try to change corporate practice like CEO compensation, okay? And finally, there is pressure from M&A market. Again, M&A matters a lot, mergers and acquisitions. If a company is inefficient, if you're paying the CEO too much and profits are going down, shareholder value is going down, you might eventually die out, either be swallowed by your competitors or disappear, go bankrupt, okay? So there are ways to control this problem. There may be a role for the government as well. That's the last observation here. Following the financial crisis, the recent financial crisis of 2007 to 2009, the US government introduced a new law, okay, according to which shareholders now have to vote to approve executive compensation. This law is being implemented now, slowly being implemented, so it may be a little bit too early to figure out whether this law has had an effect on compensation or not. Academics are currently studying this issue. What we see so far is that in a vast majority of cases, the shareholders ended up approving the compensation that was proposed by the board, okay? Perhaps this means that the compensation packages were not wrong, were not excessive, okay? Or perhaps it means something else. It's a little bit early for us to say. I think we have to wait a little to be able to figure out whether say on pay is going to have an effect on executive compensation or not. As we talked about in the introduction to this module, accounting is the language of corporate finance, right? So what we're going to learn now is how to use financial ratios to measure key corporate finance concepts. We're going to be dealing with the major financial statements, the balance sheet, the income statement, and the cash flow statement, and then we're going to try to really put words to the numbers and make the financial statements live and really try to think about what can we see there, okay? What sort of important corporate finance concepts can we learn by looking at financial statements? Let's start with balance sheets, okay? So that's going to be the first set of financial statements we're going to be looking at. We're going to spend quite a bit of time thinking about balance sheets, okay? Before we get into real-world examples, which is really how I want to do this, I want to do these calculations using data from real-world companies. But before we do that, let's just start with a simplified example where we are comparing three firms here. We have firm A, firm B, and firm C, okay? And here you can see all a snapshot of their balance sheets, right? A real-world balance sheet is going to have many more items than that. Here we just have the basic items. Assets, liabilities, and assets and liabilities are split into current and non-current. And then we also have information on the equity, which is the difference between assets and liabilities. Okay? So ask yourself, what kind of information can we get by looking at a balance sheet? Okay? The first thing you notice is that the balance sheet will give you information on, how large the company is, how much assets does it have. Right? In this case, the three firms have 500,000 or 500 million, let's say 500 million in assets, okay? And then we can look at the liability side, right? And here you can notice that there are some differences, right? So if you look at this, firm A has 200 million in current liabilities, firm B has just 50 million, okay? Both companies have the same amount of total liabilities, but firm A has more current liabilities, okay? So one thing we're going to do in this lecture, in this model, is to think about what does that mean for the liquidity of the company, okay? So, and then we look at firm C. The main difference is that firm C has fewer liabilities than firm A and firm B, right? So another concept we're going to talk about is solvency, which is going to be a difference between firm B and the other two firms. Okay, so these are the key concepts we're going to be talking about: liquidity and solvency. And rather than using this simplified example and made-up examples, what I want to do is to use data from three real-world companies to illustrate these key concepts. Okay, so we're going to take two companies that are competitors. The first one is Cablevision, which is a leading telecommunications company here in the US, right? They provide mostly digital television, also high-speed internet, okay? And one of Cablevision's major competitors, which is DirecTV, which again is a major provider of digital television. Actually, DirecTV is more of an international company, right? They are a US company that also operates mostly in Latin America. It has more than 37 million customers around the world, okay? And for reasons that you will understand soon, we're going to talk about a third company in a completely different industry, which is BE Aerospace. What BE Aerospace does is they make aircraft cabin interior products, things like seats, aircraft seats. They make those both for commercial and business jets, okay? So of course, this is a completely different company. You will see why we have that in the analysis when we start talking about liquidity ratios. So those are the three companies we're going to analyze, and now we are really going to try to get into the financial ratios and see what we can learn about these companies by reading their accounting statements. The first set of ratios we're going to talk about are the liquidity ratios. Okay, so those are the ratios that allow us to measure how liquid the balance sheet of a company is. Okay, so the first liquidity ratio that we're going to compute and analyze is what we think, what we call the current ratio. Okay, so the current ratio is very simple. It's just the ratio of current assets divided by current liabilities. Okay. As a way of illustration, let us compute this ratio for Cablevision and for BE Aerospace. Okay? So let's go here to the balance sheet. Here you can see that you actually have the real balance sheet for Cablevision for 3 years. Okay? What we're going to do is we're going to focus only on the recent year now, for now. But if you're doing this, for another application, like you may want to analyze the liquidity for more years. For our teaching purpose, we're just going to focus on the most recent data. Okay, so let's go here and think about how we would compute the liquidity, the current ratio, right? So that should be really very simple. You have here the data, the most recent data on the company's total current assets, and you have the most recent data on the company's current liabilities. So the current ratio is simply the ratio of current assets by current liabilities, which is 788 divided by 1737. Okay, so this is in a million. So this means that Cablevision has $1.8 billion in current assets and $1.7 billion in current liabilities. So this ratio is approximately equal to 1. Okay, so Cablevision has the same amount of current assets as they have current liabilities. Okay, so now let's go to BE Aerospace, right? Same information. You have the balance sheet for the last 3 years. Okay, let's focus on the latest information we have. Okay, and here you have information on the current assets, current liabilities. Okay, so again we can compute the ratio. Current assets divided by current liabilities would be 1723. Again, this is in millions, so it means that they have $1.8 billion in current assets and $800 million in current liabilities. So you would get a current ratio of approximately 2.15. So here we have done the calculation, right? Now let's think about it. BE Aerospace seems to have a much larger current ratio than what Cablevision has, right? So it's 2.15, significantly larger, right? Does that mean that BE Aerospace has more liquidity than Cablevision, right? Now what we need to do is we have to start thinking about the details a little bit more, okay? And what you'll soon realize is that the main reason why BE Aerospace has this high liquidity ratio is because they have quite a bit of inventory, right? Out of the $1.7 billion in current assets that they have, $970 million is inventory, okay? So let's take that information and think about the following question, right? So why is BE's ratio so high, right? Inventory, does this really measure liquidity, okay, right? Is inventory really a liquid asset? Does it, does this calculation mean that BE has more liquidity than Cablevision has? So what we need to think about is what is liquidity, right? What are we trying to measure, right? And so the notion of liquidity, that's something very important in finance, of course, right? Liquidity measures how easy it is to transform an asset into cash, right? So how fast can we generate cash from an asset? How easy it is? How much cash are we going to get for an asset? Okay, so that's the notion of liquidity, right? So really what we're trying to understand is whether a company like BEI Aerospace has sufficient current assets to cover its current liabilities. Okay, right? So is inventory really a liquid asset? Okay, so if you think about that, right? Of course, companies can try to sell inventory, right? If you run into a liquidity problem, you have some inventory, you can use that to raise cash, but you might have problems, right? Liquidating inventory to raise cash is going to disrupt the business. Think about BEI Aerospace, for example. The reason they have inventory, right, is because they have to keep seats, aircraft seats, for example, to sell to airlines, right? And if they have to liquidate inventory, that's going to disrupt their business. And in addition, the company may not really get a good price when it does that, right? The inventory, the aircraft seat may be very specific to a particular airline. If you're going to sell that to a different airline, you may not get a lot of cash for that. Okay? Actually, there is some evidence in the corporate finance literature. This very interesting paper by Berger, Ofek, and Swary, which was published a few years ago. What these authors did is they gathered data on how much money, the amount that firms were able to obtain when they sold their assets, okay? When they had to sell assets because they were discontinuing operations. So these were companies that went bankrupt, for example, and what they did is they looked at how much did they get for their current assets, right? Intuitively, right, cash, right, is one. Okay, so if you liquidate cash, cash is cash, so they got 1 for that. Receivables, they got 72 cents per dollar. So what this number means is for each dollar of receivables that they had, they were able to raise 72%. Okay, so if they had 100 million in receivables, they raised $72 million in cash. Inventory was the lowest, right? So inventory just generated $50 million in cash out of 100 million, so 55%. Okay, so inventory is somewhat liquid, but it's not perfectly liquid, right? So that's why we have to think about additional liquidity ratios. Okay, so we have some liquidity ratios that take this illiquidity of inventory into account. Okay, there are 2 ratios we're going to think about. The first one is the quick ratio, which uses only cash and receivables. And then we're going to have the cash ratio, which looks only at cash, okay? You're ignoring even receivables. Since receivables are not perfectly liquid, let's just take the most liquid asset, which is cash, and think about that, okay? So recalculating these ratios using these different measures, what we do, now you have DirecTV, by the way, right? So now you have DirecTV's balance sheet here, okay, in addition to Cablevision. So what you would do, for example, to calculate the quick ratio is just take the first 2 numbers, cash plus receivables, okay, and divide it by total current liabilities, okay? And so notice that really what you're doing is you are ignoring everything else that is in the balance sheet. You are assuming that is not liquid, okay? You only take the assets that you know are going to be generating some liquidity for you. That's the idea, okay, of computing this quick ratio. So here you have an example, right? So if you do this for the DirecTV using that data that I just gave, okay, here's what you should find. That the DirecTV's quick ratio should be about 0.9. Okay, if you just take cash and receivables and divide by current liabilities, right? So that means that DirecTV has 90% of its current liabilities in cash and receivables. Okay, we're going to talk about later what does that mean. Okay. So here are all the calculations using that data, and I encourage you to do it on your own and check to make sure you can get the same numbers. We have the cash ratio, the quick ratio, and the current ratio for Cablevision and DirecTV. We're not going to talk about the BEI Aerospace anymore. The reason why it was there is just to illustrate that inventory issue. Now let's compare these 2 companies that are in the same industry. Okay, so those are the liquidity ratios, right? You can see that if you look at this comparison, it's easy to see that DirecTV has higher ratios, has more liquidity than Cablevision has. Okay, since we're talking about that, let's think about the following question. What is a good ratio? Okay? Remember, the question we are asking is, can the company pay for short-term liabilities without relying on cash flow, right? Just looking at balance sheet items. What that means is that, you know, 1 is a reasonable standard to look at, okay? Current ratios should be above 1, right? That means you have more assets than liabilities, okay? Quick ratios should also be close to 1, at least close to 1. Why? Because we don't want to rely too much on inventory, right? So inventory is tricky. So what we conclude is that quick ratios should also be close to 1. Ideally, you don't want your quick ratio to fall too much below 1. The cash ratio, you know, how large the cash ratio needs to be, that's a more complicated question. It depends on how liquid the receivables are and some other considerations. On Module 2, we're going to be talking more about short-term cash management. I think we're going to have more to say about that. But, you know, of course, the general idea is that a high cash ratio is a good thing in terms of liquidity, but perhaps it doesn't have to be quite above 1, okay? How does liquidity deteriorate? If you see a company with low liquidity, how can that happen, right? When you think about it, liquidity is about comparing short-term liabilities to short-term assets, right? So one way that a company can reduce its liquidity is by increasing short-term debt to invest in long-term assets, right? So if you raise short-term debt and invest in long-term assets, you're going to lower your liquidity. Or if you use up your cash, right? If you take some of your cash to invest in a capital expenditure, you're again going to lower your liquidity. And that's an issue we're going to go back to in one of the examples in Module 2. So this is coming up as well. We're going to talk about one example where that consideration is going to be important. And finally, performance, right? Performance is going to be related to everything. So if a company does poorly, cash holdings are likely to go down, liquidity is going to go down, and the company may have to think about readjusting its liquidity ratios. So now we will talk about solvency ratios or leverage ratios. Those two are synonyms. You can use either term, okay? And the first thing we need to talk about is that there are several debt ratios, and in particular there is one specific debt ratio that is commonly used that I recommend that we do not use it, but I still want to talk about it at this introduction, okay? So the 3 ratios we'll talk about are debt over assets, debt divided by debt plus equity, and liabilities plus assets. Every time we use the term debt, you should think of that as the sum of short-term and long-term debt. So we are considering both short-term and long-term liabilities, okay? To understand the difference between these leverage ratios, the best way to do this is to look at a simplified balance sheet, which is what you have here, okay? So you have debt, and other liabilities in the right-hand side, and then you have the assets on the left-hand side. In particular, we have to think about the liability side, okay? So notice that total liabilities of a company are going to be the sum of the debt, what you can think of as a financial liability, plus other liabilities like pensions and accounts payable, okay, which we talked about when we discussed our liquidity ratios, for example. So there are other liabilities, right, in the balance sheet. It's not just debt, right? So one way to think about it is that total assets, if you look at the left-hand side and the right-hand side of the balance sheet, total assets are going to be equal to debt plus other liabilities plus equity, okay? So the problem is that if you use ratio number 1, debt over assets, okay, the problem is that dividing debt over assets is going to ignore the other liabilities such as pensions, right? Other liabilities are part of assets, right? Assets equals debt plus other liabilities plus equity, but you're not including it in the numerator, okay? So debt over assets may underestimate leverage for some companies if a company has a lot of accounts payable, or if a company has a large value of pensions that the company owes to its employees, then we might be underestimating leverage and we might be overestimating solvency, okay, for that company. So what I do is I usually prefer to look at 2 and 3. So you either divide debt by debt plus equity, okay? So here what you're doing is essentially ignoring the other liabilities, but both in the numerator and in the denominator, right? So we are not including other liabilities in the numerator, we're not including other liabilities in the denominator, okay? Or the other thing you could do is to include everything, right? So that would be ratio number 3, where we divide total liabilities by total assets, okay? So my recommendation is that we look at ratios 2 and 3, but I wanted to discuss debt over assets because that is a commonly used debt ratio that you might encounter if you're reading about companies in another source or in a textbook. So I thought it was important that we discuss that. So let's focus on 2 and 3. And as we did for the first section, I want to talk about the calculation of these leverage ratios using data for real-world companies. So here, we are going to focus on Cablevision as we did when we discussed the liquidity ratios, okay? And then think about how much leverage does Cablevision have, okay? So this is the data here on the left-hand side. You have data on the current capitalization of Cablevision. So you have data on the current stock price and the current market capitalization. So that is the market value of equity, okay? You also have data on total debt. And on the right-hand side, what I did is I gave you a simplified version of the balance sheet of the company, okay? So you have assets and liabilities. The first thing to notice here, if you look at this data for a while, okay, is that Cablevision has more liabilities than assets, okay? Right? So right? Look at this, you know, for all years that we have here, Cablevision ends up having more liabilities than assets, right? So what's you know, there's something strange here, right? So Cablevision seems to have more debt than assets, okay? And if you check later the data for DirecTV, you're going to see the same thing, okay? So here's a question for you to think about. Can a company have negative assets, right? Can we have liabilities greater than assets, right? Can a company have negative equity? Okay? And the answer is no, okay? A company that has negative equity, a company that has more liabilities than assets is effectively bankrupt. That means you do not have sufficient assets to pay for your liabilities, right? So that is not a stable situation, right? It means that, you know, that this company should actually disappear. It should be sold off. Something should happen, okay? And if you look at the data, you will see that Cablevision and DirecTV are actually not bankrupt, right? They have a positive market value. They are trading. You know, these are operating companies. So there is something wrong here, right? What's going on? The problem, as we're going to learn now, is book equity, okay? So it turns out that we cannot use book equity to calculate leverage ratios. And the reason is because of something we actually discussed in a previous module in module 1, right? Which is the idea that the book value of equity does not reflect the future, okay? Does not include future cash flows. The book value of the equity depends only on what happened up to this point of time, okay? It only includes what happens in the past. It does not include the value of future cash flows. And if you want to know whether a company is solvent or not, you need to think about the entire value of the company, not just the book equity, okay? So to measure leverage, what we need to do is we really need to use the market value of equity rather than the book value. And when we think about market value of equity, we're going to be thinking about the stock price times shares outstanding, which is one way that you can compute the market value of equity for a company that is publicly traded, okay? So this example shows the importance of calculating leverage ratios based on market values, right? Your answer would not make any sense if you're using book values. So these are the ratios that we are actually going to think about, okay? So instead of using book equity, we're going to use the market value of equity. So it's going to be debt divided by debt plus the market value of equity. And then the second ratio is going to be total liabilities divided by the market value of assets, okay? And so what's the definition of market value of assets? That's very simple. All you need to do is to add total liabilities to the market value of equity, and you would get that, okay? So let's look at an example. Here is the data for DirecTV that I mentioned a few minutes ago, okay? So again, here you have the market capitalization for DirecTV. That is the current market value of equity for the company, okay? You also have the data on total debt that we're going to need, okay? And you have the data on total liabilities. As we did for the liquidity ratios, let's do these calculations using the most recent data, okay? Especially for leverage ratios, it really makes sense to use the most recent data because we are using data on the market value of equity, so we need current data. We need data that reflects the value of the firm as of today, right? So here in the bottom, you have the calculations for you, the market value of equity, which we are pulling out directly from the data, and then the market value of assets, right, which is just the sum of total liabilities, which you have here, with the market value of equity, okay? So with those numbers, it should be very simple to compute the leverage ratios, right, for both DirecTV and Cablevision, okay? So for example, the liabilities over assets for DirecTV would be 0.38, right? All you need to do is to divide the liabilities from the balance sheet by the market value of assets that we calculated in the previous slide, okay? So, and you can do a similar calculation for Cablevision. Here in the bottom, I put the value of the market value of assets of Cablevision for you, for your reference. So again, all you need to do is to divide total liabilities by the market value of assets, or divide debt by the sum of debt plus equity, okay? And you would get these ratios here, right? So what is a good leverage ratio? As we just discussed, definitely below 1, right? A leverage ratio higher than 1 means that a company is effectively bankrupt, right? So a company cannot have leverage ratio greater than 1. It might actually disappear, okay? The average leverage ratio in U.S. companies is between 25 to 30%. So how much leverage should a specific company have? That is a very important corporate finance topic that we are not going to talk that much about in this course. It's a topic that goes beyond what we can cover in this course. So let's just keep these two numbers in mind when we think about leverage ratios. The average leverage ratio in U.S. companies is sort of 30%, and you definitely cannot have leverage higher than 1 or getting very close to 1. Okay. So how does leverage get high? As we discussed with liquidity, it's important to understand what sort of decisions would make a leverage get high, right? So every time a company issues debt to do something, you are running the risk that your leverage may increase, right? So if you issue debt to repurchase equity, that is a decision that will definitely increase your leverage ratio, okay? If you issue debt to invest in projects, then it may be, right? Remember, we are using the market value of equity to compute our leverage ratios. If you invest in a new project, the market value of equity may increase. That's something we're going to talk about in Module 3. So your leverage ratio may go up or down. But if the market value of assets doesn't increase that much, then your leverage ratio may end up higher. Okay? And finally, poor performance is always a reason why leverage may increase, right? So if the company does poorly, equity value goes down, right? And the leverage ratio is going to increase mechanically. So poor performance, again, is a reason why your leverage might get too high. Let's move on now and think about the income statement, okay? So now we're going to talk about financial ratios that we're going to calculate using data from the income statement. The first thing we need to think about is what does the income statement measure, okay? Here you have an example of an income statement for DirecTV, okay? First thing is there is this term LTM, which is defined here in the bottom. What this means is that it's the data for the latest 12 months. So if this is March 31st, 2015, what this means is that you have the data from April 1st of 2014 to March 31st of 2015. Okay, so it's a year, right? And in many cases, the most current data that you can get is going to be a latest 12-month figure, right? So essentially what you have in the income statement is data on profits and costs. So you have revenue, right? You have costs, you have profits, right? And so the key information really that you can get from the income statement is profitability, how profitable a company is. Okay, the income statement is the statement that is going to give you that information, right? There are 4 profitability ratios that we're going to discuss. The asset turnover, they are defined here: asset turnover, net profit margin, return on assets, and return on equity. And you can see that for some of these ratios, we are going to use this important measure, which I call OPAT, okay? Which is operating profits after taxes. OPAT is defined as operating income minus taxes, okay? And as we're going to discuss next, OPAT is a really good measure to use when you are trying to figure out how profitable a company is, okay? The return on equity measure, which is measure number 4, uses net income instead of OPAT. So we're going to talk about, the first thing for us to talk about is what is the difference between OPAT and net income. And to do that, let's look at Cablevision income statement again. Okay, so here you have the latest 12-month figures. Okay, let's use those, right? You have revenues, costs, profits. Operating income is here. It's at the top of the income statement. Okay, that's the key thing. Operating income is right there at the top, so it only includes operating revenues and costs. Okay, so revenues and costs that really have to do with the business, right? For a company like Cablevision, they sell digital TV and internet, right? So these are the revenues that they get from their customers, and those are the costs of operating the company, right? Operating income is going to be a measure of that. And then after that, we're going to have the non-operating expenses and revenues, right? So we have interest expense, we have interest income, okay? And you can see here that there is a net interest expense. That's the amount of interest that the company paid. So your net income is going to be a profit figure that is reported after interest payments and other non-operating items. Net income is at the bottom of the income statement, okay? If you work out the math here, right, what would be your OPAT? Your OPAT would be the operating income minus taxes, right? I've done the calculation there for you. So the OPAT for Cablevision in this latest 12-month period would be $764 million, right? And if you do the math, you know, the interest is the interest is 580 million. So you can check that net income is approximately OPAT minus interest. The difference between OPAT and net income is mostly that net income is an after interest measure. Okay? So what's the right way to think about that? If you think about OPAT and ratios that are based off OPAT, like ROA, what you're going to be doing is measuring profitability for the company as a whole, right? So they are up there in the income statement. For Cablevision, for example, you're measuring the profit for the entire company. If you use net income or return on equity, you're going to be measuring profitability from the perspective of shareholders only, okay? Because net income is a profit measure that is reported after interest, and ROE is a financial ratio that is based off net income. So we are not going to be including, essentially, we are going to be deducting interest payments and other non-operating stuff from your profit measure. Okay? So this might be okay, but as we already discussed a little bit in this course, net income is at the bottom of the income statement. So one problem is that net income is easily affected by accounting manipulation and one-time items, right? So if the company has a one-time expense, like a legal settlement, for example, if Cablevision gets sued in a given year, that has to be reported in your income statement. It's going to reduce your net income, right? And there are many ways that companies can manipulate the accounts to change your net income. Operating income is usually a more solid measure. Okay, so for many companies, ROA is going to be a better measure of profitability than net income because of these two reasons. Okay, it computes profits for the entire company, and since it's at the top of the income statement, is a measure that is a little bit harder to manipulate than net income. And here comes a question for you. Right? We talked about using the market value of assets and the market value of equity to compute leverage ratios, right? We just did leverage ratios, and there, if you want to figure out how solvent a company is, we have to use the market values, okay? Now we are computing profitability ratios, right? So for example, just to give an example here for you to understand what we're talking about, ROA is going to be defined as OPAT by assets, right? And the question is, should you use the market value of assets, right, or the book value to compute profitability ratios? Okay, so think about that for a while. The answer might be a bit surprising, but it makes a lot of sense once you think about it. To compute profitability ratios, you actually want to use book values. Okay? Why? You want to compare profits to capital that is invested in the company. Okay? And remember that a company's market value is going to measure the company's total value, right? It also includes the value of future cash flows. Okay? So it's not really a measure of how much capital has been invested in that company. It's not a measure of how many dollars investors put in that company. It really is a measure of the value of the company. Okay? One way to think about this, let me go back here, because this is an important idea. Okay? If you use market values to measure profitability, what you would be doing, right? So in the numerator, you have current profits. In the numerator, you'd have something like current profits. If you use market value, remember, the market value of assets is going to depend mostly on future profits. Okay? So you're going to be dividing current profits by future profits. Does that make sense? Not to me, right? So a company that is profitable, suppose you find a company that has a lot of future profits, okay? That, and you use market value of assets, this company is going to have low profitability ratios, but it would be unfair to call this an unprofitable company, okay? So this is a ratio that really does not make that much sense to me, okay? If you want to compute profitability of the company, you have to use book value of assets and book value of equity, if you can, in the denominator, okay? Let us now give some examples for Cablevision and DirecTV. Here I have a simplified snapshot of the Cablevision balance sheet for you again. Okay, so you can see the value of assets. We already computed OPAT, which is down there, right? OPAT for Cablevision is 764 million, right? So what you need to do is divide OPAT by the total value of assets if you want to compute ROA. So the value of assets is here. That should be very simple. Cablevision ROA should be 0.11. Okay, and you can get the data that I provided, and of course I will provide these calculations as well for you. So you can get the data and verify that you can get these numbers, which should be really easy to compute. All of them using the most recent data: asset turnover, net profit margin, ROA. Okay, let's think about ROE, right? ROE, let's go back here again, okay? ROE is what? ROE is net income divided by equity. And remember, do we use market equity or book? Book, right? We just learned that. So you would need to use book equity. But we know that book equity for these companies is negative. Okay? Book equity for these companies is negative, right? So you really could not use ROE to measure profitability for Cablevision and DirecTV. So it's a measure that does not make much sense. It wouldn't be very useful for you, okay? And it's, you know, this is a common problem. Book equity is a problematic figure to use, and that is why, in general, I prefer, okay, I prefer to look at profitability measures that measure profits for the company as a whole, like ROA. ROE is going to have problems, okay? Finally, let's talk about earnings per share. Okay, this is a profit measure that we talked about in the beginning of this module already, right? It's essentially net income divided by shares outstanding. It looks like a stock price, right? But it's based off net income instead of the market value of equity, okay? And we discussed already some of the problems with net income, okay? So, of course, you're going to have some of the same problems as ROE because you're basing your profitability on net income, which is after interest, so it does not compute profits for the company as a whole. It is subject to manipulation and all that. It's affected by one-time items, okay? In addition to that, there is an additional problem, which is that you are dividing net income by shares outstanding, okay? And as we already discussed, shares outstanding can be easily manipulated. It's very easy to change the number of shares outstanding that a company has with something as simple as a stock split, okay? And then, of course, one thing you could do is to adjust your profitability measures, try to get at the actual profits, but, you know, it's much simpler just to not use earnings per share to compare profitability across firms, okay? You know, so my recommendation is that we do not use earnings per share to compare profitability. You know, since the number of shares can be easily changed, you know, it's not, we're not going to be able to say that a company that has higher EPS than another company is more profitable. Okay, so EPS is not a great measure of profitability, at least the way I see it. Let's talk now about the statement of cash flows. I think this is actually probably the most important statement for us to look at. It's my favorite. That's where we can get the most information about what's going on with companies. It does tend to be ignored sometimes. Okay, so I really want to emphasize that we can get a lot of information from the cash flow statement. Okay, let's look at a cash flow statement here to try to figure out what does a cash flow statement measure. So you have DirecTV, okay, again, for the latest 12 months and for the 2 previous years, right? So here, the first item in the cash flow statement is going to be net income. Okay, so you're going to start from the bottom of the income statement, and then you're going to start adding and subtracting items. And there is a very important rule that you should remember. Don't forget this. The sign of a number in the cash flow statement is very meaningful. Okay, so for example, let me go here to emphasize this. So here you have change in accounts receivable. Let's just use that example. Okay, this is minus 189. Okay, what this means is that accounts receivable provided a cash flow of minus 189 million in that period. Okay, so 189 million of cash came out of DirecTV in that year because of accounts receivable. And you can use the same rule for everything. So for example, you know, if you look at debt issued, that has a positive sign, right? which means that debt came into the company, so cash came into the company in that year, right? So the signs mean a lot, okay? So here you have, there are three parts in the cash flow statement that you can see here, right? There is the operating a cash flow part, which is the top of the cash flow statement. So you get to a measure of operating cash flow. That tells you how much cash flow the company has generated from operations, okay? And then we have investing cash flow, okay? So investing cash flow will generally be negative. You can see here that it's minus 3.3 billion for DirecTV, okay? So that means what? Remember the sign, right? It means that DirecTV invested 3.3 million in that year. Okay, and then at the bottom you're going to have the financing cash flows, right? Cash is going to go in and out of the company as well because of financial decisions like dividends. Okay, you can see here that DirecTV is not paying any dividends. Okay, but they are issuing debt, repaying debt, issuing stock, repurchasing stock. So at the end you're going to get a total cash from financing. In this case, it's minus 1.7 billion. Okay. So again, what does that mean? It means that DirecTV paid $1.7 billion of cash to investors in that year, okay? And then at the end, you're going to have the net change in cash, which is the sum of everything. So that's the total amount of cash that the company generated in that year after taking into account operating, investment, and financing activities, okay? So there is a lot. See, just by this discussion, you'll see that there is a lot of information in the cash flow statement. Right? A lot of useful information about what's going on with the company. Okay? For you to understand that better, okay, I actually want you to work with an example, a simplified example before we go back to the cash flow statements for DirecTV and Cablevision. Let's think about what's going on with these companies. We have 4 companies here, A, B, C, and D, okay? And I gave you the main items that you see in a cash flow statement: operating, investment, and financing cash flows. Okay? And the question that I want you to think about using what we just learned about the cash flow statement is, which of these companies is likely to be a startup, a new company that is growing, that is being started up now? Okay? Which of these, A, B, C, or D, is likely to be a startup? If you look at that data, right, it should be clear that the company that is most likely to be a startup is company C, right? Why? Because company C is generating negative cash from operations, it's investing, and raising money from investors, okay? Let me go back here just to the table just to make sure that you understand that, okay? So here, company C, right, has negative cash from operations, minus 400, okay? It's investing, right, minus 200, let's say million, okay? The unit doesn't matter much, let's say million. And it is raising cash from investors, right? So that is a typical situation of a startup company. You're borrowing money, you're not profitable yet, but you're investing in the business because you probably expect to become profitable in the future, okay? So that's how we can use the cash flow statement to really drill down and think about what's happening to companies, okay? So the other companies, we can talk about them as well. Company B is a mature company that is downsizing, right? How do you know it's downsizing? Because the cash from investment is positive. So instead of investing in the business, company B is generating cash by selling off investments, okay? Company A is a profitable company, right? How do we know? Because it's generating cash from operations, but it is also raising additional financing. And finally, if you look at company C, it has a negative change in cash, okay? So in that year, company D did not generate any cash, it lost some cash. What will happen to the company? Is that bad? You know, let's go back here. Think about that. Not necessarily, right? So cash went down for that year. What will happen is that there will be a reduction in the amount of cash that the company has in the balance sheet. Okay? So this company has to be able, it should be able to use its cash that is in the balance sheet to finance this, okay? And if it's not, then the company has to plan some additional financing. This is something we're going to be talking about in Module 2 when we talk about financial planning. That's going to be a very important idea. That's going to be how we're going to figure out whether a company needs new external financing or not, okay? So the profitability ratios that we can compute using the cash flow statement are similar to the income statement ratios we talked about, but they are based on cash profits. The most important ratio is it is the only one that we're going to emphasize here, is what we call the cash profitability ratio. Okay? It's just the operating cash flow divided by total assets, right? So it's very similar to ROA, but instead of OPAT, you're using operating cash flows. Okay? Think about, so here is a calculation for you for Cablevision, again using the latest 12-month period. Okay? You have cash from operations here, which is 1.3 billion. This ratio is very simple. You just have to divide cash from operations by total assets. For Cablevision, this would be 0.20. Okay? And you can do the same thing for DirecTV. You should get a ratio of 0.26, right? So both of these companies seem to be generating a cash flow from operations, right? They are cash profitable, right? And in addition, if you look at the cash flow statements for Cablevision and DirecTV, what you'll see is that both of these companies have negative cash flow from investments, right? And have negative cash flow from financing, right? So let's apply what we just learned about the cash flow statement. What does that mean, right? It means that both of these companies are investing in the business, but they are not raising new financing from investors. They are returning cash to investors, okay? So if you go back here and look at the cash flow statement for Cablevision, okay, you'll see that Cablevision, for example, is issuing new debt, 1.3, but is also repaying a lot of debt, okay? In addition, they are repurchasing stock, okay? So on average, in the latest 12 months, there was no new financing entering the company. The net amount of cash from financing is negative, meaning that Cablevision actually paid off a cash to investors, okay? Which is a common situation for US companies these days. We're going to talk more about that when we discuss our assignment. So we've done a lot of work, right? We computed liquidity ratios, we computed leverage ratios, we computed profitability ratios, we looked at cash flow statements. And if you think about what we've done, we really learned a lot about what's going on with Cablevision and DirecTV, this specific example we looked at, right? And of course, you can use a similar calculation, similar techniques to think about any company that you're interested in, right? Here's the summary of what we discovered for Cablevision and DirecTV, right? Cablevision has higher leverage and lower profitability than DirecTV. DirecTV seems to be a more profitable company, right? DirecTV also has liquidity ratios that are a little bit higher, okay? And if you look at the cash flow statement, what you see is that both companies are investing in operations and are returning cash to investors, right? They have negative cash flow from investment and negative cash flow from financing, okay? So how have the companies performed in recent years? Let's look at what happened to stock prices, okay? As we discussed earlier in this module, the stock price really is the key summary of the value of shareholder value, right? And it should be somewhat related right? If these ratios make sense, then the stock price should be somewhat related to what we discovered here. And if you look at the stock price performance of DirecTV and Cablevision in the recent time period, we're looking here at the last 5 years, okay? What you see is that DirecTV, which is the red line, so this is DirecTV here, Cablevision is the blue line, okay? DirecTV has performed significantly better than Cablevision in the last 5 years, okay? So this stock price chart is consistent with the analysis we've done, right? We learned that DirecTV is more profitable, it has lower leverage. As we learned, poor performance can result in higher leverage, right? So you know, just from doing this quick analysis, it does make sense that DirecTV has performed better than Cablevision in the last 5 years, right? Since we're talking about stock prices, this is a good time for us to think about valuation ratios, okay? This is the last set of financial ratios that we're going to discuss in this module, right? And these ratios are ratios that summarize the company's current market valuation. And there are going to be two versions that we're going to use, but both of them are going to use market values in the numerator. So the market value is going to be in the numerator, and then in the denominator of these ratios, we're going to have either book value or profits, current profits, okay? So let's go back here and think about what these ratios mean. So we have market divided by current profits, for example. Market value divided by current profits, okay? And we've learned already, right, that the market value of a company is a measure of everything, right? Current, but also future cash flows. The market value should reflect all the cash flows, right? So really what you're doing is dividing the future, okay, by today, right? This is how we should interpret the valuation ratio. It's a measure of future relative to what you have today. It's also true when you look at book values, right? As we already learned, the book value of assets essentially reflects what happened to the company up to this point. It does not capture the future. So if you compute a valuation ratio, this really is what you're doing, okay? So remember this idea. It's a very important idea, I think, in finance. So the market to book ratio, let's talk about that one first. It's the ratio that uses book values in the denominator, okay? This ratio can be based either on assets or equity. What do I mean? So there are two versions. We can use the market value of assets and the book value of assets, or you can use the market value of equity and the book value of equity, okay? And we already learned in this module that book equity can be a problematic measure. For example, for Cablevision and DirecTV, you would not be able to compute the market-to-book ratio because they have negative equity, okay? Because of that reason, I think it's better, I prefer, when I'm computing these ratios, I prefer to use assets to compute market-to-book ratios. So instead of using equity, I prefer to use assets, okay? I'm going to show you an example in a second. In terms of value over profits, again, we can do this either based off assets or based off equity, okay? So as we learned already, right, OPAT is a measure of profits for the company as a whole, right? Operating profit after taxes measures profits for the company as a whole. Net income measures profits for shareholders, okay? So ratio number 1 divides the market value of assets, the entire company, by profits, current profits for the company as a whole. Whereas ratio number 2, which is the well-known price to earnings ratio, looks at equity only. So it's the market value of equity divided by net income. These ratios capture very similar information, right? Because you're dividing market values by current profits, right? But you might guess that at this point, I think you can probably guess the ratio that I prefer, okay? I really prefer to look at ratio number 1, right? Why? Because it's based off asset values and profits to the entire company. So we're looking at the entire company instead of looking just at equity, okay? And because we avoid using net income, right? Remember, the key difference between OPAT and net income is that OPAT is at the top of the income statement and net income is at the bottom. So net income is a number that is easier to manipulate, okay? So my recommendation is that we focus mostly on assets over OPAT instead of the price to earnings ratio when we are analyzing companies for corporate finance purposes. Okay? Cablevision. So it should be very simple to compute these ratios. All of these numbers were computed in previous slides. Okay? So it should be really straightforward for you to do these calculations. For example, the market to book ratio should be just the market value of assets divided by the book value of assets. Right? So you can see that this ratio is going to be a little bit below 3 for Cablevision. And you can do the calculation for DirecTV as well, and which, the data is here to make it easy for you. You can compute the other ratio for Cablevision, and that is the answer you would get. Okay? So Cablevision has a market to book ratio of 2.7. DirecTV has a market to book ratio of 3.1. Cablevision has a higher value to OPAT ratio. Okay? Which seems to be an interesting observation, right? So it appears that Cablevision is valued more, right? If you think about valuation ratios that way, right? It might seem that Cablevision is valued more by the market than DirecTV. Okay, so let's think about that for a while. Is this finding, right? Is this consistent with what we've done so far, right? We learned that DirecTV has performed better, right? It is more profitable and all that. So what about this ratio, this ratio that we found now? How can this be consistent with what we've done? That's the question for you to think about for a while. And the answer is yes, okay? It has to be, right? This is the real data. It has to be consistent, okay? Why? Remember, valuation ratio, what it's measuring is future over present, or even future over past, right? The book value of assets reflect what happened in the past as well, right? DirecTV is more profitable, currently is more profitable, and has performed better in recent years, okay? So it's not surprising that really what you're finding is that a greater portion of Cablevision's value is lying in future, depends on future profits, okay? The value of Cablevision depends more on what's going to happen in the future, whereas DirecTV is more profitable today, okay? That's how you would conciliate this higher value OPAT ratio with the analysis we've done so far, okay? And just a final observation here, sometimes future values can come not from organic growth, but they can come from mergers, which is going to be one of the topics that we will discuss in a future module, right? There is a rumor going on that Cablevision might be acquired by another company, right? And of course, an acquisition can definitely change the future prospects of a company. Perhaps that is the reason why investors are boosting the valuation of Cablevision in the expectation that this merger is going to improve the financial situation of the company. This model was about the goal and the language of corporate finance. In terms of the goal, we talked about why maximizing the stock price is a reasonable objective for companies, right? And why it's better than alternatives such as earnings per share and the book value of equity, okay? However, reasonable doesn't mean perfect, so we also discussed the problems, the conflicts that may arise between stock price maximization and social responsibility, other stakeholders like employees, and the government, okay? And finally, we talked about the agency problem, right? The fact that managers may not maximize shareholder value and how corporate governance can help with that, okay? Then we started talking about the language of corporate finance, right? The fact that we can use information from the accounting statements to learn a lot about companies, okay? We used information from the balance sheet to measure liquidity and solvency, okay? And we made comparisons across companies, right? We worked with a specific example, okay? We used information from the income statement to measure profitability and again to make comparisons across companies, okay? Then we looked at the cash flow statement, okay? The cash flow statement allowed us to understand how companies are generating and spending cash, okay? And finally, we looked at valuation ratios, right? Such as the market-to-book ratio. We calculated and we discussed the meaning of valuation ratios, right? That very important idea that a valuation ratio measures future divided by present, okay?
The University of Illinois was formed about 150 years ago with a land grant mission to democratize education. The IMBA is a testament to that mission. We are about access to education. We are looking for talented people around the world across a variety of socioeconomic backgrounds and demographic characteristics to constitute our classes because we believe the heterogeneity in background, heterogeneity in talented people will be fantastic for the IMBA, not only in terms of our visibility, but also in terms of enhancing the experiences of our students. And so what we have done is we are providing the opportunity to people around the world, talented people around the world, to complete a high-quality MBA education for about $20,000. So if you are talented and if you are eager to grow, then we want you to be a part of the University of Illinois family. The University of Illinois was formed about 150 years ago with a land grant mission to democratize education. The IMBA is a testament to that mission. We are about access to education. We are looking for talented people around the world across a variety of socioeconomic backgrounds and demographic characteristics to constitute our classes because we believe the heterogeneity in background, heterogeneity in talented people will be fantastic for the IMBA, not only in terms of our visibility, but also in terms of enhancing the experiences of our students. And so what we have done is we are providing the opportunity to people around the world, talented people around the world, to complete a high-quality MBA education for about $20,000. So if you are talented and if you are eager to grow, then we want you to be a part of the University of Illinois family.
I want to talk about the objectives of assignment 1, okay? This assignment will have open questions and numerical problems. The goal of the open questions is to allow you to discuss in your own words some of the key ideas that we talked about in this module, such as shareholder value and other ideas, okay? And in addition to these open questions, we have an important numerical problem, okay? And this problem is about calculation and analysis of financial ratios. If you remember the lectures, in Module 1, we talked about ratios that describe the financial health of a company. What you're going to do in Assignment 1 is to apply what you learned to analyze two companies in the footwear industry, Nike and VF Corporation, okay? So let me talk a little bit about the goals and what I expect you to do here, okay? So what I will do is I will provide the data that you need to calculate the financial ratios for Nike and VF Corporation, okay? The difference between the assignment and the lecture notes is that these data for the assignment will be in what I call a raw format, okay? This means that the data will be exactly as you would find it in Yahoo Finance, Google Finance, or any other similar source, or capital IQ, okay? My goal is to force you to sort through this data and find the information that you need to compute the financial ratios, okay? So this is a real-world exercise where you're going to get the raw data from the financial statements and compute the ratios, okay? After you do that, make sure that you report the ratios in a way that can be easily read by your peers. And then question 9 is again an open question where you're going to spend some time thinking about what you learned, okay? In a similar way to what we did in class for Cablevision and DirecTV, what you need to do here is to think about the numbers and compare these two companies, okay? So this is again an open question where you're going to do this, compare the financial ratios for Nike and VF in your own words, okay, and summarize what you learned. I will provide my own solution of the assignment, but make sure that you work on the assignment and prepare your solution before you see mine. Okay? That's an important condition for you to take as much as possible from assignment 1 and all the other assignments in the course. So this is the solution to assignment 1. Starting with question 1, where the question was for you to discuss why maximizing current shareholder wealth is a reasonable objective for the company, okay? And the important idea that we discussed in the lecture is that the stock price should reflect all future consequences of current corporate decisions, right? Stock price should reflect all future cash flows, and therefore it's likely to be a much better objective than alternatives such as earnings per share and book value per share, which only measure current profits, disregard the future, and therefore can definitely lead the company to become short-termist, okay? Remember though, as we discussed in the lectures, that reasonable doesn't mean perfect, right? Maximizing stock prices relies on the assumption of market efficiency, right? And it can lead to conflicts between shareholder value and society, okay? Question 2, it really is an application of this idea of shareholder value, okay? So if you think about the differences between bonus-based compensation and stock-based compensation, the key difference is that a bonus-based compensation is going to be a function, is going to be based on current profits, okay? So executives will be paid more if they increase current profits, right? So guess what? What will tend to happen is that this will lead to short-termism, right? So if you tell executives that they're going to be paid more if current profits are higher, you know, guess what? What they're going to do is try to maximize current profits and might take actions that are bad for shareholders in the long term, okay? Stock-based compensation is not a perfect solution, but it may help alleviate this problem, okay? As we discussed in the lecture, there are some issues. For example, many academics and practitioners are concerned that stock-based compensation has gone too far and executives are paid too much. But definitely, if I had to choose between stock versus bonus, I believe that stock is definitely a more reasonable way to set compensation for real-world companies. Question 3 asks you to compute liquidity ratios. And the example here is Nike and VF Corporation, which are two competitors. The solution is here, all the numbers. You can check your calculations to make sure you've done it right. And in terms of the analysis, the 2 points to note are that, first of all, both companies seem to have appropriate liquidity. The ratios are high enough. Second, Nike appears to have higher liquidity than VF Corporation. So those are the 2 points you should have noted in your analysis. Question 4 asks you to compute leverage or solvency ratios. Remember, the key idea here is to use market values, okay? We do not use book value of assets, book value of equity. We use the market value. The market value of equity is the market capitalization, which is just the stock price times the number of shares outstanding. That was directly in the data, okay, both for VF and Nike, right? And to compute the market value of assets, all you need to do is to add liabilities to the market value of equity, as we learned in the lecture notes. Okay? So these are the values that you should have using the latest data. As we discussed in the assignment, for this question, you only need to do it using the latest data. Okay? Given this, the leverage ratios should be easy to compute, right? Debt divided by debt plus equity and liabilities over assets. These are the numbers you should have found. Okay? And if you look at these numbers, you see that both companies have relatively low leverage ratios, right? Nike has lower leverage ratios than VF Corporation. Okay? Then we move on to profitability. As we discussed in the lecture notes, the key starting point here is to compute OPAT, right? We want to compute profitability for the business, profitability for the company as a whole. So the best measure is a measure that considers sales and costs and takes taxes out, right? Rather than looking at net income, which is affected by interest payments, is affected by one-time items and a bunch of other things that may not be relevant if you want to measure the profitability of the company. So this is something we discussed in the lecture notes, and this is and you should have used the idea here to compute OPAT. Okay, so you start from OPAT and then you compute the profitability measures, right? Asset turnover, profit margin, and ROA. Those are the three key measures that we focused on in our lecture notes. What you should have found is that both companies appear to have similar profitability. Okay, so if you look at ROA, for example, right, the ROA ratios are very similar across Nike and VF Corporation. In terms of cash profitability, right, the difference is that here we start from cash flow from operations instead of OPAT divided by assets. And again, these are the numbers that you should have found, right? This should have come directly from the cash flow statement and the balance sheet. Okay, and again, what we see is that both companies are, have a significant cash profitability. Perhaps Nike has a little bit higher cash profitability. Okay. In terms of the cash flow statement analysis, as we discussed in the lecture notes, we can learn a lot by looking at the cash flow statement, right? So I pulled out the main items here, right? As I discussed in the instructions for the assignment, one of my goals was to force you to try to find this data. So I hope everybody found, the most important items, which are the cash flow from operations, the cash flow from investment, and the cash from financing. And of course, the net change in cash at the end. In addition to this, I pulled out the stock repurchase item to allow me to talk about one issue here. Okay, so if we look at these cash flow statements, they are, in terms of the signs, they look very similar, right? So Nike, both Nike and VF Corporation are generating positive cash flow from operations, right? And they are investing in the business, right? And returning cash to investors. So rather than borrowing more or issuing stock, what Nike and VF Corporation are doing is to return cash to investors through stock repurchase. That's why I pulled out the stock repurchase figure here, just to show you that this is a very common way that companies are using these days to return cash to investors. Okay? And notice that if we compare the dollar figures of investment, like capital expenditures, the cash flow from investment with stock repurchase are significantly higher. We'll talk more about that at the end. Okay? Finally, the valuation ratios, right? Remember, the key thing to remember here is that we are focusing on valuation ratios that reflect value and profits for the company as a whole. Okay? So rather than doing price earnings ratios, for example, we are looking at value OPAT. I prefer these valuation ratios because they don't use net income, which is a problematic measure, and they reflect valuation for the company as a whole. And market to book refers to market value of assets divided by the book value of assets. That avoids problems with then negative book value of equity, for example. Okay? So those are the numbers you should have found. What we see is that Nike has higher valuation ratios, right? So what's the overall analysis? This was an open question, so there are, several possible, reasonable, good answers here. Okay, this is what I learned by doing this analysis, overall the companies look quite similar, right? They are both profitable, they both have adequate liquidity, they both have low leverage, right? Perhaps Nike has a little bit higher liquidity and a little bit lower leverage than VF Corporation, so you could have mentioned that, right? And it was interesting that both companies are repurchasing stock and investing in the business, but if you look at the numbers, repurchases are larger, okay? So these companies are mostly returning cash to investors rather than investing cash to grow the business. And this is related to this recent debate about investment in the U.S. economy, right? That we mentioned in the lecture notes briefly, right? So there are many practitioners and even the government that are concerned with the low rates of investment in the U.S. economy. Many companies are spending more money repurchasing stock than investing in the business. So Nike and VF Corporation seem to be more, additional examples of that. Okay, and comparing the valuation ratios, what we saw is that Nike has greater future opportunities. As we discussed in the lecture notes, the valuation ratio essentially measures future over past or future over present, right? So the fact that Nike has higher valuation ratios means that investors expect future cash flows for Nike to be higher relative to VF Corporation compared to current ones. In this model, we'll start talking about investments. Investments are, of course, essential for companies, right? They need investments to be able to survive and grow, right? So a very important topic of corporate finance is the financing of these investments and to think about how companies make decisions about whether to undertake an investment or not, okay? We tend to divide investments into long-term and short-term investments. When we're thinking about long-term investments, we're thinking about investments such as capital expenditures, R&D, research and development, right? And acquisitions, which are investments that might take a while, might take a long time to generate cash flows. So we tend to think of those as long-term investments. And in contrast, we also have short-term investments that are investments that generate cash in the short term, that the company has to manage on a short-term basis, like inventory and accounts payable. And we're going to talk about both in this course, okay? Starting in this module, what we're going to talk about is the financing of these investments, okay? We're going to learn how to forecast financing needs and how to manage a company's liquidity. Given a certain investment plan, given investments that a company has to make in capital expenditure, inventory, and all of those, there are very important decisions that a financial manager has to take about the long-term and short-term financing of these investments, okay? So we're going to be talking about long-term financial planning, which is the funding of long-term investments such as capital expenditures, okay? And then we're going to talk about short-term financial planning, which, as we are going to learn, is mostly related to working capital management, okay? And we're going to be talking a lot about the implications of working capital management for cash generation in companies and how do companies manage their short-term financial plan, okay? So what we're not going to talk about in this model, which is coming up next, is whether an investment should be made or not, okay? So the idea is in this model, we will take investments as given and talk about the financing, the funding of these investments. In the next two modules, we will talk about whether companies should make new investments or not. Which financial tools do we have to make decisions about whether a new investment should be made or not, okay? So in module 3, we will talk about tools that allow us to measure whether a new investment in the company increases shareholder value or not. And then in module 4, we will talk about whether acquisitions increase shareholder value or not, okay? What we will learn in this model is, as I said, the financing, financial planning that goes behind these short-term and long-term investments. So the first thing we're going to talk about is the forecasting of financial statements. As we're going to learn, we need to forecast financial statements to estimate the long-term financing needs that companies have. Okay? And then we're going to talk about working capital management that relates to short-term investments like receivables and inventory. Okay? And as we are going to learn, working capital management has very important implications for cash generation in companies in the short term. Okay? So we're going to learn how to calculate and analyze working capital ratios, how to measure cash conversion cycles, and then we're going to have several examples that illustrate the importance of working capital management for short-term cash generation in companies. So we're going to have one example that talks about inventory management when sales growth rates are very high. And then we're going to have another example when we talk about seasonality in sales. And finally, we're going to be talking about liquidity risk, a very important notion of liquidity risk specifically arising from short-term financial planning, specifically from accounts payable. So those are the topics we're going to be talking about in our financial planning model. So let's start with long-term financial planning. Okay, the starting point for us is going to be financial forecasting. So we're going to be examining financial statements as we did in Module 1, but we're going to be thinking about the future. Forecasting, it's the key word. Thinking about how the financial statements are going to look like in future years. Okay, so why do we do that? Why would a financial manager have to forecast future statements? The examples we're going to cover in this lecture are mostly about financing needs. Okay, so we're going to be forecasting future financing needs of a company. Okay, it's a very important corporate finance decision that we're going to be learning on this module. Okay, but forecasting has other uses as well, right? So a very important use of forecasting is to forecast cash flows for valuation. So when you value a company, you have to forecast future cash flows and to come up with a value for the company. That's another important use of that. And a third use that is very important in practice is to estimate the impact of new projects and acquisitions on a company. So if a company takes a new project or if a company acquires another company, how is that change going to affect the financial statements? And as we're going to talk about when we go to mergers and acquisitions, we're going to learn a little bit about that. Okay? So forecasting is a very important topic, very useful. The specific example we're going to be talking about in this module is financing an aggressive expansion plan. Okay, so we're going to have a company that requires a large future capital expenditure. Okay, and this company has to figure out whether and when it will need to raise long-term financing to support this expansion. Okay, and when we think about long-term financing, we are thinking about a new debt or equity issue. Okay. So will the company generate sufficient cash internally? So does the company have sufficient cash from operations, or will it need additional funds? Is the company going to need to go to the financial market to raise more funds? Okay, that is the question that we're going to be answering. And to continue the theme that we started on Module 1, I think it's extremely important to try to deal with real-world financial statements as much as possible. So as much as we can, we're going to be dealing with real-world companies. For this specific example, we're going to use financial statements from PepsiCo. Okay? So we're going to work with actual financial statements from PepsiCo and consider the impact of an investment program. Okay? So there's going to be specific assumptions we're going to deal with. We're going to start with 2014 year-end financial statements. Okay? So those we know already. They were reported. They were audited. Those are solid financial statements. Okay? And then what we're going to do is we're going to engage in a guessing game. Okay? We're going to try to guess what's going to happen in the future. As we're going to learn, perhaps the most important forecast is the revenue growth. Okay, revenue growth is going to affect everything, right? For the revenue growth, we're going to have specific numbers. So revenue is going to be growing at numbers that we are actually going to take from Capital IQ. So those are actual forecasts made by analysts. What's going to happen to PepsiCo in the next couple of years? What they are forecasting is that there's going to be negative revenue growth in 2015 and then positive revenue growth again in 2016. The numbers are there, minus 4.4, 4.05%. Okay? And then we're going to come up with an expansion plan. Okay? So PepsiCo, this is going to be an assumption that we make. We actually don't have this data. It's very difficult to get data on capital expenditure plans from real-world companies. So this is an assumption we're going to make. PepsiCo is going to need to invest $3.5 billion in 2015 and $6.5 billion in 2016. Okay, so we came up with that. As you can see, it's a very significant capital expenditure. Okay, and then we're going to have other assumptions. Investment in net working capital is going to be equal to 2% of revenues. Okay, and then we're going to have interest payments being equal to 4% of 2014 total debt. Those are reasonable forecasts. And we're going to keep the same dividend policy. So the PepsiCo is going to keep paying a constant fraction of net income as a dividend. Dividend is also a use of cash, so we have to forecast dividends as well. Okay? And then the question we're going to try to the question we're going to try to answer is whether the firm can finance this expansion without issuing new debt or equity. Okay? Does the company need to go to the bank to get more cash, or does it have sufficient cash flow to finance this expansion plan? To answer the question we just posed, we will need to do financial forecasting, right? That's what we just talked about. And the first financial statement we're going to be thinking about is the income statement. Okay, so now we're going to learn how to forecast an income statement, right? The model we're going to use is what we call a percentage of sales model. So in the percentage of sales model, all the key variables are going to be growing at the same rate as revenues. Okay, so everything is going to remain a constant proportion of revenue with certain exceptions. There are some variables that we cannot use this assumption for, other variables we can. Okay, so that's what we're going to be talking about now. It's a very common forecasting model. Obviously, it's not the only one, right? And it works better in some situations than others, but it's going to allow us to illustrate what it takes to forecast a financial statement, in this case, the income statement. Okay? So this is the income statement for PepsiCo. As we said, we're going to start with December 2014 financial statements. Okay, so these were the audited numbers that PepsiCo reported at the end of the fiscal year in 2014, right? And then we're going to be thinking about what's going to happen next. As we go forward, right, what's going to happen to revenues, costs, and ultimately what's going to happen to the company's profitability, right? That's what we're looking at. The income statement ultimately gives you information about profits. That's what we learned in Module 1. So we're going to be thinking about future profits, right? So, how do we use this model, right? So we have here our revenue forecast for 2015, right? As we just talked about, we're going to use revenue growth rates from Capital IQ, right? So for 2015, revenues are expected to grow at a negative rate. So PepsiCo revenues are actually going to decrease, right? So they're going to decrease from 66.7 billion to 63.7 billion. Okay, you can check that this is a 4.4% decline. Okay, and now the question is, what is going to be the cost in 2015, right? And I want you to think about that yourself and try to solve that. Okay, so try to figure out what is going to be the forecast for cost of goods sold in 2015. So here's the answer. Okay? So we start from revenue. The idea of this model is we start from the top of the income statement, revenue, and then we use the same assumption to forecast the other items. So really what it boils down to is that COGS in 2015 is going to be growing at the same rate as revenue, right? So notice it's 4.4 here, 4.4 there, okay? So it's really very simple, right? The other way to think about it is that the company is going to keep the same fraction. Okay, so here you have the a fraction. You know, in 2014, COGS were $30.9 billion. Revenue were $66.7 billion. So that is a fraction, right? And what's going to happen in 2015 is that the company PepsiCo is going to keep the same fraction of COGS. Okay, so COGS is going to decrease to $29.5 billion, right? So that's the assumption we use. And you know, of course, it's more reasonable. It's reasonable in some cases. It's less reasonable in other cases. But that's how you would use a percentage of sales model, right? So what we do is we go back in the income statement. Okay, so you would go back here in the income statement and just using a spreadsheet, right? Or you will probably be doing this in a spreadsheet, right? It's not practical to forecast income statements on pencil and paper, but that's literally what you'll be doing, is just writing the numbers, right? So you have revenue here, right, that we came up with, and then you keep forecasting the other numbers, right? So we figured out that COGS is going to be this value, right? SG&A, we're going to use the same assumption, right? They're going to be growing at the same rate as revenue. You're going to have the same fraction. It's the same thing. So you can check that is the answer we're going to get. So SG&A in 2015 is going to be $24.5 billion, okay? And now we come to this item, others, right? So I want to talk about this a little bit. In every real-world financial statement, there are going to be items that we are not sure about, right? So what are these others? And in some cases, you can do additional research. In other cases, it might even be difficult to find out exactly what this item is. Okay, so think about we are trying to forecast future financial statements, right? So the key question is, what's going to happen in the future? Is this item going to be a recurring item? Is it going to grow? Okay, so there are several assumptions you could work with here. Okay, so a common assumption when you have these other items is just to assume that they are one-time items. Okay, that they are non-recurring. And that, so whatever is happening in 2014 is not going to keep happening in future years. So that means you would just add a zeros to this line. Okay, so that's what we have here in this slide. We have other non-operating income. Okay, the question is, are they recurring items or are they one time? Here we're going to assume that they are one-time items and that they're not going to happen again in future years. Again, of course, it's an assumption, right? Every time we forecast a financial statement, we are making assumptions. The assumptions could be more or less reasonable, and it really is the job of the financial manager to try to come up with as good assumptions as possible, right? Then we have interest payments. When you think about interest payments, it becomes, it's very clear that we should not forecast interest payments as a constant fraction of revenues, right? The amount of interest that a company pays is going to depend on how much debt the company has, right? So PepsiCo in this case has $29 billion in debt in 2014. Okay, you can check the slide with the balance sheet that is coming up in a few slides. Okay, so PepsiCo has $29 billion in debt. That means that your interest payment is going to be whatever interest rate you're paying times the amount of debt that you have. Okay, so if you do this calculation, using our assumption, again, there is the important slide with all the assumptions we are using, right? Interest expenses is 4% of total debt. That means PepsiCo is going to be paying a 1.15 billion interest payment every year. Okay? And then we're going to assume a constant tax rate. So the tax rate is not going to change in future years. And really, these are all the assumptions we need to forecast the entire income statement. Okay? So here are some of the numbers that we wrote down ourselves, and we can do it for every little cell here. Okay? So here you have the interest, for example, right? Taxes, we are assuming a constant tax rate, right? And what that means is you can forecast all the items, right? With the other non-operating income, we are using the same assumption we used above, which is to set them to 0. So effectively, we are assuming that this is a one-time expense that is not going to happen again in the future, okay? So that is the answer. That is our forecast of PepsiCo's future income statement. So now we're going to move to the cash flow statement. We have just done our forecast of the income statements, right? So now we're going to be thinking about cash flow. As we learned in Module 1, right, the cash flow statement has 3 different parts: the cash flow from operations, cash flows from investment, and cash flows from financing, right? And then at the end, we have the net change in cash. We already talked about that. So cash flow from operations, cash flow from investing, financing, and then the net change in cash at the end, right? Which is what we learned in Module 1. So here again, we have the 2014 cash flow statement for PepsiCo, right? So those are the actual numbers that PepsiCo reported in 2014. So you start with the earnings, right? And then you make the adjustments to change earnings into cash flows, right? Depreciation, you're adding depreciation because it's a non-cash expense. The company actually had some positive cash flow from working capital in that period, so that's how you end up with a 10.5 billion cash flow from a 6.5 billion net income number, okay? But our goal here is to forecast the future, right? So what we're going to do is, again, keep using the assumptions that we made in the percentage of sales model, right? So we have the depreciation in 2015, for example. We are going to use the percentage of sales model, right, and assume that depreciation is going to be growing at the same rate as revenues. Okay, so depreciation is going to be a constant fraction of revenues. That's why we have the 4.4% growth rate here. Okay, so in terms of working capital, our assumption is that working capital is going to be 2% of revenues. Okay. And you might have learned this already or not. In any case, we are going to be talking about this in this module when we talk about working capital. We should think of working capital as an investment, okay? Working capital is an investment in the business, right? This investment is going to generate a negative cash flow, okay? So it's exactly like a capital expenditure. So there is an investment in net working capital that PepsiCo requires that is equal to 2% of revenues. Okay, so as we did in the other, in the case of the income statement, okay, we can go back here and start writing down our numbers or doing it in a spreadsheet, right? So we have the earnings here, right, that you start with, right, and then we have the depreciation that we just figured out. Okay, it's like $2.2 billion, right? The investment in net working capital, right? With the other adjustments, as we just discussed, we are going to keep the assumption that these are one-time items. We're not going to worry about those, so we're going to set those to 0, right? And then, given that, we can compute the cash flow from operations for PepsiCo in that year, which should be equal to $7.3 billion, right? So you're adding depreciation, deducting the investment in net working capital, you're going to come up with a cash flow from operations of $7.3 billion. Right? And then we move on to the part of the income statement where we have our capital expenditures. Remember, our original goal was to figure out whether the company could fund this expansion plan, this capital expenditure with internal funds, right? So that's where the capital expenditures are going to be entered in the financial statement, right? So here we assumed that there is going to be a 3.5 billion capital expenditure in 2015 and a 6.5 billion capital expenditure in 2016, right? So we enter those here, which means that your cash flow from investing in the future years are going to be equal to those numbers, right? So PepsiCo is going to require $3.5 billion to invest in 2015, and then $6.5 billion to invest in 2016, right? So now we have the cash flow from operations, we have the cash flow from investment, right? Let's think about the financing cash flows, okay? So one of the assumptions we used is that dividends are a constant fraction of earnings, right? So dividends are going to be a constant fraction of earnings, so you can forecast dividends using that formula, right? The same ratio that PepsiCo paid in 2014 is going to be paid off in 2015, okay? And now I want you to think about this question, okay? This is an important part of the financial state of our forecasting exercise, is to figure out which value should we input for net debt and net equity issuance. Okay, so which values are we going to put in the cash flow statement for the items that correspond to debt and equity issuance, right? And just a hint for you, that has to do with the question we asked to begin with. So remember, right, the question we are asking is, can PepsiCo finance this expansion without new debt or equity issuance? Right, that's the question, right? So if we have no new issuance, right, really what this means is that it's a big zero, okay? That's what we should have, right? There is no new funds coming into the company. What we're going to do is we're going to input some big zeros in that cash flow statement, right? So here we go back to the cash flow statement, right? And every time you see net issuance of stock, net borrowing, we're going to add zeros. Okay? So this is not, and this is not an assumption. It really is the question you want to answer, right? You want to figure out if PepsiCo can finance the expansion plan without issuing new funds, so you have to input zeros here, right? If you had some funds coming in, then you're not asking the right question, if you want, right? So that's what this is the answer. That's what we should do. So I think now we are ready to look at the entire cash flow statement, right? So that's our answer. The numbers we plugged in, right? Here's the capital expenditure, right? And the dividends, right? Notice that the dividend is coming in with a negative sign, right? Because dividend is a use of cash, is going out of the company, right? And then we have the zeros, right? There's no new issuance of stock, no new borrowing, okay? There are no negative numbers either, right? Notice that in 2014, PepsiCo was actually repurchasing stock, okay? So what we're going to do is we're going to eliminate this repurchase program going forward and ask whether PepsiCo has sufficient cash to pay for these investments, right? So with all these assumptions, we can figure out the total cash flow from financing, right? Which in this case is just going to be the dividend. So essentially, we are assuming that PepsiCo is only paying out the dividend and is not issuing issuing new stock or debt, or making any stock repurchase or paying debt, right? So we come up with the cash from financing here, and then in the bottom we can estimate the net change in cash, right? So that's the amount of cash that PepsiCo is going to be generating in 2016 and in 2015 according to our financial model, right? So just to put the words here, if our model is correct, PepsiCo is going to be generating $190 million of cash in 2015, and then it's going to be generating minus $2.6 billion of cash in 2016. Okay, so that's what we come up with, right? So now let's try to answer the question. We have the income statement, we have the cash flow statement, and we've just figured out that the company is going to have a net change in cash of $2.6 billion in 2016. So, there is a negative number, right? So the question is, does this negative number require PepsiCo to issue new debt, for example, right? So does PepsiCo need to raise money from investors to cover this negative change in cash or not, right? So that's what we're going to do next. And as you're going to learn in a second, we actually now have to go to the balance sheet, right? And we have to think about how much cash the company has in order to answer this question. as we just discussed, now we need to think about the balance sheet, okay? And I know it might look scary. Now we have all these items here, right? So you might think it's going to take a long time for us to go through all of these. How do we forecast all of these? Okay. The good news is that for the question we are going to answer, okay, for the question that we are asking ourselves, the most important item to look at is actually the first one, cash and short-term investments. Okay, we are actually not going to have to worry so much about the other items. The most important thing is to think about cash, right? What is going to happen to cash in 2015 and 2016? That's the key item that we're going to think about, right? So how do we forecast cash? It actually is fairly easy, right? It's not an assumption. This really is an accounting definition, right? So the PepsiCo's cash in 2015 should be exactly equal with the cash in 2014 that you ended up the year with, plus whatever happens in 2015, right? So if you generated $190 million of cash, as in our example, your cash is going to go up a bit. And then you go to the future year, right, 2016, what happens? We start with cash in 2015 and then add or subtract the change in cash in the next year, right? So as we just learned from forecasting the cash flow statement, what's happening here is that the company is generating a bit of cash in 2015 and then generating a large negative cash flow in 2016, right? So the answer is that cash is going to go down by approximately $2.5 billion between 2014 and 2016, okay? So you could go back here, right, if you want, and just write down these numbers, right? So your cash is going up a little bit from 2014 to 2015, right? And then it's going to go down substantially from 2015 to 2016, okay? So this is the number, right? PepsiCo's cash, according to our forecast, is going to go to $6.3 billion, okay? What about the other balance sheet items, right? So as I said, we don't have to worry so much about those now, okay? But the solution that I'm going to post, the Excel spreadsheet that I'm going to post on our website, okay, actually has everything done for you. The important thing to notice is that the changes in the balance sheet have to be consistent with the changes in the income and the cash flow statement. Okay, that's what we did for cash. Our cash flow statement projects that cash is going to go down by $2.5 billion. The balance sheet reflects that. Okay, same idea here. For example, PPE, right? PPE is property, plant, and equipment, right? PepsiCo has some equipment. If you are making capital expenditures, if you're engaged in an expansion plan, right, your PPE is going to increase. Okay, so the increase in net PPE is going to be equal to the capital expenditure in 2015 minus the depreciation, right? Your assets are going to depreciate by a certain amount. Okay, same thing for working capital items, right? We assumed that the company requires net working capital investments in receivables and inventory. So the amount of receivables and inventory that you end up with in 2015 have to reflect the increase that happened during that year. Okay, so it really is pretty simple, but it does involve, of course, a lot of calculations, and you can check here what the answer is, right? So for example, your PPE is going up, especially in 2016, right, because of your expansion plan. Your current assets are also reflecting, receivables and inventories are reflecting the increase in working capital, okay, and so on and so forth. As I said, I will post a solution with all the details and all the numbers for you to check, okay? But as I said, really the important number to think about is cash, okay? So think about this question. Now we are ready to actually answer the question that we posted in the beginning. We've done all the work, so now it's just analysis, okay? So let's think about this. Can PepsiCo finance the expansion plan or not, given these numbers? The answer is yes, right? It seems to be yes, okay? Why? Because, PepsiCo has about $8.7 billion of cash in 2014. That's a cash reserve that the company has. Okay, cash is going down, of course, right? Cash is going down to 6.3 billion, but that seems like a reasonable, still a reasonable number. PepsiCo has sufficient cash to finance this expansion plan, right? The answer would be different, for example, if cash had become negative. Okay, so if you figure out that you don't have enough cash to finance an expansion plan, then you're going to need to issue new funds, right? That's when the company has to plan and financing, go to the capital markets and raise new financing. Okay, but in this case, the answer seems to be yes. And notice the word seems. Okay, everything is more complicated than it seems, right? So there are two issues that you want to consider here. Okay, remember in Module 1, we talked about liquidity, cash ratios, right? So, yes, PepsiCo has sufficient cash to pay for the capital expenditure. On the other hand, this implies that PepsiCo's cash ratio is going to go down, right? If you work out the numbers, PepsiCo had approximately a 50% cash ratio in 2014. Remember, the cash ratio is cash divided by current liabilities, right? And this cash ratio is going down from 50% to 30%, right? So now PepsiCo's financial manager, the CFO, has to think about, is this still a good level of liquidity to have, right? How is the financial manager going to answer that question? Probably by doing even more financial forecasting, right? So now you're going to have to think about what's going to happen even in future years. Is Pepsi going to need more cash, right? Should we maybe keep a 50% cash ratio just for security reasons and all that, right? So maybe it's not true. Maybe PepsiCo will have to issue additional external finance, okay? Plus, again, let's go back to an idea we discussed in Module 1, okay? PepsiCo is a multinational company, right? So some of this cash is likely to be trapped outside the US. So try to remember that. Why is this, right? PepsiCo is a multinational, right? So if PepsiCo decides to bring the cash back to the US, it's going to incur a large repatriation tax. So it seems like PepsiCo has a lot of cash, but in the real world, managers may actually prefer to, instead of using their cash reserves, managers may actually prefer to issue new debt to pay for this capital expenditure and avoid the repatriation tax. So that's another issue that a PepsiCo financial manager has to consider before you decide, yes, we're not gonna issue any new external financing. So we just discussed PepsiCo's long-term financial plan, right? Our answer was that PepsiCo could probably finance the expansion using internal funds, but there are reasons why the company may want to issue new long-term financing, okay? And this is obviously a very important topic in corporate finance. If a company decides that it does need new long-term financing, right? How should you do it? There are many issues to think about here, right? So this is, we call this the capital structure decision, right? So how do companies finance themselves? What kind of securities should they issue, right? And to talk about all of these issues would be beyond the scope of this module, okay? This is something that we're not going to cover so much in this course, but I just want to highlight a few of the key issues that the company would need to consider, okay? So just for completeness, let's talk about a few of the issues that PepsiCo would need to consider if it does decide to issue new external funds, okay? So the first issue to consider is which source of financing to use, right? So yes, you need, for example, $3 billion of cash, let's say. There are many ways you can raise this money, right? You can raise the money by issuing new stock. You can raise the money by issuing a bond, or you can go to a bank and borrow the money, right? So there are many factors that a chief financial officer would need to think about here, including taxes, liquidity, how much leverage you have. Remember, we talked about leverage in Module 1. Now we know how to measure how levered the company is. We have to think about market conditions, right? What do interest rates look like, risk, many other considerations, okay? Like I said, in this course, we don't have the room to talk about capital structure in that detail, okay? But this is something that we will cover in a future course. If you're interested, there will be a second corporate finance course that we're going to do where we're going to be talking about this, okay? Anyway, for us at this point, let's say that PepsiCo decides to issue a bond. Okay, suppose you consider all of this and you're going to raise the money by issuing a bond. Okay, first question to think about, when should you do it, right? We have our financial planning model. We know that PepsiCo is not going to need the money until 2016. Okay, so it's not, you know, your cash is going to stay constant. There's no need to get any new financing until that year. So you might think that it may be better for PepsiCo to just wait, right? Just sit and wait until 2016 comes and then you issue the bond, right? Of course, the advantage of that is that PepsiCo won't have to pay any interest, right? So if you don't issue that until 2016, you're not going to pay any interest on that, okay? The disadvantage, which may be less clear, right, is that you're never sure what market conditions will be in 2016. Right? So it's the future, and we never know what's going to happen. What if, for example, what if we have a new financial crisis? Okay? And this actually allows me to talk a little bit about some research that I've done in a paper that I recently wrote with Scott Weisbanner, that was one of the other professors in this specialization, actually, right? And some of our co-authors, where we look at corporate debt during the recent financial crisis, right? We had a financial crisis around the world in 2007, from 2007 to 2009. Our paper examines what happens to companies during that time. And a very interesting finding that we have in that paper is that companies that were forced to issue new debt at the height of the financial crisis, right, in 2008, did worse than companies that were in a stronger financial position, okay? So it's a little bit like the situation we are discussing here. PepsiCo is thinking about, you know, should I issue the debt today or should I wait? Okay? If you wait, you know, you might end up being in a year where market conditions are really bad. If you are forced to issue debt in that year, you may not be able to issue it, like banks may say no, or you might have to pay a much higher interest rate. Okay? An interesting example that we discuss in our paper is the case of Avis and Budget, which are two car rental companies here in the US. I know they actually operate around the world. And what happened is that before the financial crisis, they were both independent companies. They were competitors, okay? But Budget was exactly in the situation that we are describing here. Budget was forced to issue debt in 2008 to refinance some long-term debt that was maturing in that year, while Avis was in a much higher financial position. And if you read the news, if you read the history, what you'll see is that Avis ended up acquiring Budget following the financial crisis. So Budget was actually acquired by Avis partly because it was going through some financial trouble, and it ended up being swallowed by the competitor. Okay, so poor financial management can have very extreme consequences for companies. That's what we show in our research. Okay, so it may not be a good idea. Going back to our PepsiCo example, PepsiCo may actually want to issue the debt today instead of waiting until the future. Okay, the second question is how much, right? Suppose you need to you decide that you need, let's say, $2 billion, okay, to finance this expansion plan. Should the company borrow exactly $2 billion, right? Again, the advantage is to minimize interest payments, right? If you borrow just what you need, you're going to be paying less interest, but there is a risk as well, right? Think about what could be this risk. It's actually related to what we just discussed. You know, it's this idea, the idea of precaution, right? You know, it may be safer to borrow more. You know, it might sound counterintuitive that having less leverage makes you safer, But when you think about this problem, it may actually be safer to borrow more than $2 billion despite the additional interest. Why is that? You know, we have this forecasting model. Our forecasting model is telling us, yes, we're going to need 2.6 billion, but the forecasting model could be wrong, right? Maybe PepsiCo is going to do worse than what we expect. There might be other expenses. There might be other cash needs, okay? So it actually is, you know, PepsiCo's CFO might actually consider whether it's worthwhile to borrow more than what you need, right? Just for precautionary reasons. And we call this precautionary borrowing, okay? And here comes a question. So if you're going to engage in this precautionary borrowing, if you're going to borrow more than you need, what are you going to do with the excess funding, right? So what should PepsiCo do with the cash? The answer is that you have to hold cash, right? So for this excess funding to give you financial security, you can't spend it, okay? You have to hold the cash in the balance sheet. And again, this allows me to talk about some research that I've done where we make precisely this point that holding cash in a sense is economically equivalent to this precautionary borrowing idea, right? A company that decides to hold cash could potentially use that cash to reduce the leverage. One use of the cash is to repay debt, right? So if you decide to hold cash in the balance sheet, in a sense, you're really deciding to have higher leverage as well, right? Or to put it in another way, you know, a company that does precautionary borrowing, that borrows more than what it needs, is going to end up holding more cash, okay? And that might be, despite the higher cost of this financial strategy, it might end up making sense for a company that needs to take precautions against future cash flow shocks, against future liquidity shocks. We just talked about long-term investments. Let's now move to short-term investments, okay? So we're going to be talking about inventory, right, which is an investment that a company has to make in the short term in order to sell goods. And we're going to talk about receivables. And at first, it may be strange to think about accounts receivable as an investment, right? So things like trade credit, consumer credit. Why is this an investment in the business? Okay? Let's think about that. Why does a company have receivables? Okay? The reason really is that it may be necessary to give for a company to give some terms, to give time for customers to pay for the goods, right? So having a receivable is a necessity of the business because it can increase the demand for your products, right? It gives better terms for customers. If customers have time to pay for whatever you're selling, that might increase demand. On the other hand, receivables are going to tie up cash, right? Because you're giving customers time to pay for the goods, it's also going to take longer for cash to come in, right? And cash is, of course, going to be an important consideration, okay? So how could a company reduce receivables, right? Of course, the first issue you might want to consider is whether it's worth giving discounts, right? Companies can usually trade off receivables for discounts, so maybe you can give discounts for customers to pay early, right? But you will quickly realize that this is going to be costly, right? Discounts are going to reduce revenues, okay? There is an alternative, which is to factor receivables, okay? Let's see how that works. If a company has, for example, $300 million in receivables that you generated because of your business, let's say actually that these receivables are due in a year, okay? The company has two options, right? You can wait a year to get paid, right? Or you can try to get the money now, right? And you can think about how could the company get the money now, right? You can go to a bank, for example, and tell the bank, look, I have a receivable, I have some accounts to receive in a year. Can you give me some money now, right? Or a factoring company. That's exactly what a factoring company does, is to buy receivables from companies that have them, okay? So, of course, that's going to have a cost, right? That's not going to be free. So the bank factoring company will pay less than 300 million, right? So you're not going to get the full 300 million. It's a little bit like a discount, okay? Say it's 280, right? Should the company do it, you're going to lose to 20 million, but you're going to get the 280 million now, right? That is actually a question we're going to be thinking about later in the course. When we talk about net present value, we are going to use an example that is very similar to that. But for now, let's just think about the following, right? It's going to depend really on how bad the company needs the cash today, right? You are paying a significant interest rate, right? Because you are getting 280 million for a receivable of 300. If you think about how this problem works, the company could invest the 280. If the company invested the 280 million at a 7.14% interest rate, you would end up with 300 million at the end of the year. So the implied interest rate on this deal is 7.14%. Okay, so it's as if you are borrowing money at a 7.14%, and the money and your borrowing is collateralized by the receivables that you have. Okay, so selling the receivable really is very similar in economic terms to borrowing against the receivable, right? Let's think about inventory a little bit. Inventory, as you're going to see, is similar, right? We think about raw materials, work in progress, finished goods. Why do companies need to retain inventory? It's necessary for the business to run, right? So you might need to have the finished goods already in place to be able to sell your goods to customers and all that. But the cost is going to be the same as having a receivable. Having an inventory is going to tie up cash because the company has to buy the goods before you actually sell them. So the trade-off we're going to think about is exactly the same, right? So having inventory is necessary for the business on one hand. On the other hand, it's going to tie up cash. Okay, so this is going to be the trade-off in the examples that we're going to talk about in a second. Finally, we have accounts payable, which is the liability side. Okay, so accounts payable are exactly like accounts receivable with a reverse sign, right? If a company increases accounts payable, it might seem like a bad thing. You have more liabilities to pay, but really what you're doing is you're freeing up cash, right? Increasing payables is like borrowing money from suppliers, right? You're telling your suppliers, look, I'm not going to pay you now, I'm going to pay you later. That is going to free up cash for the company, okay? Of course, that might have a cost as well, similar to inventory and receivables, right? If you increase payables, you might affect supply. Your suppliers are not going to like it. They might charge you a higher price. They might say, yes, you can do that, but we're going to charge you a higher price for the good. And then the company has to think about that trade-off. It's exactly the same trade-off, but with the reverse sign, right? And that's why we think of net working capital as an investment, right? So we have receivables, inventory, and payables. Net working capital is just the sum of these three items, right? Receivables plus inventory minus payables. So if a company increases net working capital, for example, increase inventory, right? What you're doing is you are tying up cash, but you're making an investment in the business, right? Or if you're buying inventory, what you're doing is you're making an investment in the business, right? It's a short-term investment because net working capital investments will typically generate cash soon, right? So if you increase receivables, the receivables are going to be paid relatively soon. Your goods will hopefully be sold. So that's why we think of net working capital as a short-term investment. So now we've talked about the main working capital items. Let's talk about the financial ratios that we have in corporate finance to analyze working capital management for real-world companies. Okay? So the first ratio that we're going to discuss as an example is the average collection period in days. Okay, so that has to do with accounts receivable, right? Companies generate accounts receivable due to the nature of the business, and this ratio will tell you how long does it take for a company to collect its receivables, right? The way you compute it is by dividing the total amount of accounts receivable in the balance sheet by the company's daily revenue. Okay, so let me give an example here. Suppose a company has $100 million in receivable and you have a total annual revenue of $2 billion. Okay, that means your daily revenue dividing by 365, right, would be 5.5 million. Okay, and then what you do is you divide the total receivable by the daily revenue, and the answer you get is an answer in days. Okay, so it means that it takes, on average, during the year, it takes 18 days for a company to collect its receivables. Okay? And we have similar ratios for the other working capital items. Inventory and payables, okay? Those ratios are usually based on operating cost. So the definition of operating cost that we use to calculate these ratios is the sum of COGS and SG&A, so cost of goods sold plus selling, general, and administrative expenses, okay? And then the definitions are very similar. The average days in inventory is the total amount of inventory that a company has divided by the daily operating cost, okay? So that measures how many days of inventory a company has in the balance sheet, right? And then we have the payables. Remember, the payables are the other side of the equation, right? So the company borrowing money from suppliers, and this ratio, the average payable period, tells us how many days of payable the company is carrying in the balance sheet, okay? And then at the end, we put all the working capital items together and we compute this important ratio to talk about working capital management, which is the cash conversion cycle, okay? So the conversion cycle is equal to the collection period, okay, plus the days in inventory minus the payable period. Remember, accounts payable always enter with the opposite sign, right? And it should be clear, but let me just make sure everybody's understanding this, right? So let's ask a question now. So what does the cash conversion cycle measure? Let's see if you can answer that one. Right? Going back to the receivable example, it should be pretty simple, right? That what the cash conversion cycle measures is how much time it takes for a company to generate cash from its working capital investment, right? So think about it this way, right? So you have to buy some inventory, right? So suppose you're selling a certain good, right? The first thing a company has to do is to buy inventory and hold the inventory until you sell the good, right? And then when you sell it, you might generate some receivables, right? So if you sum the collection period and the inventory and the days in inventory, you're going to be taking those two times into account, right? How much time it takes for you to sell the good, and then how much time it takes for you to get the money for your customers to pay you fully, okay? And then on the other hand, you have payables, right? Payables are always the opposite sign. Companies are borrowing from suppliers. Having payables is going to shorten your cash conversion cycle, right? Because you're essentially getting cash, borrowing money from your suppliers. So if you calculate cash conversion cycles for real-world companies, really we have a very useful measure of how much time it takes for a company to generate cash from its working capital investments. Okay? In our assignments, we're going to calculate several cash conversion cycles in the real-world examples. Let me give a few examples here. Okay? We are going to use two companies that distribute heavy equipment by companies like Caterpillar, right? Caterpillar produces diesel engines, tractors, very heavy machinery. These two companies, Power Solutions International and Toromont International, what they do is they distribute this heavy equipment. Okay, so they get the machines from Caterpillar and then they sell to other parties. They distribute that. Okay, so what this example will show you is that the cash conversion cycles really depend on the nature of the business, right? So PSI, a little bit more on PSI here. It's a manufacturer, right? It also has some manufacturing business, right? And like we said, it distributes engines and power systems for companies like Caterpillar. Okay, so here are the working capital ratios for these companies. Okay, you can see that there are very significant numbers here, right? So if you look at the inventory that PSI has, for example, right? Let's say in 2014, PSI was carrying 98 days of inventory in its balance sheet. Okay, so you had 98 days of inventory. That means it takes 98 days on average for PSI to sell the goods that it has on inventory, right? You also have some receivables and payables, right? In the end, if we sum inventory to the collection period and then we deduct payables, we get the average cash conversion cycle for PSI, which is 117 days on average, right? So that means it takes virtually a third of the year, right, for PSI to generate cash from working capital investments, right? From the day that they buy the inventory and then until the day that they get paid, it takes 120 days. Okay, taking payables into account, right? Like payables are financing. And just to show you that this is not bad management, right? The competitor Toromont, also has a similar situation, right? Because of the nature of the business, you have to carry a very large amount of goods in inventory, 111 days. Okay, so you end up with a very long cash conversion cycle. Okay. Of course, not all companies are like that. We can compare these two companies with a retailer like Walmart. Okay, the retailer will have some inventory, right? But a company like Walmart really does not take very long to get paid. There are some sales on credit card, but those don't take as long. So what Walmart ends up with is a very short cash collection cycle. Okay, so it only takes 12 days for a company like Walmart to generate cash from its working capital investments, right? So what we learned is that the cash conversion cycle really depends on the nature of the business, because Toromont and PSI have this need to hold large inventory. They are going to end up with a very long cash conversion cycle, right? Distributing engines requires them to keep a lot of inventory, okay? But of course, this is an important characteristic of the business for a financial manager to think about. The financial manager of these companies, Toromont and PSI, has to take that into account and think about how the short-term planning of the company is going to be made. That's where we are going next. We're going to be thinking about how working capital needs like inventory and other working capital needs are going to generate specific needs for short-term financial planning. So let's start talking about short-term financial planning, okay? The general theme of these examples that we're going to talk about is that working capital management, which as we just learned is an investment in the business, is going to determine cash generation and liquidity management needs for companies. Okay, so this is going to become clear as we go through these three examples. The first one is going to be an example of inventory management in a high-growth environment. Okay, then we're going to talk about seasonality, and the third example is going to be about managing liquidity risk arising from accounts payable. Okay, so let's start with inventory management. The specifics, so we are going to have some numbers now to give a specific example. So the situation we have is a company that on average has to purchase inventory 90 days ahead of the time when the goods are actually sold. Okay? The sales are going to be $300 million a year, and they're going to grow at 10% per quarter. Okay? All sales are cash. For simplicity, we're not going to have any receivables. Okay? and we're going to have a profit margin of 8%. And if you're wondering where did I get those numbers from, we can actually show that these figures closely match the current situation at Power Solution International. Okay? The distributor that we just talked about when we discussed working capital ratios, what they have is a situation where they have a very high, huge growth. 10% a quarter is a huge growth rate, okay? Combined with a very long cash conversion cycle, okay? So just to show you this, these are the basic financial numbers for PSI, okay? You can see in this table that the company is growing at a very high growth rate, right? So the growth rate of revenues here is 33%. Expected growth rate for 2014 was 46% at that time, right? The company has about an 8% profit margin, okay? And so in terms of revenue, and the revenue, even the amounts match, right? Because it's about $300 million in annual revenue, 350 expected in 2014, okay? These are the numbers, right? It's a simplification of a PSI's problem, but it is it's going to give a very similar answer to what's actually happening in that company. Okay? So here we have a snapshot of a year in a company like PSI. Okay? We have the sales, we have the costs, and we have inventory. So let's look at this example here. We have, right? Annual sales is 300 million, right? So you start the quarter with a $75 million in sales, okay? And then your sales are going to be growing at 10% per quarter, right? So that's why sales are going to 82.5, then they go to 90.8, then they go to 99.8, okay? So those are your sales. You have an 8% profit margin, right? So your profit is 8% of sales, and your inventory has to be in place 90 days beforehand, right? What this means, essentially, right, it's 1/4 of the year, okay? So what this means is that your inventory has to be in place at the beginning of the quarter, right? So to be able to sell the goods at the end of the quarter, a company like PSI has to have the goods already in place at the beginning of the quarter, okay? So that's what is in this model here. In the beginning of quarter one, the company has to buy 90 million, which then you sell, right? This number goes here. That becomes your cost when you actually sell the good, okay? So you can check that PSI is profitable, right? You're making a profit, which is 8% of sales by assumption, okay? And then at the end of quarter one, right, what PSI needs to do is to buy the inventory for the next quarter, right? They are going to begin the second quarter with $75.9 million in inventory. Where is that number coming from? That number is the cost of the goods that they are going to sell at the end of the second quarter, right? So that's the situation in this company. Every quarter, if you look at this model here, right? Every quarter, at the beginning of the quarter, they have to have the amount of goods in inventory ready to sell for the end of the quarter, okay? So that's the situation, right? So think about this. That is a very interesting example, right? When you start thinking about cash flows, okay? So here's the model. I hope everything is clear now where the numbers come from. So now let's think about the following question. What is the cash flow, right? At the end of each quarter, if we had to figure out how much cash is coming into a company like PSI, what would be the answer? How much cash are they generating? And the answer, it might seem very surprising, but the answer is that PSI is generating negative cash flow, okay? Remember, the assumption, this company has a very high growth rate, right? This company has a very high growth rate. Sales are growing. It's a profitable company, okay? But cash flow is negative. If you want to see why, you just have to think about what's happening here, right? So at the end of quarter one, you're selling 75, but you have to buy the goods that you're going to sell next quarter, right? Because your growth rate is so high, right? The amount of inventory that PSI has to buy every every quarter end is actually larger than the amount that you're selling at that period, right? So your cash flow, for example, in quarter one would be 75 minus 75.9, which is minus 0.9, okay? And this happens every quarter. Quarter one, quarter two, quarter three, quarter four, right? It's a negative cash flow. Plus, you can see that the cash flow is growing. It's increasingly negative, right? That's very interesting, I think. Okay? So think about this. PSI is a profitable company that's growing very fast. If you had heard that before you took this course, you might have thought, yeah, this is a great company, right? And yes, it may well turn out to be a great company, but right now it's generating negative cash flow, okay? Because your investment in inventory is always larger than the amount that you're selling, okay? So your cash flow is always negative. And if you look at the cash flow statement for the company, that's exactly what you see. So the company is profitable, you're generating a positive profit, okay? But the amount of your investment in inventory, which is highlighted here, for example, for the year of 2014, was minus $29 million, minus $29 million, which is significantly higher than the profit that you're generating, okay? When we get to the bottom of the cash flow statement, of course, there are other items here. It's not just inventory. When we get to the bottom of the cash flow statement, what you see is that PSI is generating a negative cash flow, okay? So you're profitable, but you're generating a negative cash flow, right? This is a situation where a company seems to be generating negative cash flow forever, right? And ask yourself, if a company generates negative cash flow forever, what should be the stock price, right? Let's go back to Module 1 and think about what determines the stock price. The stock price is the discounted sum of future cash flows, right? If all future cash flows are negative, the company is worthless, zero, okay? The company should be liquidated. It's not generating any profit, right? Any economic, any cash flow, okay? So this is an extreme situation where you have a company with a very high growth rate, but working capital needs that are actually making the company cash negative. The company is not generating any cash flow, right? And of course, PSI is not bankrupt, right? PSI is a valuable company. Why is this the case? It has to be that PSI is going to become cash positive going forward, right? The company has to become cash positive going forward, one way or the other, right? One possibility is that there's going to be a natural slowdown in sales growth, okay? The 40% growth rate that we had in our model is not reasonable. I mean, it's what's happening right now. It's unlikely to go to keep, the company is unlikely to keep growing at that rate. So if sales growth slows, then this problem is going to change. It's actually one of the examples that we have in our assignment for you guys to go and try to show that. Okay, so there's going to be an exercise where you show that. Okay. In addition, the company might actually consider changing working capital management, right? Perhaps what PSI needs is improved inventory management, right? Maybe you're keeping too much inventory. You have to move towards a situation where you have more just-in-time inventory and try to generate cash quicker. Okay. Another possible solution is try to increase your profit margin, right? We can also show in the example that if a company has a higher profit margin, you're going to be generating positive cash flow. Okay, so the bottom line is that for PSI is definitely expected to become cash positive going forward for some of these reasons. Possibly the most important one is that sales growth is not going to keep as high as it is right now. our second example is about seasonality. Okay, so for many companies in the real world, a common situation is that sales tend to be higher in the fourth quarter, right? But on the other hand, expenses are not necessarily seasonal. Expenses can come at any time of the year. Okay, so that's going to generate seasonality in cash flows, which when you couple that with accounts receivable, that is going to generate a need for short-term financial planning. Okay, so this is what we're going to characterize here using a simple numerical example. Okay, so here you have an example of a situation where sales are seasonal. You can check that sales start low and then they pick up in the fourth quarter. Okay, let's say that the company starts the fourth quarter with receivables equal to 15. Okay, so what this means is that the company is going to collect this 15, let's say $15 million this quarter, and then you're going to collect some cash from the sales this period. Let's say that your collection, the percentage of sales that you collect this period is 80%. Okay, so you sell 87.5, you collect 80% this period. Okay, and in addition to that, you collect the existing receivables. Okay, so you had 15, so your total collection is 85 million this period, right? And now what we're going to think about is, what happens in the future quarters. So let's go here. Okay, right? So think about this. We have you generated 70, right? You sold 87.5 in the first quarter, collected 70 this quarter. So what happens to the rest? It becomes an account receivable, right? The 17.5 becomes a receivable that then you're going to collect next quarter, right? So this is a little bit like our inventory example, that there is this timing of collection of cash, okay? So the 17.5 gets collected next quarter, right? So that is going to be your accounts receivable from last period, okay? In addition to that, you have the sales from this period, okay? So you're going to collect in the second quarter, you collect 80% of that. If you do the calculation, you're going to get 62.8, okay? So your total collection in the second quarter is 80.3, okay? And then, the model goes on, same way as we did for the first quarter. You're going to generate some receivables in the second quarter, and so on and so forth, okay? So here you have the answer, okay? Here you have the answer with the numbers that we plugged in, and in fact, all the numbers for the 4 quarters, okay? So you collect 80.3 in the second quarter, 108.5 in the third quarter, and then you collect 128 in the fourth quarter, okay? So you can see that cash collection becomes seasonal as well, right? Because your sales are seasonal, you're going to collect more cash in the fourth quarter than in the first quarter, okay? Let's think about expenses now, right? So you have the collection here that we just computed, okay? Let's say that there is one more source of cash, just for the sake of the example. It comes in the third quarter, so it's 12.5 million. For any reason, there is another inflow of cash, so it goes to 121 in the third quarter. And now there are the uses of cash, right? So you have to make payments on accounts payable, have to pay your labor expenses, and an important one, let's say that there is a capital expenditure that the company has to pay for in the first quarter, okay? The timing of the capital expenditure doesn't have to coincide with the timing of sales, so it's plausible that that's going to come up early in the year, okay? What this means is that you're going to have a high usage of cash in the first quarter, okay? If you sum all of these sources, you're going to get 131.5 million, okay? Which then means that the company is generating a negative cash flow of minus 46.5 in the first quarter. You generate minus 15 in the second, 26 in the third, and then 35 in the fourth quarter, okay? So the pattern is a seasonality pattern where you generate negative cash flow in the first 2 quarters and then positive in the last 2, okay? So suppose that the company has some cash, okay, in the balance sheet, so you have $5 million in cash, but you have no excess cash. So this 5 million is the minimum amount that you think you should have for precautionary reasons. This is something we discussed already in this module. Companies may need to keep a certain amount of cash. Okay, let's say that this is your minimum operating balance, right? And we computed in our example the sources minus uses, right? So the amount of cash that the company is generating, right? So the question is, how much does the company need to borrow at the end of each quarter, right? So try to think about that yourself. Okay, and here's the answer, right? So since you cannot use your cash, it's as if you had no cash, right? This is your minimum borrowing, your minimum operating balance. So the situation is just as if the company didn't have any cash in the balance sheet. Okay, so what you're going to have to do is you're going to have to borrow at the end of the first quarter. You're going to have to get the 46.5 million from somewhere. Notice that here we are taking the cash into account, right? So we're doing what we did in the PepsiCo example for the long term, but in the short-term model, but we are already taking the cash into account. So really, the company does need to get 46.5 from somewhere. Okay. In addition to this, in the second quarter, you generate an additional negative cash flow. So now you have to borrow $15 million more. Okay. So by the end of quarter 2, the company needs to borrow $61.5 million. Okay. And this is a short-term financial need. Why? Because as we discussed, the company is going to generate cash in the third and the fourth quarter. So when you get to the end, right, when you get to the fourth quarter, the company can essentially repay everything. Okay? So you can, if you borrow 61.5 by the end of quarter 2, when you get to the end of the year, your cumulative financial requirement has gone down to 0. This means that the cash flows you generate in quarter 3 and 4 are sufficient to pay for the amount that you had to raise. Okay? So the question now is, how can the company do this, right? You have a short-term financial need, right? You have to get some cash in the beginning of the year and then repay it at the end of the year. What are the options that this company has? Okay? The first option is to make a short-term loan, right? It doesn't have to be a long-term loan because you can repay it within the year, but you might have to raise some money. Okay? So one option is to open a credit line with a bank. In the next example, we're going to talk more about credit lines, which is a very important corporate finance instrument. Here, you could use a credit line as well. Just have a credit line open with a bank, saying that you could borrow, for example, $65 million from the bank, and then if the company has a cash need in the first 2 quarters, you could raise that cash and then repay it at the end of the year. Okay? Another option is to increase your cash balance, right? You can always use your existing cash to manage this financial need, but this company doesn't have enough cash. So if you're gonna use cash balances to manage this liquidity need, you're gonna have to raise more, either from long-term financial sources, right? So maybe you have to issue a bond or issue equity, or perhaps the company can save cash from operations. Okay? And finally, the third option that the company has is to change operations. Right? If you are having difficulty managing your liquidity using just financial variables, what you can do is to change your operations, for example, delaying the capital expenditure, right? If you can delay the capital expenditure from the first quarter to the fourth quarter, that will be sufficient for you to manage your cash need, okay? Or try to extend accounts payable, right? You can try to get financing from suppliers. And finally, one option that the company could contemplate is to sell receivables, right? Is to either sell receivables to a factoring firm or maybe borrow money from a bank using receivables as collateral, okay? Changing operations, of course, is an option that companies should generally avoid, right? For example, delaying the capital expenditure might be costly for the company, right? If you need to make the investment now, delaying it to the end of the year may not be the best option. So in general, what we recommend is that if you can use a financial, like a loan or a credit line to manage this short-term liquidity need, it will generally be more desirable than changing operations. For example, going to your suppliers and asking them to extend accounts payable. That's going to be a costly option for the business. Raising a short-term loan is generally going to be a lower cost option. the final example we're going to talk about covers accounts payable. Okay, so we've done 2 examples so far. One that looks at inventory and cash management. The other one that looked at receivables and short-term financial planning. And now we're going to be talking about accounts payable. And again, we're going to use a real-world example from Power Solutions International, which is the company we're looking at here. Okay. As a way of motivation and to introduce the topic we're going to talk about, I have here the liquidity ratios for PSI, okay? And you might recognize these liquidity ratios from Module 1. Those are exactly the ratios that we talked about when we were trying to measure a company's liquidity: the current ratio, the quick ratio, and the cash ratio. Here I'm doing the calculations myself. You should be experts at calculating these ratios already, right? So it's a good time. If you forgot the liquidity ratios, this is a good time to do a recap, right? And go back to Module 1 and then remember how to calculate these ratios and what do they mean, okay? So first question, is the current ratio a good measure of liquidity for a company like PSI? This is a topic that we covered in Module 1, right? So think about that, and you pretty soon should figure out that there is a problem with using just the current ratio as a measure of liquidity for PSI, given that the company has very large inventory, right? And this inventory is required for the business, so we should not think of this inventory as a particularly liquid asset, okay? So it's not a bad thing that they have a high current ratio, but it doesn't mean that, that they can always rely on their inventory to manage liquidity, okay? So and if you look at the data in that slide, you'll see that PSI has very low cash, okay? The cash ratio is quite low, right? And is that a problem for the company or not? Okay, so let's think about that, right? The first observation, something we just covered in the previous example, or in the inventory example actually, is that PSI's operating cash flow is negative, okay? So you can check slide 90, for example, and you'll see that PSI has negative operating cash flow, right? And remember, the liquidity ratios, what they try to get at is whether the company has the ability to repay its current liabilities if they come due, okay? Since PSI's operating cash flow is negative, they definitely cannot rely on their cash flow to repay the current liabilities, okay? So how are they going to do it? When the current liabilities come due, how is PSI going to repay those current liabilities? Okay, so let's think about that. First data point that is very important for us to look at is to get some data on what exactly are these current liabilities. Okay, so let's open up the black box a little bit. Instead of just talking about total current liabilities, let's look at exactly which liabilities do they have. Okay, so here are some data for September 2014 for PSI. Okay, and what you see here in the data is that they have about $60 million in current liabilities. Okay, most of those are accounts payable. Okay, $46 million in accounts payable. There are some other current liabilities, a little bit of long-term debt that is coming due. Okay, 1.7 million of short-term debt that has to be repaid next year. Okay, and some accrued expenses. But most of the current liabilities is accounts payable, okay? So those are bills, right? Essentially, those are bills that the company has to pay to suppliers in the next year, in the short term, okay? So question is, for you, what will happen, okay? When PSI's accounts payable come due, what is the company going to do, right? Remember, they don't have cash, they don't have cash flow. Okay, so how are they going to repay these accounts payable? The answer is that PSI, as many other companies in a similar situation, is going to be relying on refinancing. Okay? The key idea here is refinancing. Okay? So what do we mean by refinancing, right? So they have 46.4 million in accounts payable coming due. Okay? They have to repay that. Let's say that comes due in 6 months. Okay? On average, on 6 months. When that liability comes due, what PSI is probably trying to do is to generate a new liability. Okay? So you pay the existing one, and then you borrow more from your suppliers. You go to your suppliers and say, look, I want to keep paying my bills on term, so I'm not going to pay cash. You know, I still want to wait 6 months to pay my bills. Let's just keep doing the business the way we've been doing business. What that means is that there is going to be no cash outflow to worry about, right? Think about this. You pay the liability, but at the same time you're borrowing money from your suppliers because you're generating a new liability for the future, okay? So there is no, there really isn't any cash outflow that PSI has to worry about, okay? Unless what? Unless suppliers deny to extend financing, right? This is the liquidity risk idea that we're going to talk about in this example. The liquidity risk that PSI faces is that suppliers may demand the payment of the 46 million and then deny the new financing, right? In that case, PSI may indeed face a liquidity crisis, right? Because they have to repay that liability, and they really cannot raise the financing from the suppliers anymore. So they cannot refinance, okay? When could this happen, right? One situation is an overall financial crisis, right? There might be an economy-wide financial crisis where all companies want cash immediately, they want to retain cash, so the suppliers may deny additional financing to PSI, okay? The other possibility is when the financial health of PSI deteriorates. Maybe their sales are going to grow less than expected, right? Or perhaps their costs are going to go up, their inventory is going to go up, okay? So if the financial health of PSI deteriorates, then they might have to refinance. The suppliers may actually deny the financing. The third one is that the financial health of the suppliers may deteriorate. Okay, so the suppliers might have been financially healthy, but they might run into problems and then try to raise some cash from their business with PSI. The bottom line is that there are many things that could happen that might create liquidity risk for a company in this situation, okay? So how would PSI manage this liquidity risk? They don't have cash, that's not what they do, right? They are not holding a lot of cash. So what are they doing? One possibility is that they are counting on their receivables, okay? As we discussed in Module 1, the quick ratio captures liquidity that comes from receivables, and if you look at the data, okay, they have $68.9 million in accounts receivable. Their quick ratio is definitely above 1, okay? So perhaps what they are doing is they are relying on their receivables to pay for the accounts payable if they come due, right? How can they do that? This is again a topic we covered already in this module, right? They could try to factor the receivables, okay? Instead of waiting to get paid in the future, they can go to a bank and raise money backed by the receivables. They can sell the receivables to a factoring company. They might get less than the full amount, but they will definitely get cash today that may allow the company to survive and pay accounts payable. Okay, so that is one possibility. It's essentially what they are doing is raising a short-term loan using receivables as collateral. Okay. The other possibility, which is a new idea I want to talk about now, is to manage liquidity risk using a bank credit line. Okay? First observation here is that PSI does have plenty of collateral, right? The inventory that they carry is not a very liquid asset, but it's definitely something that they can use as collateral to raise a bank loan, right? So if they don't repay the loan, the bank can repossess, the bank can take away the collateral and keep the collateral, okay? Same thing with receivables as we just talked about. The nice thing about credit lines is that credit line terms are negotiated ahead of time, okay? So PSI would definitely not wait until you are in a liquidity crisis, right? If to initiate a credit line, that would be the wrong thing to do. Would be probably much better to initiate a credit line today and have that deal in place so you can raise financing when the time comes, okay? To understand that better, let's talk a little bit more about credit lines. How do bank credit lines work, okay? A credit line, you can think of it almost like a credit card, okay? What the company would have a credit limit, okay? So there is a maximum amount that you can borrow from the bank, and the interest rate that is negotiated ahead of time, okay? So a company if a company has a credit line with a bank, you typically have a maximum amount that you can borrow at a certain interest rate, which is negotiated ahead. So it's typically a spread over LIBOR, right? So if the economy-wide interest rate changes, then the interest rate on your credit line would change, but the spread would not change. So the bank doesn't have the ability to, shoot the interest rate up to the roof if the company hits a liquidity crisis, for example. In exchange, what PSI does is to pay a commitment fee to the bank, okay? So if you have a $100 million credit line, for example, PSI would pay an annual fee, which for a company like PSI is going to be fairly low, typically 0.1 to 0.3% a year. They would pay a commitment fee to the bank to keep that credit line open. If you think about that, a credit line is very much like insurance, right? You're paying a fee, right, to the bank. If your house burns down, you have the right to draw on the credit line to meet a liquidity need, okay? And it turns out that for a company, for PSI specifically, it seems to be exactly what they are doing. Here's some data, okay, that I pulled out from PSI's financial statements. You can check that they actually do have a credit line. So let me explain these fields to you. You might not have seen this before. So the undrawn credit, undrawn revolving credit, is the credit line that the company has not drawn yet, that you haven't used, okay? So you can see that they have $48 million in that credit line. That means they can use that, they can raise, they can draw, they can use this 48 million pretty much like a credit card, okay? If they do use it, it goes to this first item here, which is total revolving credit, okay? Total revolving credit means that this is a bank loan that was raised from a credit line. So you can see that they do have a large credit line as well, and maybe the size is not a coincidence, right? The size is pretty similar to the amount of accounts payable that the company has, okay? So the bottom line is that if a PSI hits a liquidity problem, if the suppliers don't want to extend financing, then they might be able to rely on their credit line, okay? They have the right to use that line just like a credit card, and it actually turns out that this is what they seem to be doing in practice to help manage liquidity risk. So here is what we've learned in this module. We covered a lot of topics that relate to financial planning, right? So we started with basic forecasting of financial statements to allow us to figure out whether a company will need long-term financing or not, right? So we were thinking about PepsiCo, whether PepsiCo would need to raise additional financing to support an expansion plan, right? So they had a large capital expenditure, and the question that we answered is, do they have to raise external financing or not, right? So we learned how to use financial forecasting to do that. We talked about the importance of cash and the cash flow statement and all of those issues, okay? Then we talked about short-term financial planning, right? So what we learned, the general idea is that working capital management is an extremely important source of cash generation and cash demands for companies, right? So receivables, payables, and inventory are issues that the companies need to think about on a daily basis, okay? So extremely important for cash generation, okay? And we learned how to calculate and analyze these working capital ratios that allow you to think about, whether a real-world company generates cash quickly, like Walmart, or whether a company has to wait very long to generate cash from working capital investments. And the companies that have to wait long are those for which short-term financial planning is most important, right? So companies like PSI really have to work really hard on their short-term financial planning to make sure that they don't hit liquidity problems, okay? And we did talk about how to manage these short-term cash needs, both in terms of inventory, in terms of receivables, and in terms of accounts payable, right? So we covered 3 specific examples that are not exhaustive, but I think illustrate the issues very well, right? The first example, we talked about inventory management when sales growth rates are very high, okay? Then we talked about seasonality and how that generates the need for short-term cash management. And finally, we talked about the notion of liquidity risk and how to manage liquidity risk using accounts payable, okay? So I hope now we learned a lot about the financial planning. Our next topic in the next module is to think about whether investments should be made or not, okay? Including short-term and long-term financial short-term investments like capital expenditures, okay? So that's where we're going next. I want to talk briefly about the objectives of assignment 2, okay? This is going to be brief because the instructions are very similar to what we already discussed in assignment 1, okay? There's going to be some open questions and a numerical problem, okay? The goal of the open questions is to allow you to discuss some of the key ideas in your own words, so this is exactly as we discussed in the instruction for assignment 1, okay? The numerical problem of this assignment is something I want to talk a little bit more about, okay? In Module 2, we discussed this key trade-off that underlies how companies choose investments in working capital, okay? So the idea that investment in receivable is necessary to run the business, but it ties up cash, okay? And here what you have in this assignment is a numerical problem that allows us to develop a model of that. So we are going to try to develop a model, a numerical model of this idea, okay? Should a company speed up the collection of receivables or not, okay? The nice thing is that we are going to use the same example in Module 3 to develop the concept of net present value, okay? So assignment 2 is going to flow into Module 3, okay? And in terms of, the fact that we're going to use exactly the same example that we're going to start developing assignment 2 to think about the concept of net present value when we start Module 3, okay? So make sure that you work on this assignment 2 before you actually go to Module 3, otherwise you're going to have to go back and do the assignment anyway, okay? So in terms of the resources available, there is nothing really needed for this assignment other than the assignment questions. So everything is already in the file, nothing very complicated. And as in the other assignment, I will provide my own solution, but you should make sure that you work on the assignment before you prepare your solution, okay? Otherwise, the learning goals of the assignment are not going to be achieved. So this is the solution to assignment 2, okay? Question 1 is about a trade-off that a CFO faces when trying to decide whether to borrow today, right, or waiting to borrow in the future, the benefit of waiting to borrow in the future is that this is going to save some interest payments for the company, right? If you borrow today, you're going to have to start paying interest today, as we discussed in the lecture notes. However, there is an important point that borrowing today is going to protect the company from future risks, right? As we discussed in the note, in the lecture notes, companies can never be sure about what's the future situation of financial markets. The company's own financial situation may deteriorate. So there is this idea of precautionary borrowing, right? The idea of precautionary borrowing, which is that borrowing today and saving cash may be a way to protect the company from these financing risks. So these are the issues that you should have discussed in question 1, okay? This very important idea in assignment 2, which is why should we think of something like accounts receivable as an investment? The idea, of course, is that having accounts receivable helps the business, right? It increases demand for the company's product because consumers are going to appreciate having some time to pay for your good, okay? However, it ties up cash, right? If you increase accounts receivable, it's going to take longer for cash to come in the company, right? Therefore, increasing accounts receivable is exactly like an investment. The company is spending cash, right, today, right? You're foregoing cash inflows today in order to generate more cash tomorrow. So this is the key idea that you should have understood and you should have used it to answer question 2. Question 3 is about seasonality, right? So it's an example where the company needs short-term financing because of seasonality, and here the optimal solution, the natural solution, is to borrow in the beginning of the year and repay at the end of the year. As we discussed in the lecture notes, a bank credit line or a bank loan is going to be a very natural solution to a problem like that, okay? If the company has problems raising a bank loan, then you're going to have to think about other alternatives, such as increasing your cash holdings, right? Having higher cash is another solution. Of course, that is going to require the company to raise cash somewhere. So you're going to have to issue additional external financing or save some cash from operations. Finally, the third option is to change operations, right? So you might have to delay capital expenditures, cut some expenses, increase accounts payable, and things like that. Of course, companies should try to avoid changing operations if you can solve a seasonality problem with a simple financial transaction like a bank loan. Question 4 is about accounts payable, right? The liquidity risk that arises from accounts payable. Here is a specific example about a farm, right? And clearly, the liquidity risk that the farm suffers, that is exposed to, is that the suppliers may demand payment before they actually provide the necessary supplies for next year's harvest, right? If you think about it, in this case, right, the farmer will have to pay for last year's supplies, right, that you financed last year. On top of that, you're going to have to buy the supplies for next year ahead of time. So the farm, in that case, might face a liquidity shortage, right? That's exactly the notion of liquidity risk that we emphasized in Module 2, right? If the company has an open credit line with a bank, that's exactly the point at which it can use. If the farm has a credit line, right, what the farmer would do is to draw on the credit line, right, and today, right, to buy the supplies for next year, right, and then repay the credit line at the end of the year when the crop comes in. So that would be a natural solution. Notice, though, that this is not a long-term solution, right? When next year comes, the farm is going to have to refinance either the credit line or accounts payable, right? Otherwise, you're going to have the same problem in future years, okay? So really the right way for a financial manager to think about the situation is, try to solve the long-term, the short-term problem, but also think about the long-term, okay? And so you would have to think about, am I going to be able to refinance accounts payable? Should I refinance my credit line? And of course, the alternatives, as in question 3, are to inject more cash in the business, right? So it might be the case that the farmer is going to have to save some cash, right? Or maybe even change operations, okay? And then we go to question 5, which was the numerical question of this assignment. as we discussed in the instructions, this is very important for our course, for our class, because we are using this example in Module 3 to develop what is probably the most important concept in corporate finance, which is the notion of net present value. Okay? So the particular example that we're going to talk about is related to Module 2 because it's going to consider the trade-offs that companies face when determining the amount of accounts receivable that they have. Okay? And if you think about it, this is a choice variable for companies, right? What they can do, as we are going to show you in the numbers, is to try to speed up the collection of receivables, and of course that might generate effects on the business. So this is a very simplified example, but which I think gets at the fundamental trade-off of how companies determine accounts receivable. Okay? So that's the current situation, right? At the beginning of the year, the company collects 80%, and it's selling $1 billion a year, right? Since you only collect 800, then you're going to generate receivables equal to 200. So here you have on a table the cash flows, right? So you have an 800 million cash flow today, and then at the end of the year, you're going to collect the receivables that you generated today. Okay? The new system is identical, right? But with faster collection, right? And lower sales. Okay, so that's the trade-off. You're going to collect 90% now, so 882, which is 90% of 980, and generate 10% in receivables. But notice that the key thing here is that the sales went down. Why did the sales go down? Well, because consumers, like having time to pay. So that's the idea that investing that receivables is an investment, right? Having more receivables is going to increase your sales, right? So let's try to see if we can get at the trade-off. Before we do that, we have to figure out what happens at the end of at the second year, the beginning of the second year, or the end of the first year, right? So the company, in the old situation, you're again selling $1 billion, right? We assume that sales are constant, collecting 80% today, and generating new receivables. So have a look here at the table. That's what it looks like, right? So you collect 800 at the end of the year, generate receivables for the end of the following year, okay? But now notice that you have the $200 million in receivables that were generated today, right? Today, these receivables were generated and they are collected at the end of the year. So the difference is that the collection today is 800, but the collection at the end of the year is going to be $1 billion, right? So it's the 800 immediate sales plus the 200 million that you collect from receivables that you generated a year ago. Okay? Same thing for the new system with different numbers, right? In the new system, you collect 882 today, and when the end of the year comes, you generate new sales, which again give you 882, but you collect the receivables from the previous year. So the total sales is $980 million. Okay? The total sales and the total cash flow at the end of the year. Right? And then if we think about future years, then what you quickly figure out is that the same thing is going to keep on happening. Right? In the existing system, right, at the end of next year, you're going to generate an additional 800 million. Okay? And then you're going to collect the receivables that were generated in the previous year, right? So you're going to have a total cash flow of $1 billion, okay? In terms of the new system, what happens is that at the end of next year, you again generate $980 million in sales, get 90% of that, which is 882 today, and then collect the receivables that were generated last period, okay, which means that your total cash flow is $980 million. So what's the trade-off? The cool thing is, after doing all these calculations, now we can see the trade-off in numbers, okay? So, and you should have been able to see it as well as you're working in the assignment, right? So what's the trade-off? It's easy to see here. If you move to the new system, right, if you go from the top to the bottom, what will happen is that you're going to have higher cash flow today. The cost is that you're going to have lower cash flow, next year, at the end of the year, and then at the end of the following year as well. So future cash flows go down, right? This is very related to the fundamental notion of what determines accounts receivable, right? As we discussed, an investment in accounts receivable, it means that you are foregoing cash today in order to generate higher cash flow in the future. And I think now you can see this idea here with the numbers. Okay? So in words, that's what we have, right? That's the trade-off. And it's interesting now, I mean, we're not really ready to make a decision, okay? Because we haven't talked about net present value yet. It turns out that we have a tool in finance, in corporate finance, that allow us to calculate a number that is going to summarize the consequences of a decision like that for shareholder value. This number is net present value, and this is one of the main goals of Module 3, to develop, calculate, and apply the concept of net present value. How do companies create value for shareholders, right? That is a fundamental question. It's the question that drives a lot of corporate finance teaching, research, and real-world practice, right? There are two main sources of value creation. The first one is creating new products, right? If a company creates a product that people love, that people want to pay a high price for, right? That is going to generate profits, that is going to create shareholder value, okay? The other main way in which companies can create value is by buying other companies that have created valuable projects, right? So you either create it yourself or you find a way of buying other companies that have done it for you, okay? Unfortunately, a finance professor like me is not going to be able to tell you how to create something like an iPhone, okay? That's not what finance is about. We are not inventors. Maybe we wish we were, but we are not, okay? What we can do, what we know how to do, and what you will learn in this module is to figure out how a new investment is going to contribute to shareholder value. Okay? We have tools, we have techniques, we have formulas, we have calculations that we can use to try to figure out whether a new idea, whether a new investment, and also an acquisition is going to contribute to shareholder value or not. Are you increasing shareholder value by creating a new product, or are you destroying shareholder value? Okay? And in some cases, we may even be able to stop, a new product from being made. Okay? One of our roles is to, in some cases, figure out that an idea, no matter how cool it sounds, no matter how important it may be, is going to destroy shareholder value. And if a company is maximizing shareholder value, perhaps that product should not be made, that acquisition should not be made, this idea should not be developed. Okay? So that is what a finance professor can help with. In the next two modules, we're going to develop these techniques. Okay? To be able to estimate the contribution of a new project or a new acquisition to shareholder value. We're going to start on Module 3 by thinking about investment, okay? So we're going to be learning tools that are going to allow companies to make decisions about projects. And then on Module 4, we're going to talk about mergers and acquisitions, okay? So that is the game plan in terms of our next two modules, okay? For this module specifically, what you will learn is it's the first time we're going to talk about this essential concept in finance, which is the notion of net present value, okay? This is a very important idea, and we're going to spend a lot of time talking about NPV and to really make sure that you understand how to calculate and how to use NPV, okay? We're going to learn how to use NPV, and why NPV is equivalent to maximizing shareholder value, right? One thing we're going to learn is that NPV, if you use NPV to make investment decisions, you are essentially maximizing the company's stock price, okay? And then, of course, if you're taking a corporate finance course, you have to learn how to build NPV calculations, how to build cash flows, how to compute NPV, how to use NPV to make decisions. So we're going to learn this in this module, okay? We're also going to talk about the concept of internal rate of return. We're going to learn how to compute rates of return on projects, and then we're going to talk about the relationship between NPV and IRR, okay? It turns out that there are some cases in which you can compute a rate of return on a project, and there are some cases in which you should not compute the rate of return on a project, and you should be using only NPV to make investment decisions. So we're going to talk about that, okay? And then finally, we're going to incorporate a very important idea as well, which is the idea of real options, okay? Many investment decisions are going to come embedded with real options. Options to wait, options to abandon, options to change, options to expand, okay? And we're going to try to think about how to model these options and how to incorporate them into investment decisions, okay? It turns out that we're going to use this very useful tool called the decision tree to make this, to incorporate real options into valuations, okay? We're going to talk about a few specific examples. In particular, we're going to learn how to value R&D, okay? That is a very important part of the economy. It's of growing importance in economies around the world, and it turns out that to value R&D, you have to use real option techniques, okay? So we're going to discuss R&D valuation. In addition to that, we're going to discuss two additional options, which are the option to wait and the option to abandon a project. Again, what you're going to see is that we can incorporate this option into investment decisions by using decision trees. Let us start from exactly where we ended at Module 2, okay? So this is the problem that you are working with in the final assignment of Module 2. It's a problem that describes a situation that many real-world companies may face. The specific situation here is that the company has to decide whether to speed up the collection of accounts receivable or not, okay? So you have the data on annual sales. Currently, the company receives 80% immediately, okay, and 20% after 1 year. And the firm has the choice to move to 90% immediate collection. So you get 90% of the cash immediately, right? But then the cost is that if the firm does that, sales are going to go down by 2%. Okay, so that was the nature of the problem. And in the final assignment of Module 2, you worked with these numbers to derive these cash flows, the cash flows for both collection systems. So those are the values of cash flows that are coming in the firm in both cases. Okay, so in the existing system, you get 800 today, right? It's 80% of sales, and then you get the full amount next year and the year after, which is 1 billion. Okay, if you move to the new system, you're going to get 882 today, but the cost is that sales are going to go down, right? So your sales go down to 980, right? If you need to recap this calculation, please go to the final assignment of Module 2. You can find a video where I explain that. You can look up your work as well, okay? But this is the situation, right? And you can see in the numbers the trade-off that the firm faces, right? If you move into to quicker collection, you're going to get cash earlier, right? The amount of cash that you get today increases, okay? But your sales goes down, right? This is the fundamental trade-off that we talked about when we were talking about working capital investments like receivables and inventory, right? Increasing receivables is likely to increase sales because customers like, you know, they will appreciate having time to pay for the goods, but it costs the company in terms of time to receive cash. So it ties up cash. Cash takes longer to come in. Okay, so now we have these numbers. Our job is going to be to develop tools that are going to allow the company to really make a decision on whether they should change the collection system or not. Okay? To do that, we have to introduce this very important idea, which is the idea of incremental cash flows. Okay? The way that I like to think about incremental cash flows is extremely simple. Okay? It really is the idea of new minus old. Anytime a company has to make a decision on an investment, the relevant cash flows that we're going to consider are new minus old. So whatever the new system is minus the old system. The new product minus the old product, if there is one, okay? So these ideas you're going to see as we progress, it's a very, very general idea. So remember this concept, new minus old, okay? Let's apply it here to our receivables example, right? So you have the old system, the cash flows in the existing system, that's the old, okay? And then you have the cash flows in the new system, that's the new, right? So the idea of incremental is just to do new minus old, right? It's pretty simple here, right? So the incremental cash flows are going to be $82 million today, right? It's 882 minus 800. And then starting tomorrow, next year, and the year after, right? You're going to lose $20 million, right? So look at these numbers, think about them for a while, right? It seems, just by looking at these numbers, it seems that the new system looks quite attractive, right? You're getting $82 million and you're just losing 20 million, right? So it seems good. The problem, as we're going to see next, is that something is missing, okay? Remember what we've been talking about. We talked about this idea in Module 1, for example. Every time a company makes a decision, you have to think about all the consequences. It's not just today, it's not just current profits, it's not just current cash flows. You have to think about every consequence, every cash flow, right? To value a firm, for example, to find a stock price, you have to think about all the future cash flows. So really, what is missing here is the future, okay? Future cash flows. What is going to happen in the future, right? And if you think about this problem, if you look at your assignment solution, it's very easy to see that what will happen is that the same situation is going to repeat itself. Every year, the same situation is going to happen over and over again. In the existing system, right, what happens is you sell 1,000 or a billion here, right, collect 800 million immediately, and then you collect the receivables from last period, which are equal to 200 million, so your total collection is 1 billion every year. With the new system, you sell 980, collect 882 immediately, and then you collect the receivables from last period, okay, which are equal to 98, so you're going to get $980 million every year. And this is going to go on, right? The way we're going to write this down is as a timeline, okay? I like to think of this sequence of cash flows as a timeline. And let me go over here to show you something important, okay? Notice that here we have 3 dots, okay? These 3 dots here at the end, okay? What these 3 dots are going to mean in this timeline is that these cash flows are going to go on, into the future, okay? So these go on and on, okay? This is what these 3 dots mean, and then these 3 dots are going to show up in other problems as well, okay? When we write the timeline, we may not write today, next year, year after. A simpler way of writing this with numbers, you can represent today by writing a 0. Next year you write a 1. Year after you write 2. The year after you write 3. And then it goes on, okay? The advantage of doing this with numbers is that you can work with timelines even if the length of the period here is not a year, you can still work with timelines, right? So for example, if this is a month, if cash flows happen every month, you can still represent cash flows using a timeline, okay? Except that in that case, the length of the period is going to be 1 month. If you recall Module 2, when we worked on our inventory management problem, we already had a timeline. In that case, the timeline was represented in quarters, right? Because the problems there is that the company had to have the inventory in place a quarter before the goods were sold, okay? So this is the idea of a timeline. Every time we work with these corporate decision problems, we're going to try to calculate incremental cash flows and then express and then write them down in a timeline. Okay? So here's the timeline that we just talked about, okay? 0, 1, 2, 3, and then the little, the 3 dots, okay? And now we have the numbers, we have all the numbers here, right? You can see, you can express the trade-off we're thinking about in numbers. So if you speed up the collection payment, the collection of receivables, you're gonna get $82 million today, and then you're going to lose $20 million every year starting next year. Okay? So what should the company do? Just by looking at these numbers, now it's not obvious, right? You know, now it's not obvious because this $20 million is going to go on and on, you know. So is that good or bad for the company, right? Is that going to be better? Is it better to receive the $82 million today and then lose $20 million every year? Or is it better not to do anything and keep the old collection system? To answer this question, we're going to have to develop the concept of net present value. The reason I love this example is that it really shows you why we need to think about net present value to answer questions about corporate decisions. Okay, we are missing this concept. That's where we're going next. We're going to develop the concept of net present value, and then we're going to use the concept of net present value to answer this question. Should the company do it or not? So now let's develop the concept of net present value. Okay? This is a fundamental concept in corporate finance because that's what's going to allow us to make decisions about projects, about collection systems, about acquisitions, and pretty much everything else we're going to talk about in this course. Okay? What is the net present value? The net present value is the sum of all the incremental cash flows. Remember, right? We already defined incremental cash flows, new minus old. Okay? All the incremental cash flows discounted from the future to the current period. Okay? The important thing here is that to get your NPV right, you have to take all the incremental cash flows into account. Everything, right? You take all the consequences, any decision you're thinking about, you have to model all the consequences of taking that decision and then discount to the current period. That is NPV. Okay? Notice that there is the word discounting here. Okay, so we have to discount. Okay, and so we are going to need to use a couple formulas. Okay, that I'm pretty sure you've seen those already at some point. If you didn't, it really is very easy to learn and to apply these formulas. Okay, all you need really are these two formulas: the computer and a calculator. And in some cases, pencil and paper really works. It might be even the best way to solve the problem. Okay? So these are the two formulas that we need. Okay? So R, there is this term R, which is the discount rate. Okay? So that's the rate that we're going to use to discount the cash flows. So here you have a situation where you have a cash flow T that is happening T periods ahead. Remember, this is a timeline. So T here could be anything. Okay? T here could be anything. It could be a year, it could be a month, whatever you want. Okay? And to discount that cash flow, what you do is you divide it by 1 plus R to the power T. Okay? So if the cash flow happens 2 periods ahead, you do 1 plus R to the power 2. Okay? Very simple stuff. I hope. Right? This is a little bit more complicated, but it's very important that we learn that. Okay, we cannot do corporate finance without a growing perpetuity formula. Okay, this is what it is. Now we have a cash flow that happens every period. Okay, so here there is a cash flow C in period 1. There is a cash flow C1, another cash flow in period 2, and notice that now the cash flow is going to grow at a certain rate. Okay, G here is the growth rate of cash flows. Right? So if you look at this, right, if G is 5%, then the cash flow in period 2, remember it's not necessarily a year, right? The period 2 is going to be 5% larger than the cash flow in period 1. If you go to period 3, again you're growing cash flows at 5%. Okay? If you have this pattern, which as we're going to see is going to be a very common pattern, okay? If you have this pattern, the present value is just going to be C, the cash flow, divided by R minus G. Okay? So I know this is math, it's a formula, many people get scared with math, but it really is very simple, okay? All you need to do is to remember these two formulas, or even look them up if you forgot, and apply them to solve some different problems, and you're going to get this very quickly, I think, okay? All calculations can be done with these two formulas, all of them. So I like to really narrow down and just tell you about those two formulas because they are sufficient. Okay? To allow you to practice this, I wanted to try to answer these two questions on your own. Okay? So very simple present value problems. So first one, we have $1 million in 1 year. The discount rate is 6% a year. The second one is a perpetuity. Okay? So it's a payment of $1 million every year that's going to last forever, and the discount rate is 6%. Okay? So please work on these two questions. Answer should be really simple, right? The first problem, all you need to do is to discount the cash flow of 1 million by 6%. So you divide 1 million by 1 plus 6%, okay? And then you should get a present value of 943,396, okay? If you're dealing with a stream of payments, right? $1 million every year lasting forever, then you have to use the perpetuity formula. Like I said, that's going to come over and over again. Okay? Perpetuity formula. Now we have the discount rate is 6%. What is the growth rate? The growth rate in this case is 0, right? Because the payment is not growing. So all you have to do is to divide 1 million by 6%. Okay? And you should get a present value of 16,660. This is one of those numbers that are annoying, right? Yeah, you get a 6 forever, right? So it's 16,666,000. Okay, it's a tongue twister, right? Okay, so it's really, really very easy to use these formulas. Okay, let's go back to the accounts receivable example. Remember, we have the incremental cash flows, right? $82 million today. And then a loss, a negative cash flow of minus 20 million every year, starting next year. And now the time period here is years, right? So we're expressing this in years, okay? This is the trade-off that we already derived, right? Now we have to think about, how many years into the future are we going to consider? Okay, are we going to consider 10, 20 years? What's the timeline? What you're going to see, and once you think about this, it might sound like a not very natural idea, but for most corporate finance problems, like acquisitions, valuation, project analysis, we have to end up considering an infinite horizon, okay? This sounds strange, so I really want to talk about this now, but the issue is that there is no natural date for a company to end, okay? Right? So suppose that we're thinking about a company and we think that in the future the company is going to be sold to another buyer. That's an example you might think about. Okay? So if you're going to value this company today, what you need to do is you need to think about what's the sale price, right? The sale price, if it's not 0, right, is going to be part of the value, right? And now what? The sale price, how are we going to determine that sale price? Again, it's the same idea, net present value, right? The sale price is going to depend on the future cash flows after the sale that are going to go to the buyer, okay? So it doesn't stop. Even if you sell the company, it doesn't stop. The cash flows are always going to go on, okay? So really, this is the infinite, the sign, the mathematical sign for infinity, which is something that is going to show up in corporate finance over and over again, okay? There's no way to get around that, okay? And you might be thinking, okay, yeah, infinity, right? No one lives forever, right? And a cash flow that happens, let's say 1,000 years in the future shouldn't matter. And this intuition is right, okay? And it is actually taken into account in our formula, okay? This is what the present value formula is doing for us. Think about this, okay? I mean, you don't have to do this calculation. I've done it here for you. But if you want to check it, do it so you believe me, okay? suppose you're going to get, $1 billion sounds a lot, right? If I had $1 billion, I would be a billionaire, right? Of course, okay? But today, okay, what if I get $1 billion in 1,000 years? How much is that worth? Okay, do the math, right? You can discount $1 billion by 1 plus 6% to the 1,000th power. Okay, guess what? What answer you get? Here's the number. There are I can't even count the number of zeros. Okay, really, the answer, let me just go here to emphasize this. The answer is 0. Okay, $1 billion in 1,000 years is worth nothing. Okay, unless the discount rate is 0, which it's not. As we're going to see in corporate finance, discount rates are not going to be 0. Okay, so yeah, 1,000 years ahead, it's really not going to affect our calculations, but this is taken into account. Okay, all you have to do is to use the present value formula. Okay, and you're going to get that. Okay, so let's solve this problem, right? So finally, right, we've been working on this for a long time, but like I said, I really like this because it really builds, every concept builds on another concept, and now we can finally get a solution. Okay, suppose that the companies, we're going to need a discount rate, right? We just learned we have to discount. Okay, we're going to need a discount rate. Let's say it's 10%. Okay, in this module, we're really not going to talk about where discount rates come from. That's something we're going to talk about in module 4. Okay? So if the discount rate is 10%, what is the NPV of the new system? Right? Let's go back here, okay, and do this. Right? So what is NPV? You have to take all cash flows into account and discount them. Right? The $82 million comes today. Right? Do we have to discount it? No. Okay? And then what we have these infinite cash flows, right, of 20 million. It goes on forever. So all you need to do is to apply the perpetuity formula. It's a magic formula. All you need to do is to divide 20 by 10%, okay? And, if you're not mathematically inclined, you might need a calculator to do this, but you'll find that the answer is 200, right? Actually, it's 82 here, not 80, okay? So the present value of a $20 million stream of payment happening every year is 200 if the discount rate is 10%, okay? So this means that the NPV is minus 118, okay? The NPV is minus 118. So now we have the number. That is the net present value of this particular decision. Okay? So before we talk about what are we going to do with the NPV, let's talk a little bit about Excel. Okay? So I want to show you how to compute net present values in Excel and do a little exercise for you to talk about the perpetuity formula. Okay? So we could set the horizon to 30 years. For instead of if you had never seen the perpetuity formula, one way you might want to solve this problem is by setting a horizon to a large number of years. So here very boring to write this down, but I wrote all the 30 years here. Okay? To compute the NPV in Excel, all you need to do is to use this Excel function. Okay, there is an Excel function in Excel that is literally called NPV. Okay, so the NPV function, you write the discount rate, in this case is 10% as the first point, and then all you do here is you refer to the cells, cell 1 to cell 30. Okay, and then you should be able to compute NPV in Excel. The problem is that what I end up getting is that answer here. Okay. Yeah, instead of getting minus 118, I just get a blank. Okay, so what's going on, right? Actually, the reason why Excel does that is because the amount of numbers, right, that Excel reports is too large. That's what Excel is reporting, minus 10,653%. I mean, it seems to make no sense, right? So here's a little letter to Microsoft. NPV is not a percentage, okay? The problem is in some versions of Excel, the NPV function is programmed to give you an answer in a percentage. Come on, that's not, it's the wrong answer, okay? It's a currency. It's either a number or a currency, please, okay? And, you know, by the way, we do not need 12 decimal points, okay? Anyway, so you may need to reformat the answer, okay? I have here, I showed you, I'm just showing you a tab from Excel. You can figure this out on your own, I'm sure, but here is the formatting. And then what happens is you're going to get an answer of minus 106.54, okay? Our answer, of course, is minus 118, right? What's going on, okay? So what's going on is that we consider 30 years, right? We are considering 30 years. We are not considering the entire future. 30 years is not that far. If somebody tells you you're going to get 20 million in 30 years, you know, you're going to be happy. You know, that matters. That has value, right? 20 millions in 30 years is a lot, okay? So, you know, what you need to do if you really want to get an answer that is closer to the perpetuity value is to increase the horizon, okay? If you have the patience to do this, I recommend you do it once, okay? So do it with 50 years. You're going to get minus 116.3. Do it with 100 years. You're going to get 117.99, which is mathematically it's the same. You know, it's really very close to minus 118. Okay? So a cash flow of $20 million in 100 years is worth nothing, or very close to nothing. Okay? So if somebody tells you you're going to get $20 million in 100 years, you should really think about whether this is a lot of money or not. Probably not. Okay, the pattern, of course, is the more years we put in the formula, in the calculation, in Excel, the closer we're going to get to the perpetuity formula.
Hi there. I received many questions about how to calculate NPV in Excel, and I realized that several of the students are having trouble with this calculation. It's actually very simple, but there is a specific procedure that you have to follow to get the right NPV. So what I'm doing here is I'm showing how to calculate the NPV using one of the examples that we used in Module 3, and we're also using in Module 4. It's the example that we used to do sensitivity analysis in Module 4, and we first introduced this example on slide 63 of Module 3. Okay, so here you have the Excel spreadsheet. I have already calculated the cash flows for you. So you have a cash flow of minus 40,000 in date 0, and then you have the positive cash flows later on. Okay, so here I'm going to show you how to calculate the NPV. The key thing is, so you can see what I'm doing here, the key thing is that the first cash flow that you put in the NPV formula is the cash flow at date 1. Okay, so you go from date 1 until the end. Okay, and of course you also have to add the discount rate. Okay, so you do NPV of the discount rate. Okay, and then the cash flows from date 1 to date 10. Okay, and then what you need to do is you need to add the date 0 cash flow separately. Okay, you cannot have the date 0 cash flow inside the NPV formula. I'll show you why in a second. So if you do this, you'll see that you will get the right NPV. Okay, which in the slides it's $13,153. Okay, so here's the problem. If you don't, so this is the right way of doing it. But what many students are doing is to include the first cash flow in the NPV formula. So the date 0, including the date 0 cash flow as well. Okay, and then you see that you're not going to get the same answer, right? So look at this. It's you have, in this case now, you have all the cash flows, right? And the discount rate, and you get a lower NPV. What's going on? The problem is that Excel assumes that the first cash flow happens 1 year from now. So Excel is discounting all the cash flows, including the cash flow at date 0. But since the cash flow at date 0 happens today, it should not be discounted. Okay? So that's why you need, to compute the right NPV, you have to start from date 1 and then add the date 0 cash flow separately. Okay? If you do that, you will get the right NPV. With the IRR, it really doesn't matter because Excel is in fact assuming that, so to do the IRR, let me show you, you just put all the cash flows in the IRR formula, okay? And you get the right answer, which is 15.25%. Excel is actually assuming that the first cash flow happens 1 year from now, but the thing is that the IRR actually does not depend on when the cash flows start, okay? So even if cash flow at date 0 is actually at date 1. If you move all cash flows 1 year from now, so if you have 1, 2, 3, 4, 5, 6, 7 instead of 0, 1, 2, 3, 4, 5, right? You would still get the same IRR. The IRR does not depend on when the project starts. Okay, so that's why to calculate the IRR, you actually have to include all the cash flows in the formula. Okay. So I hope this clarifies this point. Since I was getting several questions on the discussion board, I decided to record this short video. Please let me know if you still have questions, but I think this calculation, this example here is going to be useful for you. Thank you.
Okay, we got an NPV of minus 118, right? That's what we just did. We did all those calculations and we figured out the net present value is minus $118 million, okay? What are we going to do with that? That's very important. Now we have to think about what does net present value mean, okay? How are we going to use net present value to make decisions? In order to understand this is really a fundamental point in corporate finance. Let's think about the relationship between NPV and shareholder value, right? If you go back to Module 1, we talked about the stock price, right, which is the measure of shareholder value that we focus on in corporate finance. The stock price is just the sum of all the future cash profits discounted to the current period, right? So you take all future profits into account, discount to the current period. That is how we figured out the stock price, as we talked about in Module 1. Now think about NPV. NPV is the sum of all cash flows that are a direct consequence of making a decision or taking a decision, right? Discounted to the current period. So we are taking all cash flows into account, discounting to the current period, right? Think about this. These two definitions are the same. They are virtually the same. There is no difference. Mathematically, they are the same, okay? Conceptually, they are the same, right? So really what this means is that NPV and stock prices are equivalent, right? So let's think about that, okay? Let's take this idea, okay, and consider the following question, right? And I think you should be able to answer this even before I do it, okay? So we figured out here that if the discount rate is 10%, the NPV is minus 118 million, okay? So ask yourself the following question. Suppose the company decides to change the system, okay? So you want to change the system, you're going to change the system, you change the system, okay? What is going to happen to shareholder wealth if the company does that? Okay, and then let's try to think about, what should the company do given this? The answer is very simple, right? Since NPV and shareholder wealth are the same concept, since they are mathematically equivalent, what will happen is that shareholder wealth is going to go down by exactly $118 million, okay? If the company makes that decision, then they're going to destroy shareholder value, right? Shareholders are going to lose $118 million. So what should the company do? Obviously, keep the old system, okay? 0 is better than minus 118, so just do what you're doing right now, okay? No change. No change is the right answer in this case, Okay? So finally, we know what to do. After many, many slides and assignments, we got an answer to this problem. Okay? And I think it really illustrates all the concepts that you have to remember very well. Okay? So this is the result. We call this the equivalence result in corporate finance because it is a fundamental notion in corporate finance, which is the notion that maximizing net present value is equivalent to maximizing shareholder wealth. Okay? So if you want to make decisions that increase shareholder wealth, what you do is you take all investments that have positive net present value, right? As long as an investment has positive net present value greater than 0, it's going to increase shareholder wealth. Okay? So that is the equivalence result. And as with many things in corporate finance, this result does not, always hold exactly, right? In the real world, the equivalence between net present value and corporate and stock price is not going to be perfect, right? For example, the stock market is computing the stock price. The stock market may not have all the information that is required to compute net present value, right? Maybe the project is a secret project. So the market is going to learn about it slowly, right? Managers may have more information than the market, right? Of course, the result, just as in Module 1, we talked about the fact that maximizing a stock price relies on market efficiency. Here we have the same concept, okay? If markets are inefficient, then all hell breaks loose. The stock price may no longer reflect future cash flows, and then, of course, NPV and stock price are not going to be the same thing. So we are relying on the assumption that markets are reasonably efficient to do this calculation, okay? And finally, this is something that we are not going to cover as much in this course. We did talk about leverage, right? We talked about how to measure leverage for real-world companies in Module 1, right? So when leverage gets very high, there could be problems as well. What happens is that the decisions that maximize firm value may not be the same decisions that maximize the stock price, because many of the proceeds may end up going to debt holders. Okay, so this sounds a little bit complicated, it is actually, and it's something that we're not going to talk about in this course, but I just wanted to highlight that leverage may also matter. If you want to learn more about this, you may consider taking the additional corporate finance course that we're going to provide. Okay, so this result that NPV and shareholder wealth are equivalent relies on these assumptions, but even if they don't hold exactly, it's still a very useful guideline for financial management. Okay? Similar to what we discussed in Module 1, there are no good alternatives to net present value, right? So even if markets are not perfectly efficient, for example, computing net present value is still a very important step to make sure that managers make the correct financial decisions. We just talked about net present value, which is the concept, the calculation we're going to use to make corporate decisions, right? The net present value is a number. In our example, in our accounts receivable example, we computed $118 million, right? And we also talked about the fact that there is a direct equivalence between net present value and shareholder wealth. So shareholder wealth would go down by $118 million if the management decided to speed up the collection of accounts receivable. Okay? The problem is that when we think about investments, we like to think of investment returns in percentages. So when we think of the stock market return, we're not measuring that in dollars usually, we're measuring it in percentage. What's the return on your portfolio? What's the return on PepsiCo stock? We're always thinking of percentages. Okay? So that's why we need this additional concept, which is the rate of return on an investment. It's very important for us to be able to compute the rate of return on any investment that we are given. Okay? And the idea is that that's going to give you a percentage measure of how much you're getting out of that investment. Okay? And here is the definition. And I know that the first time people see this definition, it sounds a little bit confusing. Okay? The rate of return of any investment can be defined as the discount rate that makes the net present value of the investment equal to 0. Okay? That is the most general definition of a rate of return that we can come up with. Okay? And by the way, we have this alternative name, just like NPV. We have this alternative name for the rate of return, which is the IRR. Okay? That stands for internal rate of return. Okay? So let us see why. Let us try to understand why the rate of return is the discount rate that sets the NPV to 0. Okay? So let me give you an example. Very simple one. And my experience teaching this is that most people that have done some math, basic algebra, can figure this out. Okay? So suppose that you have an investment that requires $10,000 today, okay, and that's going to pay back $11,000 in a year's time. Okay? And ask yourself, what is the rate of return on this investment? Okay? Let me go over here. Okay? So you invest $10,000 today. Let's do this in a timeline. Okay? That we're going to use later, and then you get 11 a year from now. It should be obvious to most people that the rate of return is 10%. Okay? So I'm pretty sure that the moment I gave you this problem, you said, yeah, the answer is 10%. What kind of problem is that? Right? Too easy. Okay? But I want to use that problem to show you that this concept works. Okay? So think about, let's go inside your brain. Okay? So this is fun. We're actually going to try to think about what is the equation that you're solving in your brain when you got that 10%. Okay? And I'm pretty sure that this is the equation you're solving, the first one here. Okay? What you did is you deducted 10 from 11, right? So I'm making $1,000. And then you divided 1,000 by 10,000. Okay? So that's how you got the return of 10%. Okay? So if you've done basic algebra, you can try to manipulate this equation a little bit. Just change the numbers around. Okay? So our equation, what you can do here is you can divide the 10,000 by 10,000. So you'd have 11,000 divided by 10,000 minus 1. Okay, we know that that's equal to 10%, right? And then you can start rewriting this, right? So you can send the 1 to the other side, right? You get 1 plus 10%. And now you can divide everything. First, actually, you send the 10,000 to the other side, multiplying the 1 plus 10%. And then you divide the 11,000 by 1 plus 10%. Okay? So this can be written as follows, right? If you deduct 10,000 from the right-hand side here, this can be written as 0 is equal to 11,000 divided by 1 plus 10% minus 10,000, right? So think about this. We did the timeline, right? So you have 10,000, 11,000, okay? So this term here that we just derived, okay? Let me highlight this. This term here that we just derived is nothing more than the net present value of an investment that pays off 11,000 in a year and requires an investment of 10,000, right? When the discount rate is 10%, we are discounting by 10%, highlighted here for you, okay? What is this NPV? The NPV is equal to 0, okay? So the equation you're solving in your brain is mathematically equivalent to writing down the NPV and setting the NPV to 0. Finding the discount rate that sets the NPV to 0. Okay? If you don't believe me, we can do it in another way, right? Write down the NPV of that problem. It's very simple, right? We learned NPV already. So the NPV is minus 10,000 plus 11 divided by 1 plus the discount rate. And then do step number 2. Find the discount rate that makes the NPV equal to 0. So set this equation to 0. You will see, it's very easy to see that the value that you have to plug in here to set the NPV to 0 is 10%. Okay? So if the discount rate is equal to 10%, the NPV is going to be exactly equal to 0. Okay? So that is why we can use, this is why the definition of rate of return is the discount rate that sets the NPV to 0. Okay? Of course, you could have solved this problem in another way, right? If you had, you could have used Excel, for example, right? Excel also has an IRR function, right? And this one actually works fine, as opposed to the NPV function that we just talked about. Yeah, all you have to do is to input the cells, okay? So it's the IRR of cell 1 and cell 2, right? And then Excel will tell you that the IRR is 10%. Okay? Of course, for this problem, you probably don't need Excel. For another problem, you may want to use Excel, so I wanted to talk about this as well. Okay? Let us now see if we can apply what we just learned. Okay? Let me give you this problem to work on. We have an investment that requires $10,000 today, and now it produces a cash flow in perpetuity. So the cash flow is expected to grow at 4% a year. And the question I have for you is, what is the rate of return of this investment? So every time we solve a problem like this, what I want you to try to do is to use what we learned. Set the NPV to 0. Okay? This turns out to be a very powerful idea that helps us solve many problems in finance. Okay? So what is the NPV, right? We learned the growing perpetuity formula, right? It's minus 10,000 the investment today, and then the present value of the cash flow is going to be 500 divided by the discount rate minus 4%, right? And I didn't give you the discount rate, right? You might be able to, whoa, but how am I going to solve this problem? What is the discount rate? Remember, that's not what we are trying to do here. In this problem, what we're looking for is the rate of return. We're looking for the IRR, okay? And step number 2 here is the definition of the IRR, right? What the IRR is the discount rate that makes the NPV equal to 0, okay? The discount rate that makes the NPV equal to 0, and if you solve this equation mathematically, what you're going to see is that the IRR is 9%, right? If you put 9% here, you're going to get 500 divided by 5%, which is going to be equal to 10,000, okay? So you get an IRR of 9%. So this is really cool, right? I gave you these cash flows. It was probably not obvious what the rate of return is, but I can tell you with certainty that the IRR, the rate of return on this investment, is 9%, okay? Let us try to use Excel in this case, okay? And here you're going to see that there's going to be a problem, right? You can do it, but it's going to take a lot of boring work, okay? Let me show you this. Suppose we were doing this with 30 years, right? So we have an investment of 10,000, and then we have the cash flows. 500 in year 1, 520 in year 2, and it's growing, right? The cash flow continues to grow. When you get to year 30, the cash flow is 1,559. Okay, I just did this manually. And then you can ask Excel, compute the IRR for me. Excel will tell you in this case that the IRR is just 6.665%. Okay? The problem is that here we have growth. The cash flow is growing. Okay, so even if you do it for 30 years, the value is still too high. This is still, 1,559. It still matters, right? So the rate of return of this investment really is higher because this cash flow is going to continue to grow, right? So if you just ask Excel to do it for 30 years, you'd get an answer that is a considerable underestimate of the true rate of return on the investment. Okay? So in this case, you actually do have to use, the little trick that we learned, right? Instead of using Excel, you have to, write down the NPV and then set the NPV equal to 0. just learned the concept of IRR, the rate of return of an investment, right? Now we know how to calculate it, and we just did it for this specific example, the investment that requires $10,000 today and then produces a yearly cash flow of $500 in perpetuity, okay? So with a growth rate of 4%. In that case, we calculated an IRR of 9, right? 9%. The question now is, should we invest in this project or not, right? We know it has a rate of return of 9%. How do we know if we should make this investment or not, right? The answer is that you don't have enough information, okay? To figure out whether a project is good or not, we're also going to need a discount rate, right? When we computed net present value, for example, we needed the discount rate to discount the cash flows, right? And so now we also, to make a decision using IRR, we are also going to need a discount rate, okay? And an idea that it really is very intuitive, it should make sense to you, is that in our case, we would invest in the project if the discount rate turns out to be lower than 9%, right? So you should think of the discount rate as the required return on a project, right? The discount rate is the minimum return that the project would need to have for the project to be a good project. On the other hand, the IRR is the actual return on the project, okay? So if the IRR is bigger than the required return, right? If the IRR is bigger than the discount rate, that means this is a good project, okay? We think of this as the IRR rule. The IRR rule says that you invest in a project if the rate of return is greater than the discount rate, okay? That's what we think of as the IRR rule. Let's do an example here, okay? So let's go back to our simple investment, right, which has an IRR of 9%. And now let's assume that the discount rate is 8%, okay? Let me actually go over here. The discount rate is 8%, okay? So the IRR is 9, the discount rate is 8, okay? So that means this is a good project. Okay? That means this is a good project, right? The IRR is bigger than the discount rate. Ask yourself, what should be the net present value then, right? We just learned about NPV, okay? And we learned that when a project is good, the NPV should be positive, right? So in this case, right, we know, even though we didn't compute NPV yet, we know that the NPV should be positive, right? Consider now a different case where the discount rate now is 10%, okay? So now let's have a discount rate of 10%, right? You should be able to do this very easily, right? Since the IRR is lower than the discount rate, right? What should you do? You should not invest in that project, right? So the answer is that this is a bad project, okay? This is a bad project because the discount rate is bigger than the IRR. What should be the NPV? The NPV should be negative in this case, okay? If we want to check that, of course, what we could do is just to go ahead and compute the NPV, right? Which is what I've done here, okay? And you know, I recommend that you go out and really try to do this calculation on your own. Compute the NPV, okay? And you will find out that if the discount rate is 8%, the NPV is 2,500, okay? If the discount rate is 10%, the NPV is minus 1,667, okay? So this shows that, you know, if the discount rate is 8, the NPV is positive. If the discount rate is 10, the NPV is negative. So here comes a question for you, right? There is a very important lesson here. There is a pattern, okay? There is a general result that lies, you know, hidden in these numbers here. Not that hidden, but I wanted to think about this question and try to generalize. You know, what did we learn, okay, by doing this calculation? This is what we learned, okay? Another very important set of rules, okay? If the NPV is positive, right? So if a project is good, if it increases shareholder value, if the NPV is positive, these are all the same thing as we just learned, then the IRR should be bigger than the discount rate. These statements are equivalent. Okay? Positive NPV, IRR bigger than the discount rate, good project, project that increases shareholder value, all of these are equivalent. Same thing for a negative NPV, right? If the name NPV is negative, then what this means is that the IRR is lower than the discount rate. Okay? And this result is great because what this means is that you can use either NPV or IRR, right? So if you compute IRR of a project and you know the discount rate, you're going to get it right. You're going to make the right decision. So maybe we don't even need to compute NPV. We can just compute IRR and compare the IRR with the discount rate. Okay? As we're going to talk next, as we're going to learn next, you know, this is actually not true. There are some cases where we're going to have problems to compute an IRR. But that's our next lesson. We just learned that IRR and NPV can be equivalent, right? You make the same decision using either IRR or NPV, okay? But before we start moving too fast and say, yeah, we don't need NPV, we can just compute IRR, we have to talk about a few problems with IRR, okay? There are some issues that you have to know about that actually limit your ability to use IRR to evaluate projects, okay? The first notion is that there are some investments that are not going to have a well-defined rate of return. Okay? Sounds a bit strange, but consider this example. Suppose we have this timeline, right? And we already learned about timelines. Okay? So we have an investment that requires a $20 million, an investment that gives you $20 million today, right? So this is like the accounts receivable problem. You get $20 million today, and then you have to pay $22 million tomorrow. Okay, so you lose $2 million, right? You know, using the same intuition that we used when we first talked about IRR, it sounds like the rate of return on this project should be minus 10%, right? You're losing 10%. Okay? But try to use Excel. Write down this problem in Excel. I mean it, you know, really do it. If you have Excel, try this, okay? Write down the timeline in Excel, okay? And then write down 20 minus 22 and ask Excel to give you the IRR. Excel will tell you the IRR is 10%. Okay? And now, this is not Microsoft's problem, okay? This really is a mathematical problem, you know. What Excel is doing those two steps that I told you about. Compute the NPV and then set the NPV to 0 by trial and error. Computers can do trial and error algorithms very quickly, right? So Excel is just trying a bunch of possible discount rates, and it turns out that if you discount minus 22 by 10%, you're going to get minus 20. So 20 minus 20 is 0, the NPV is 0. Okay, the IRR is 10%. Excel gets a solution. The problem, though, is we know the solution is wrong. This is this investment is this is an investment that is losing money, right? You're not making 10%, you're losing 10%. Something is wrong, okay? Right? And here you might think, okay, yeah, I'm clever, I can figure this out. If I have an investment like that, all I need to do is to reverse the sign. I do this in Excel. Instead of getting positive 10, I take minus 10. That's the rate of return, okay? That could be. The problem is that it gets more complicated, okay? Suppose you have this case, okay? Again, another timeline, minus 4, 25, minus 25, okay? So you get, you invest minus 4 today, then you get a payoff of 25, let's say, $1 million tomorrow in a year. And then you get, but then you have to pay again. You have to pay minus 25 million in 2 periods. Okay, let's try to use Excel. Excel, so write down the cash flows, use the IRR function, okay? Excel will tell you that the IRR is 25%, okay? With the answer here. Is that reasonable? I mean, who knows? I mean, now it doesn't sound crazy, okay? That you have a 25% rate of return here, right? The 25 million payoff comes before the minus 25, maybe, okay? But this is the problem. Write down this equation, okay? If you have the time, the patience to do that, just write it down in a calculator or in just do this calculation, minus 4 plus 25 divided by 1 plus 400%, minus 25 divided by 1 plus 400% to the second power, okay? So what this is, let me actually write this down here for you, right? This is the NPV of the investment, okay? This is the NPV of this cash flow, of these cash flows, okay? The NPV is equal to 0, okay? If the discount rate is 400%, right? What does this mean? Is 400% also an IRR? Okay, so do we have two possible IRRs? That doesn't make any sense, right? An investment should have one rate of return, not two rates of return, okay? So there is something wrong with this problem as well. The other thing you can do, by the way, just do it in Excel if you don't want to do this equation. Write down the NPV in Excel to convince yourself that if the discount rate is 400%, you should also get a 0 NPV, okay? There is a problem. Think about the following thing. What is the common feature of these two examples, okay? The common feature is that you have a negative cash flow that is coming after a positive one, okay? You have positive and then negative. So 20 minus 22, 25 minus 25. Here's my advice, okay? If you see this pattern, positive, negative, do not use IRR, okay? It is tricky, it is complicated, and it might lead you to make the wrong decision, okay? So if there is positive and then negative, unfortunately, you should not use IRR, okay? That is the lesson, and there is really no reliable mathematical way to solve this problem, okay? The second problem that you have to know is an issue of magnitude, okay? So the NPV, as we talked about, is in the same unit as cash flow. So if the cash flow is in dollars, the NPV will be in dollars. The cash flow is in pounds, the NPV is going to be in pounds, okay? The higher the NPV, the greater the impact of a project on value. That's, that concept we learned when we were talking about NPV, okay? The IRR, on the other hand, is a percentage return. If you recall our lesson, that is the reason why we're using IRR, right? Is because we want to measure investments in percentage, but this can create problems, okay? Think about the following. Suppose we have two investments. We have an investment that requires 1 cent today and pays off 2 cents next year, okay? So you make 1 cent in a year, investing 1 cent today. And then you have an investment that requires $100 today and pays off $200 next year, okay? If you compute the rates of return of these two investments, you're going to find what? You're going to find 100% for both, okay? The first investment, you invest 1, get 2, right? The second one, you invest 100, get 200, It's in a different unit, right? The first one you invest in cents, the other one you're investing in dollars. So investment 2 requires a bigger investment. It gives you a bigger payoff. Both have the same rate of return, okay? But try to answer the following question. So now comes a question for you, based on this simple example. Suppose the discount rate is 10%, okay? Which investments would you take, okay? And then think about which one is the better investment and which investment has the greater NPV. So you can either calculate NPV, but I think it will actually be obvious which investment has the greater NPV, okay? But you can do the calculation if you want. So let's do the answers here, okay? Which investment would you take? Remember the rule. We take all investments that create shareholder value, right? So we would actually take both, okay? Investment 1, something, 1 cent we don't care about, right? But it is a good investment. It is creating value. So you would actually take both, right? That's what we should do. But obviously, investment 2 is the better one, right? You're making $100 instead of 1 cent, right? So it is obviously the better investment to take, okay? Which investment has the greater NPV? Investment 2, right? You can do the calculation if you want, but it's obvious that investment 2 is going to have the higher NPV, okay? So think about that. The IRR is telling you correctly that both investments are good, but the IRR cannot tell you which investment is better, okay? The IRR will tell you that both investments have the same rate of return, right? Whereas if we use NPV, we'll be able to figure out that investment 2 is going to create more shareholder value, okay? So this is the other problem, and there are really only 3 rules to remember, okay? The bottom line of all of this discussion we are having about IRR and NPV is that there are 3 rules that you have to remember, okay? The first one is that IRR and NPV are going to lead to identical decisions in most cases. So if the IRR is bigger than the discount rate, the NPV is going to be positive, okay? That is a really important idea, and you should remember that, okay? However, there are the qualifications, right? There are cases where you should not try to compute an IRR, okay? If you see a negative cash flow coming up after a positive one, don't compute IRR. For example, recall that we worked on our accounts receivable problem, but I never computed an IRR in that problem. We solved that problem only by using NPV, okay? Right? Why? Because that was a case where the positive cash flow came first, and then the negative cash flows came later, okay? So don't compute IRR in that case. And third rule, which is simple, beware of magnitudes, okay? So you cannot reliably use IRR to compare investments of different sizes. So our cents versus dollars example showed that very, very clearly, okay? So if you want to compare investments, the safest way to do it is to use net present value. In order to master net present value and IRR calculations, you're going to need to practice them, okay? There is no other way, right? If you want to master anything like playing guitar, for example, okay, or computing IRR, the only way to do it is to do exercise after exercise, okay? So make sure you work your way through all the quizzes, the practice quizzes, and then the final quiz. Do a lot of problems, okay? There's going to be an assignment as well that you can use to practice through, try your hand at doing these calculations, okay? That really is the only way to master this, okay? What I want to do is go through a few examples with you, though, okay? So I want to go through 3 examples here to illustrate a few additional issues that we have to be aware when computing NPV and IRR, okay? The first one here is a project analysis. So we have a project that, it's a more realistic example of a project where you have an initial investment, and then the project is going to add both revenues and costs to the company, okay? So you have added revenue and added expenses. So obviously, this is a profitable project. It's adding a profit of $9,000 per year. Let's say this is measured in thousands, okay? You have some depreciation, right? Depreciation is naturally going to come from the initial investment, right? The investment has to be depreciated, okay? We're going to consider a planning horizon of 10 years, okay? And as we discussed already, having a fixed horizon is not natural. The way we handle this is by thinking about a salvage value, okay? At the end of the 10 years, we have to think about how much are we going to get for that project. If we sell that project, for example, how much it is worth, so we're going to call that the salvage value, okay? what we want to do is to compute the NPV and the IRR of this project. So let's go here and check the cash flows, okay? This table is building the cash flows for you. At year 0, we have the minus 40,000 investment, and then notice that I'm dividing this in 2 periods, years 6 to 10 and years 1 to 5 in the left corner, okay? So you have the profits, and notice the role of depreciation here. The important thing of this calculation is the role of depreciation. Depreciation has to be deducted from profits before you compute taxes, right? Why is that? Because depreciation is tax deductible, okay? If a company has higher depreciation, you're going to pay less taxes to the government. Here is what this is what we're doing here by deducting the $8,000 in depreciation, okay, from your taxable income. So your actual taxes in years 1 to 5 is just 300. Your after-tax income is 700, okay? But we are not done with depreciation. At the bottom here in the cash flow, before we compute cash flow, we have to add depreciation back, okay? Why? Because depreciation is a non-cash expense. Depreciation doesn't mean that it's actual cash coming out of the company. Nothing is happening in terms of cash flow. The way we address that is by adding depreciation back to compute the cash flow. So the cash flow in years 1 to 5 is 8.7 thousand, okay? The calculation is exactly the same in year 6 to 10. The only difference is that the depreciation is 0, okay? So now you pay taxes on your entire profit, meaning that you're going to get a lower cash flow, right? Your taxes are going to be higher. Taxes now are 2.7 thousand. Your cash flow is going to go down to 6.3 thousand, okay? So cash flow is higher when depreciation was higher. Salvage value, okay, at the end, that's very simple. It's just the 4,000 that was our assumption minus the tax, which is 30% of 4,000. In this case, I told you that the salvage value was a before tax value, okay? So just to recap this, since depreciation is tax deductible, we have to deduct it from profits before we compute taxes, but then we have to add it back to compute cash flow, okay? So to make sure you understood this, right, ask yourself, why is the cash flow lower in years 5 to 10, okay? When depreciation is lower, the cash flow is lower. Make sure you understand why this is the case, okay? Given the cash flows, of course, we can compute NPV, right? So the way we do it is by applying the NPV formula that we talked about, okay? You can do it in Excel, of course. A problem like this, if you want to do it by hand, you literally have to write down all the cash flows and discount all of them, okay? So an easy way of doing it is just to write down the timeline in Excel and then use the NPV function. But you can do it by hand as well, you know, and I recommend that you do a couple of problems both ways to make sure that you are using Excel correctly, okay? The NPV here should be $13,152. And now let's think about IRR. We just talked about IRR. Let's make sure you understand IRR, okay? A couple questions for you before we talk about them. First one, is this a case where we can compute IRR? Are we allowed to compute an IRR, okay? Second is, before you compute it, can you guess a range for what it should be, okay? So can you make a guess on what the IRR should be? The answers, okay? Number one, yes, right? This is a case with a standard cash flow pattern. You are investing in the project today, and then the project is producing cash flows in the future. So yes, it has a well-defined rate of return, okay? If you have to guess, right, we learned that if the NPV is positive, the IRR should be bigger than the discount rate. So a reasonable guess here would be that the IRR has to be lower than 8%. The IRR should be lower than the discount rate. If you do the calculation in Excel, okay, again, Excel would be the best way of doing this, using the Excel function, IRR, okay, writing down the cash flows, use the Excel function, you will see that the IRR is 15.25%, right? So 15.25 bigger than the discount rate, same thing as a positive NPV. Okay? This is a good project, right, that would increase shareholder value. Example number 2. Let's recap the concept of incremental cash flows, okay, and really make sure that we understand how to use it. This example is one where computing incremental cash flows is a little bit more complicated, similar to the accounts receivable problem, okay? So we already did a lot of work to get our incremental cash flows in that problem. Now this is another example where you have to do a little bit of work before you figure out what are the right cash flows to discount, okay? So here you have a machine and that the company is considering to invest in, okay? And these are the only cash flows that you have, okay? Very simplified situation. You have an investment of minus 70,000 and then the machine produces profits or cash flows of 25,000 every year for a period of 4 years, okay? So what do we do? To make a decision on this, we need a discount rate, okay? And we have to compute NPV. An additional assumption here is that the machine is going to be discontinued in 2014 and has 0 salvage value, okay? So there is no other cash flow, as I said before. So it should be very easy to compute the NPV of these cash flows, right? Using Excel, using the formula, you should get an NPV of 12,800. Okay, as of 2010. Okay, so what should the company have done at that point? The company should have invested in the project. Okay, it has positive NPV, invest in the project, right? Buy the machine, put the machine in operation. Okay. However, let's say that now it's 1 year. Okay, it's just 1 year after, but technology moves very quickly, and the company actually has a pleasant surprise. One of the engineers developed a better machine that is going to reduce costs, okay? So it reduces costs, it increases cash flows, okay? And it's going to be discontinued in the same year, right? Again, let's assume there is no salvage value for simplicity, okay? Of course, a real-world problem would be a bit more complicated than that, but that's what the new machine looks like. It has it requires a bigger investment of 90,000 to put it in operation. It's a more complex machine, but then it's going to increase your profit significantly in the last 3 years. Okay? The question now is, should the company replace the machine, right? Or with the new one, or should it keep the old machine? Okay? So you can see that this has the same flavor of the accounts receivable problem that we worked with. Okay? So depreciation, let's give some data on depreciation. The old machine has been depreciated to 50,000 and it can be sold for 39,000, okay, in 2011, okay. Should we sell the old machine and replace it with the new one? That's the question that we have to answer, okay. And here, the key idea that we're going to use is the idea of incremental cash flow, okay? New minus old, right? We have to think about which cash flows are a direct consequence of replacing the machine, okay? What is going to happen if you replace the machine, right? So first, we are going to talk about things that don't matter. Before we actually derive the incremental cash flows, let's talk about two numbers that are irrelevant, okay? So we are in 2011, right? And you invested 70,000 in the machine in 2010. Does that matter? Okay? No. The answer is no. Okay? Whatever you do in 2011, you cannot recover that 70,000 anymore. It's gone. Okay? The 70,000 are gone. It's not going to show in our calculation at all. Okay? The 70,000 is what we call a sunk cost. It's a cost that is already gone. You paid for it in the past. Whatever happened in the past should not affect your NPV anymore. Okay? We gave some data on depreciation, okay, but I also told you that there are no taxes. So in this case, depreciation actually doesn't matter. Okay? Depreciation in this case is irrelevant, right? Because there are no taxes, so we can ignore that number as well. Every time you do a project analysis, there is going to be some information that is going to turn out to be relevant, right? And one of the tasks that you have is to try to figure out which information is relevant, which information is irrelevant, okay? So let's think about the relevant information. And I'm actually going to ask you to do some of these calculations, okay? So we are here in 2011, right? And we have to think about the idea of incremental cash flows, okay? So what is old? Old is to keep the old machine. If you keep the old machine, your cash flow is zero, right? But if you decide to put the new machine in place, okay, then what's going to happen? You're going to sell the old machine for $39,000 and buy the new one for $90,000, okay? So ask yourself, what is the incremental cash flow? And then from 2012 to 2014, the old machine produces $25,000, the new one produces $45,000. Again, ask yourself, what is the incremental cash flow in that case? The answer should be very simple, right? Using the new minus old idea, okay? What happens is that, again, every time there is the word incremental cash flow, every time there is the word cash flow, actually, what we have to do is to think about new minus old, okay? So in 2011, okay, the incremental cash flow would be minus $51,000 because you can sell the machine for $39,000 and you have to buy the new one for $90,000, so the incremental cash flow is the difference. And then from 2012 to 2014, the incremental cash flow is $20,000, right? The difference between new minus old. So if you use the new minus old idea, you should have been able to obtain those, okay? What is the NPV? You know, after you figure out the cash flows in this problem, computing the NPV should be really easy, okay? I write down the timeline, right? Here you have the timeline with all the cash flows, and use the Excel NPV function or do it by hand. You should find an NPV of $541.94, okay? Now ask yourself, should we replace the machine? The answer, of course, is yes, right? It's a small NPV, right? Because you have to, you know, the machine, you have to invest $90,000 on it, okay? Or $51 if you deduct the $39,000 you can sell the old one for, and you're only going to get an NPV of $500, okay? But that doesn't matter, right? You know, if the NPV is positive, this is like the 1 cent, 2 cent example, right? As long as the NPV is positive, we should go ahead and replace the machine, okay? But of course, you know, everybody's at this point is probably thinking, you know, if I'm only going to make $500, why do I care, right? Maybe I shouldn't do it, okay? I agree. This small NPV is going to give us reason to think, okay? And really what we are concerned about here is uncertainty, right? You know, investment decisions have a lot of uncertainty associated with them, and we have to consider, you know, are we really sure about our numbers, right? Since the NPV is so small, you know, it's very easy to make a mistake in this case, okay? In Module 4, which is coming up, we will think about how to address uncertainty in investment decisions. Okay, so this is a preamble to the discussion we're going to have in Module 4. Final example. This is a fun one. Okay, you actually don't have to do any calculations here. Okay, consider this. Now we have a real estate developer who is considering whether to build a mall in a piece of land that the developer already owns. Okay, and they estimate construction costs $20 million, and they estimate the present value of all the future rental income. So this is a smart manager, you know, they learned NPV, they know they have to include all the future rents, and the value is $25 million, okay? Question for you is the mall a positive NPV project, okay? It might seem that it is, right, because 25 is bigger than 20. The right answer is actually that you do not have enough information to answer this, okay? Think about it. The notion of incremental cash flow requires you to think about all the consequences of taking a decision, right? So if the real estate developer decides to build the mall, in this case, then you cannot use the land for anything else. The land is yours, yes, but you can sell it, right? If you don't build the mall, you can sell the land, right? So if the land could be sold, for example, for more than 5 million, then the project is going to be negative NPV, because the profit you make, the NPV of operating the mall minus the construction cost is 5, but you could sell the land for more than 5, so the project would not be positive NPV anymore. Okay? The value of the land in this case is what we think of as an opportunity cost. Okay? Every time you make a decision, you have to consider all the relevant opportunity costs and include them in your valuation if you want to make the right decision. So what the real estate developer would need to do here is, before making a decision on the mall, you have to do some research and try to figure out how much you can sell the land for. Our topic now is real options, okay? We're still talking about investments, so real options is still going to be about how to make right investment decisions. So in a sense, it's a follow-up of the discussion we just had about net present value and IRR, okay? The difference is that we are going to incorporate options into our calculations, okay? So far, what we've done essentially is we've been assuming that the decision is all or nothing. So you either take a project or you don't. You either replace a machine or you don't. Okay, but in real life, investment projects are going to come attached with what we call a real option. Okay, so this could be an option to cancel the project, to abandon. It could be an option to modify. And a very important option that's actually going to be our starting point is that some investments actually create future opportunities. Okay. Rather than creating current cash flows, they create future opportunities to invest. So specifically, we're thinking about research and development, R&D. Okay? So let's start with that, actually. It's one of the most important applications of real option analysis, is how to value R&D, how to make a decision about R&D expenses. Okay? If you think about R&D, the very purpose of R&D is to create an option to invest in the future. When a company is spending dollars to do research to develop new drugs, for example, okay, the goal of the company is to discover something that can become a product, right? So the value of R&D is going to come from this creation process, okay? Rather than creating future cash flows, you're creating an option to invest, right? So let's work with a specific example, okay, and try to put some numbers and try to think about how we would value R&D, right? So suppose a drug company has estimated the cost of researching a new drug, okay, that you're trying to develop, and this drug is going to cost $30 million. Okay, it's a new diabetes drug, just to be concrete. Okay. Question is, how do we compute the NPV of this R&D investment, right? Every time a company spends money, and $30 million is not peanuts, right? Every time a company spends money, we have to think about shareholder value, right? So is this investment in R&D going to increase shareholder value, right? And we cannot just guess. We have to go on to, go ahead, try to do the calculations to come up with this NPV. Okay, so how would we model this? The first thing to notice is that the R&D is not necessarily going to generate a useful drug. Okay, so the R&D may generate, it's research, right? It's like research, like what I do for a living as well. Sometimes our projects work, sometimes our projects don't work, and we end up with nothing. Okay, so the first thing we have to think about is that the R&D only produces a useful drug with a certain probability, okay? The way we're going to think about this is by using a decision tree, okay? So what you have here in the slide is a decision tree where, we're modeling the investment. So today you decide if you take this investment, if you spend $30 million in research, there is a chance that you're going to develop a new drug, but there is also a chance that there's going to be failure, your research is going to produce nothing, and no drug is going to be developed. Okay? So the first thing that the drug company has to estimate is this probability. What is the probability that we are going to end up in the right side of the tree here, right? We want to be on the right side, in the success side. Okay? How can we do that? This is obviously going to be hard. Okay? It's especially hard for novel projects. Think about this. Research is going on. It's probably something new, something that is going to create value, something novel. Okay? So it's not easy to estimate this probability. Okay? But it doesn't mean that we shouldn't do it. We have to do it. If we're going to figure out the NPV of the R&D investment, we are gonna have to do this somehow, right? The way that drug companies do it is by using experience, right? They've done related research in other areas, in other drugs, or educated guesswork, right? Here's some data that is useful. There's typically 4 phases to prove the safety and efficacy of a new drug. Okay, you start small, right? Testing a few healthy volunteers. Okay, and then some drugs already fail at this stage, right? 70% manage to go to phase 2. Then on phase 2, you increase the number of volunteers, right? Again, a certain percentage goes to phase 3, right? Phase 3 then is going to take a number of years. Right? That's when you really start spending the dollars to research this new drug. Okay? You go global, increase the tests to thousands of patients, and then in phase 4, you have to get approval from a regulator. Okay? Here in the US, the regulator is the FDA, the Food and Drug Administration, that is responsible to approve whether a new drug should be used in real life patients or not. Okay? So, just by looking at these numbers, you see that the probability is small, right? Only 70% go through phase 1, 33% go through phase 2. Then there are 2 more phases, right? So the probability is quite small, okay? For any individual drug, it's going to be on less than 10%, okay? Here, let's say that our probability is 5%, okay? So there is a 5%. The drug company estimates a 5% probability that this new drug is going to produce a success, that this research is going to produce a successful drug, and then there is a 95% probability that the drug will not be developed, there is going to be failure. Okay? It's a small probability. That doesn't mean that the R&D shouldn't be done. We have to do more calculations. Okay? The first thing we need to figure out is how much is the company going to have to spend if the R&D is successful, right? Remember what we talked about in the beginning. The R&D is not generating cash flows immediately. The R&D is actually generating an option to invest, okay? If you do R&D, what you're creating is, the right to spend money, if you want. So you're just going to spend more money to begin with, okay? Recently, I read a very interesting interview with the chief financial officer of a drug company here in the US called Parexel International, and the CFO was precisely describing this process. Okay, and one of the points that he made is that each phase requires an increasing investment, and that once you get to the late phases, once the drug gets close to being successful, the investments become very large. Okay, so it could cost $500 million for a single drug to be developed. Okay, so let's say for our example that the required investment is $1 billion. Okay, so here we have the 5% chance that you're going to spend $1 billion. So far, this is not looking very good, right? All we've done is estimating the chance that we're going to spend more money, right? Of course, what we need to get at now is to figure out, the cash flows that this investment is going to produce, right? So if the drug is successful, you spend $1 billion, and then you're going to generate profits, okay? It turns out that the regulators understand that developing a drug is a very costly process. It takes many years of research. It takes these, large investments. So in many countries in the world, we have this concept of a patent. Okay? So the FDA will typically grant a patent for a certain number of years. For our example here, let's say it's 10 years. Okay? The patent creates a monopoly for the company during that period. So the company will probably have higher profits because it's the only one that can produce exactly that drug. After that, competitors are going to be able to copy this drug. Okay? So how would we model that? There's going to be a two-stage cash flow process, right? Initially, the drug is going to generate high profits. Let's say here it's $200 million a year, okay, for these 10 years. And then the cash flow is going to drop to $20 million a year, $20 million a year in perpetuity. Again, the right horizon to consider is typically an infinite horizon, as we discussed already in this module, okay? Suppose then also that the discount rate is 6%, okay? What we need to do now is to figure out the present value of these cash flows, okay? At the point that the drug is developed, what is the present value of these cash flows, okay? And yes, this is one more present value example, right? Practicing always great. Practicing is what makes perfect, both for guitar playing and for finance, okay? So let's go on and do that, okay? So here what you have are the cash flow as a timeline, right? So 1, 2, 3, 4, right? 200 million cash flow for the first 10 years, and then the cash flow drops to 20 million, right? I have the calculation here for you. Notice one thing, right? Because we have the infinite horizon at the end, we're going to have to use the perpetuity formula, right? We have this $20 million cash flow that keeps going on forever, right? The discount rate is 6%, so we know we're going to have to use the perpetuity formula, right, to divide 20 by 6% to get the value of that perpetuity at the end, okay? And then notice that if you apply the present value formula, the first cash flow is happening in year 11. This value is going to go here in year 10, okay? The value of this perpetuity is going to accrue to the firm 10 years from now when the patent expires, okay? It's as if the company were like selling the drug at that time, and the value of the drug is 20 divided by 6%, okay? So you have that here 10 years from now, okay? In addition to the cash flow of 200 million that the company is still producing in that time, okay? And then you have the other cash flows that we are discounting back. Again, you know, at this point you can do Excel. You can use Excel, right? You have to you're going to have to apply the perpetuity formula at the end. But after you have figured out the perpetuity, you can definitely use Excel to calculate the present value of the cash flows, which here we got to be $1.658 billion. Okay, you are investing $1 billion. So what this means is that if the drug is if the R&D is successful, if the drug is developed, we are forecasting, we are estimating, we are guessing, right? We are not sure, but we are guessing there's going to be an NPV of $658 million. Okay? So we can go back here and add that to our decision tree. So now we have all the numbers. If you invest $30 million, you have a 5% chance of generating a net present value of $658 million. Okay? And then there is, you know, a 95% chance that you get nothing, right? We still have to think about one more issue before we do the final valuation, which is how long does it take, right? Research takes time. You know, like I said, this is one of the things I do for a living, is to do research, to write papers. I can tell you that each paper that I work on can take, you know, 2, 3, even 4 or 5 years to between the time you start and the time you complete. You know, research to develop a drug is similar, right? There's lots of people working, but it usually takes a few years to decide if the drug is going to be successful or not. So for our example here, let's say it's 3 years. What I'm saying is that, let's say that the length of this period between the 30 million investment and the development of the drug is 3 years, okay? And now the question for you, try to, with this data, we've figured everything out except the NPV of the R&D, try to do the calculation yourself. And here it is for you, okay? So that's how you would do it. You have the minus 30 in the beginning, of course, right? And notice that since there is only a 5% chance that you get the positive NPV, we have to multiply the 658 million by 5%, right? There is only a 5% chance you get that, and then we have to discount by 3 periods, which was our assumption is going to take 3 years, okay? If those numbers are correct, we are getting an NPV of minus $2.37 million, okay? So we got a negative NPV for the R&D investment, right? What this means is that despite the large potential benefit of the drug, right, you could generate really a ton of money, but you know the R&D is just not making sense for shareholders, okay? The risk of failure is too high. It takes too long to generate profits, okay? At this point, you know, what the company could do is to try to change the parameters somehow, right? In a real way, you know, not playing with parameters, not making optimistic assumptions, but what I would recommend is that the company should try to lower the cost of research. You know, is there a way of doing this research in a way that maybe is going to cost less than $30 million? Is there a way of getting results sooner? Any of these changes might cause the drug to become positive NPV and will definitely help the company. The next real option we're going to talk about is the option to wait. And the option to wait comes from the idea that companies, in some cases, will have, you know, the option, the benefit of waiting for more information before you commit cash to a project. Okay? So it might make sense in some cases, rather than investing in a positive NPV project today, you know, waiting a bit longer, getting more information to make sure that the project truly is positive NPV or whether there is a better alternative. Okay? So we will illustrate this option with a specific example of a gold mine, which is a classic example of an option to wait. And we're going to get to numbers and all that. Okay? These are the numbers that we're going to use. So you own the rights, so there is a monopoly, which is something we're going to talk about later. You own the rights to operate a gold mine for 3 years, okay? And there is a certain cost to open the mine. And if you open the mine, you can extract a number of ounces of gold. Here we have 1,000 ounces, okay? And let's assume, this is something we're going to talk about at the end, let's assume that this investment is irreversible to begin with, okay? So once the mine is open, you have to keep it, you have to keep it open until the end of the 3 years, okay? Let's say that the current gold price is 500 an ounce, and each year there is a chance that the gold price is going to go up or down. This is where the value to wait is going to come from. In some cases, it may make sense for us to wait and to get more information on what the price of gold is. Okay? There is an extraction cost, right, of 460. Okay? No fixed cost of opening the mine, so all costs are variable. So other assumptions about discount rates. Okay? We're going to assume for simplicity that cash flows happen at the beginning of the year. So the moment you open the mine, you can already extract the gold and sell it. You know, this is not realistic, but we really don't have to deal with this issue here. It's simpler to do the problem this way. Okay? So for example, if you open the mine today, you're going to get the 1,000 ounces immediately and then sell it in the market. Okay? So you get your profit immediately. Okay? The question we're going to try to answer is, should you open the mine today or should you wait 1 year to get more information on the price of gold? Okay? And again, the way we're going to do this is by building a decision tree. Okay? Like as we did with the R&D, we're going to go here and think about a decision tree. In this case, the decision tree is going to be based on the price of gold. Okay? So gold starts today at $500 an ounce, and we have an expectation that the price could move up or down with an equal probability. okay, and we are thinking of a 2-year horizon for this problem, right? The mine keeps open for 3 years, right? But remember our assumption that we extract the gold today, right? So 2 years ahead, the price of the gold 2 years ahead is going to determine the profit that you make in year 3. Okay, so that's why we have it like that. So the price could go up to 600 or it could go down to 400. And naturally, you know, the profitability of the mine is going to depend on the price of gold. Okay, that's where this is what's going to make this problem interesting. Okay. Before we do the calculations, it's very important to understand that we understand the problem. Okay, what is the trade-off, right? As with other net present value problems, it is essential for us to understand the nature of the problem. Before we get into calculations and started throwing out numbers, let's try to understand what's going on. Okay, so here was what happens, right? So if you open now, okay, the gold price is currently 500, so you're going to be profitable. Okay. Remember that, you know, the cost of extraction is 460. If the gold price goes down, right, and you decide to open the mine now, you're going to make a loss. Okay? On the other hand, right, if you wait, okay, if you don't open the mine today, you're essentially giving up the current profit, right? So you say, okay, I'm going to wait. I know that by doing that, I am giving up on the current profit. The benefit here is the main benefit, okay? The main benefit is that if you decide to wait, you can avoid this state of the world where the gold price is low and the mine becomes unprofitable, okay? So you're essentially opening the mine only if you know that the mine is going to be profitable, okay? So that is the trade-off that we have to think about and try to put numbers on, okay? In terms of calculations, this is what we're going to do to solve this problem, okay? What I want us to do is to build a profit tree, okay, from the tree with the gold prices, right? So today, if we open the mine, we're going to make a profit. The profit is going to turn out to be 40. I'll show you the calculations in a second, okay? And then, of course, the profit is going to go up or down depending on where we are, right? If the gold price goes down, then there's going to be a loss next year. If you're going to be making an annual loss of 10,000, okay? And then also here, right, you're going to be making a loss of 60,000 if you decide to open the mine today and keep it open, right? Then you're going to be making a large loss in year 3 by operating this mine. And remember, the investment is irreversible, so you cannot close the mine. Okay, we'll talk about that later. Okay, just to give a couple examples here where we got those numbers. I know that's always a question that I get when I teach this. Okay, so right, if you open the mine today, the profit is 40,000 because you extract 1,000 ounces and you make a profit of $40 per ounce. Okay, if the gold price goes down to 450, then you're making a loss of 10,000 because your margin goes down to minus 10. Okay, so very simple calculation really. Okay, so what is the NPV of opening today, right? If you go back to the profit tree and look at the numbers, this is what's going to happen. Okay, if you open today, you pay the opening cost, which is minus 70, and then you get the profit of 40. Okay. And then we have to take the probabilities into account, right? A year from now, you could either be making a large profit of 90 or you could be making a loss of minus 10. So this calculation is taking the probabilities into account in the same way that we included the probability of the drug of the drug being successful when we did the R&D calculation. Okay? So there is a 50% chance of 90, 50% chance of 10, and then we discount using the 5% discount rate, okay? And here we have the year 2, okay? There is a 25% chance of a very high profit. That's what you want, right? But then there is also a 25% chance of a negative profit of minus 60, okay? So we discount it by 2 periods, right? Because you're 2 years ahead. And if you do all of these calculations, you're going to get an NPV of 44,367. Okay? Make sure you understand this calculation. This is a standard NPV calculation, but it has these probabilities, right? So for example, you can ask yourself, do I really understand these probabilities, right? So why is the probability of the 140K profit equal to 25%, right? The reason, of course, is because to get to 140, you need 2 up moves, right? You need the gold price to go up next year and then to go up again 2 years from now. Each move has a 50% chance, okay? So make sure you understand this calculation. And here's a question for you. It's very useful that you try to build the decision tree yourself. Rather than just looking at mine, now I want you to think about the weighting option, okay? Let us think about what happens if we decide to weight. What does the profit tree look like in that case? Here's the answer, okay? Remember, if you don't open today, right, you're essentially giving up today's profit, okay? So you're going to get 0 instead of 40, right? The benefit is that, remember, this state of the world here in the bottom was a loss state. The gold price went down. The company was losing money, okay? If you decide to wait until tomorrow, then you are essentially avoiding this loss. And going forward to period 2, to the 3rd year of extraction, again, you're getting 0, okay? Here, this state was very bad because the gold price is too low, right? But you can avoid that by waiting a year, okay? Right? You only open the mine if the mine is profitable. So essentially, you are guaranteeing that the mine is going to be profitable by waiting a year, okay? That's how the profit tree should look like, and I hope you are able to get these numbers correctly. If not, try to think about what you've done wrong, okay? Because that's an important skill to be able to build these profit trees yourself, okay? Given this tree, computing the NPV should be easy, right? We can even think about it here. So you're going to open the option tomorrow. You're going to open the mine tomorrow, right? So you're going to pay the 70K here and get a profit of 90. Okay, and then you get these additional profits 2 years from now. If the gold price goes down, you essentially get 0. Okay, so this is what the NPV of waiting look like. There is a 50% chance of opening the mine. Okay, that happens 1 year from now, and you get a profit of 20. Okay, because it's 90 minus 70, and then we take into account the probabilities that you're going to end up in the high gold price states, right? 25% chance of being in 140, 25% chance of the profit being 40. You discount that 2 years and you get an NPV. Okay, the NPV in this case is 50,340. Okay, so let's think about the decision, right? So we computed the NPV of opening now is 44,367. Right? So the way I like to explain this is, if you force the manager to make a decision today, if you tell the manager, look, you either open today or never, then yes, you should do it because the NPV is positive, right? But if you wait until an extra year, then the NPV is even higher, okay? The NPV of waiting is 50,340, okay? So the right decision here is to wait. Opening the mine is a great investment, it's not bad, but waiting is even better, okay? So, nobody likes waiting, okay? But in this case, it turns out to be the optimal decision for this company, right? Before we end, let's talk about a couple ideas that are very important. The first one is that the value of the option to wait is going to depend on the amount of uncertainty that you have in the economy. In this case, it's going to depend on the uncertainty on the price of gold, okay? So suppose, if volatility is high, suppose we are in a case where gold prices are extremely volatile, right? What happens is that, fluctuations in the price of gold are going to cause very large profit gains and very large losses, okay? So in this case, if you decide to wait and open the mine only tomorrow, you are essentially avoiding a very large loss, right? By waiting, you can avoid the state of the world where the gold price is very low and you're going to be stuck with a very unprofitable mine, okay? So waiting eliminates this large loss. 0 looks great, right? If you're going to lose money, 0 looks great, okay? The other issue that we're going to talk about is that there is competition also matters. Okay? Remember, from the very beginning, we assumed that you had an exclusive right to open this mine. So you have a monopoly. Okay? In most cases, companies do not have a monopoly. They may not have the ability to wait because competitors may decide to start similar projects. Okay? Let's think of this here in our decision tree. You know, in many cases, companies are going to be in a situation where if they decide to wait, you know, they lose the profit today, but they may also lose profits tomorrow, right? If the competitor decides to start a similar project, then you're going to lose profits. And the profit is going to be low. The profit might have been higher if you had started today, because that might deter the competitor from starting a similar project. Okay? So this is how we would think about the effect of the competition on the option to wait. So every time you're trying to value an option to wait, you have to consider whether the company really has the ability to wait and whether that would not be bad from a competitive standpoint, right? Waiting in some cases may give an opportunity for competitors to come in and take your profits away. The final real option that we're going to talk about is the option to abandon an unprofitable project. Okay? Sometimes closing a project, abandoning a project is the right thing to do. Okay? Of course, all projects have to be constantly evaluated, right? You know, once you decide to invest in a drug, for example, to invest in R&D, to buy a machine, to open a division, you know, any corporate decision has to be constantly evaluated. In fact, one of the topics we're going to talk about in Module 4 is how to evaluate ongoing projects and divisions. That's one of our topics. Okay? For now, let's talk about this, the value of this option to abandon, right? So the idea is that, you know, you can exercise this option, you can use this option by shutting down a project that has become negative NPV. Okay? The other way that companies can exercise this option, of course, is by selling projects, right? Perhaps the project is not as valuable to you as it is to a competitor, so it may be worthwhile to abandon this project, move on, sell it to someone else, you know, try to make some cash, and go do something else. So shutting down projects in many cases is the right thing to do. Okay? Let's talk about this option in the context of our example, the gold mine, right? We assumed in the beginning that the gold mine was irreversible, so you could not close the mine once it's open. That is likely to be a little bit not realistic assumption, you know, unless the government forces you to keep the mine, right? You probably have a license from the government might force you to extract gold anyway, but if that's not the case, the company is very likely to be able to close the mine by paying a closing cost. We call that a decommissioning cost. Okay, those are synonyms. You could think about the decommissioning cost as a closing cost. Okay, so let's say in our example there is a closing cost of $5,000. Okay, so that's not a huge cost. How would that change your analysis, right? Now we have to consider the option of opening today, right, and then closing tomorrow if the gold price goes down. Remember, the main benefit of waiting was that we could wait until tomorrow and avoid opening the mine if the gold price went down. Now we have a third option, which is to open today, make the profit, pocket the money, but then close tomorrow if the gold price goes down. Okay? So I've made the profit tree for you in this case. Okay? So now what we have the profit here at the beginning, right? And this is the important change. If the gold price goes down and the mine becomes unprofitable, you can close it by paying $5,000. Okay? You pay $5,000 and you close the mine, and then of course the mine remains closed until the end. You just make a zero profit. Okay? If the gold price goes up, of course, you're going to keep the mine open and make the profits, right? It's not worth closing the mine in that case. So that is the tree that corresponds to this third option. And notice that the $5,000 here is precisely the decommissioning cost. Okay? So now the question for you, previously, in the previous question, you worked out the decision tree. Now, I've done the decision tree for you. Try to use the decision tree to compute the NPV. Okay, so let's check your answer, right? Let's see if you've done the right calculation here, right? So what we have the NPV, right, is going to be equal to minus 70, right, because you open at time 0, plus the date 0 profit, right? So let's mark the numbers when we take them into account, right? And then here, next year, we have a 50% chance of a profit of 90, right? We have to discount that, okay, by 5%, okay? And then, right, there is a 50% chance of a loss. The loss now is only 5K times the minus 5, okay? Again, we're going to discount that one period, okay? There is nothing here. If you close the mine, there is 0. So the only numbers we need to consider are the numbers there. So it's 25 times 140, right? Divided by 1 plus 5% to the second, okay? Plus 25% times 40. Okay, so we are taking this number into account. Okay, so here's the entire calculation done for you. Remember, here we have to discount by 2 periods as well, right? Because we are 2 periods ahead. So that's how the NPV would look like. Okay, if you do this calculation, you should have obtained an NPV of 51,292. Okay, so that's the NPV of opening now and closing tomorrow if the gold price goes down, right? So now we have 3 NPVs, right? If you open now and keep it open, it's 44. If you don't open now and wait, it's 53,340, right? If you open now and close tomorrow, it's 51,292. So now the optimal decision is to open today and exercise the option to abandon. So in this case, the option to abandon, to close the mine, becomes very valuable, right? It actually makes it more likely you're going to start the mine today. Okay? An important observation here is the notion of irreversibility, right? We can capture the notion of irreversibility with this decommissioning cost, okay? If the cost of closing the mine was very high, then it would obviously not make sense to open today and close tomorrow, right? In the first example that we gave, we assumed that this cost was infinite, so you could never close the mine. And then we worked with a cost of 5K, okay? So of course, the cost could be, at any specific value, right? The notion that is important to realize is that this cost is what's going to capture reversibility for us. Investments that have high shutdown costs are going to be reversible, right? And those are going to be the investments for which the option to wait is the most valuable, right? Because if an investment is irreversible, it really makes sense to wait until you are sure that this investment is going to be positive NPV. If the investment is not irreversible, then you might as well start today and close it tomorrow if things turn out to be bad. Okay? So let's give a few examples of irreversible investment. For example, building a factory may be an irreversible investment, right? Once you have put all the equipment in place, it may be very difficult to close the factory. There are lots of fixed costs, so you may end up having to operate a factory even if your sales turns out to be worse than expected, for example. Okay? Or testing a drug on thousands of patients, which is the example we just talked about for R&D. Once you've done that testing, it's gone, right? You can't go back and recover that money. That's completely reversible, right? So drug companies have to really think about whether it makes sense to continue doing research or not, because those are definitely reversible investments. On this model, we learned how to think about investment decisions. Okay? In particular, we learned several tools that companies can use to try to ensure that they are making investments that create shareholder value, right? We talked about net present value, which really is the most important concept in corporate investments, okay? Because net present value is equivalent to shareholder value, right? It's exactly equivalent to maximizing shareholder value under a certain assumption, right? We learned how to build cash flows for NPV calculations. We learned how to compute NPV and how to use NPV to make decisions, okay? Then we talked about rates of return, right? Which in many cases are very similar. You know, you can either make decisions with NPV or you can make decisions with IRR, the rate of return on the projects, right? And we also talked about situations in which you should not use IRR to make investment decisions, okay? So now you should know how to compute NPV and IRR, and also when you can use IRR and when you cannot use IRR, right? After we finished that, we started talking about real options. Okay? The concept of real options is extremely important because many investment decisions are going to come embedded, are going to come, you know, with options to wait, options to abandon, options to expand. Okay? And we learned that to incorporate real options into investment decisions, we have to think about decision trees, right? There are different states of the world. We have to think about what's going to happen in the future and how the company could change its original decision, okay? We talked about specific applications of real options, including R&D investments. We learned how to value an R&D investment, how to try to put the numbers, to make sure that companies are spending money in R&D that is going to create shareholder value, right? And then we talked about the option to wait and the option to abandon, and we learned how to incorporate those options into investment decisions using decision trees. The assignment for Module 3 has, again, open questions and numerical problems. In this case, the numerical problems are questions from 5 to 8, okay? And as in the other assignments, the goal of the open question is to allow you to discuss some of the key ideas of the module in your own words. Express ideas in your own words is very important, okay? The goal of the numerical questions in this case is to allow you to practice calculations, right? NPV and real options are ideas that, you know, it's easy for me to explain you the general idea, but for you to really master this, you have to practice, okay? So as we've been emphasizing in this course, practice makes perfect, right? Both in guitar playing and in finance, so make sure you practice, okay? Also work on the quizzes. Don't forget to work on the quizzes. For this modeling specifically, the quizzes are very important, so you can practice different calculations of NPV and IRR, okay? In terms of resources, this module is very simple. All you need really are the assignment questions and the lecture notes, okay? There's no a spreadsheet that you have to access. There's no data, okay? All you need is the assignment and the lecture notes, okay? And remember the guidelines, okay? You have to provide your answers in a format that can be easily read by your peers. And when answering a numerical question, it's better if you can do it in a word processing software such as Word, so it's easy to read and you don't have to rely on writing, okay? If you do solve the problem using pencil and paper, you have to make sure that your answer is accessible to others so that it can be read and can be graded, okay? And as with the other assignments, I will provide my own solution, okay? But please make sure that you work on the assignment before you see my solution. Otherwise, you're going to lose a little bit of what you would gain if you're working on the assignment beforehand, okay? So prepare your solution before you see mine. This this is the solution to assignment 3. It starts with a question about the relationship between NPV and stock price, which is a fundamental concept in finance. Okay? The reason why NPV and stock prices are equivalent, it really is because they are mathematically equivalent. It's the same formula, right? To compute an NPV, you discount the incremental cash flows to a project, right? Whereas to compute a stock price, you discount cash flows to the company, okay? So if markets are efficient, then you know both calculations should be equivalent, right? The stock price recognizes all the future cash flows to the company, so the market should also recognize the incremental cash flows to a project and adjust the stock price exactly to the amount of the NPV of the project. Okay, so NPV and stock prices are equivalent because of that. If the markets are not efficient, right, then of course the stock price may not reflect the NPV, right? Because the stock price may be reflecting other things other than future cash flows, right? And then, you know, since the NPV always requires you to discount future incremental cash flows, then NPV and stock prices are going to be different. Okay, so that's why efficient markets are important. Question 2 is just to remind you that the only thing that we are sure with NPV is shareholder value maximization, right? NPV does not ensure that we're going to eliminate conflicts with society, right? That's a simple point, but it's worth emphasizing. For example, you know, a cheap technology may maximize NPV because of lower costs, but it might be bad for the environment at the same time, right? Or, you know, we can think of situations where a company that wants to be socially responsible may need to pass on positive NPV projects because they are bad for society, because they hurt stakeholders, right? And for other consequences. Okay, so NPV does not assure that companies are doing the best for society because of this potential conflict. Question 3 is a little bit of a trick question, but it's important for you to know. Okay, so it's a situation when the discount rate is lower than the growth rate, right? The growth rate is 7%, the discount rate is 5%, and if you just apply the growing perpetuity formula, it seems that the NPV is negative, which makes no sense, right? You know, if the asset has a very high growth rate, this should be a great asset. Okay? The answer, in fact, is that, you know, the asset has an infinite value. Okay? If you're mathematically inclined, you probably know that. But the intuitive way to think about it is that if the cash flow is growing at a faster rate than the discount rate, then every year the discounted cash flow for that year is getting bigger and bigger. Okay? It's not converging to a small number, right? And what this is going to do is that if you sum all future cash flows, the answer is going to blow up. It's going to become infinite. Okay? The bottom line is that we know infinite does not exist in the real world, right? Nothing has an infinite value. So if you do find an infinite value in a present value calculation, it means you've done something wrong. You have to go back and rethink your estimates. Maybe you overestimated growth rates, maybe you underestimated discount rates. Okay? Question 4 is to remind you of the important relationship between the rate of return, the IRR, and the discount rate. Okay? So the idea that NPV equals 0 is equivalent to having a rate of return greater than the discount rate. If the IRR is bigger than the discount rate, then the NPV is positive. Okay? However, remember that the IRR should not be computed if you see a negative cash flow following a positive one. Those are the cases when you can have multiple IRRs, and it really might get you in trouble if you try to compute IRR in those cases. So if you see that, just use NPV, and also be careful when you're using IRR to compute two different investments, right? As we discussed in the lecture notes, if the investments are of different magnitude, then the IRR may give you the wrong comparison. Okay? As long as you remember these conditions, you should be able to employ this important idea, which is the equivalence between the IRR rule and the NPV rule. Question 5 is an application of the notion of incremental cash flows. It's a problem that really asks you to think about what incremental cash flows are. What's this notion of incremental cash flow, Okay, it's a project where a company is building a new, is thinking about starting to sell a new wallet. Okay, and as usual, there is an initial outlay, and the company has estimated wallet cash flows as $450,000 a year. Okay, the question is, are these the right cash flows? You know, you might know already. Obviously not, right? There are 6 slides coming up. Okay, so those are not the right cash flows. There's something else missing, right? What is missing here is that we haven't fully considered the notion of incremental cash flows. Okay, remember that the notion of incremental cash flows is this important notion of new minus old. In order to figure out the right cash flows, the right NPV for the project, we have to take into account all consequences of taking a new project. Okay, and this particular exercise is talking about erosion, which is a very common consequence of starting a new project in a company, right? If a company starts a related project, or if you improve an existing project, you know, you're creating new cash flows, but you're also reducing sales of existing products. Okay? In this case, we assume that the sales are going to decrease cash flow by 200. Okay? However, we are not done, right? Because we also have to think about competitors. You know, competitors are also trying to think about cool new products, so they might decide to produce a wallet, right? A similar wallet, and which might erode sales anyway. Okay? And you know, really to think about this problem, we have to be very careful and really model this notion of new minus old. So that's what I have for you here. Okay? Let's really go line by line and think about what changes if you go from no wallet to a new to the wallet project. Okay, so of course the wallet cash flows alone are 450, right? And you erode, if you sell wallets, you're going to erode 200. Okay, if you don't start the wallet, you know, your own erosion is 0, right? However, there is this additional line here, which is that if you don't start the wallet, you know, your expectation is that your competitors are going to start a wallet anyway. Okay, the erosion is not as big as if it was your own wallet, so it's 100, it's not 200, but it's significant, right? You have to take that into account. Okay, competitors are going to erode your cash flows anyway, right? If you do take the wallet, what is happening is that the erosion is going down, right? Okay, the erosion of existing cash flows from competitors is going down from 100 to 50. Okay, the assumption here is that competitors might also, you know, they might decide to start a wallet anyway. Even if you start your own project, the competitors may also decide to come into the market, so the erosion from competitors doesn't go to 0, okay, but it is going down, right? So your wallet project is also reducing erosion from competitors. This is a third consequence of the project that we have to take into account, right? So new cash flows from the wallet, your own erosion, and erosion from competitors, okay? After you do all that, you will quickly see that the incremental cash flow is 300, right? So you erode 200, okay, but you reduce erosion from your competitors by 50. So the bottom line is that the total incremental cash flow for the wallet project is 300. So those are the cash flows that you would discount. This question doesn't ask you to compute NPV because the idea was to allow you to think, spend the time thinking about how to build the cash flows. Okay, so that's the right answer right there. Question 6 is about opportunity costs. This is what you should have figured out here. Okay, the net present value of a full-time MBA is going to depend heavily on your opportunity cost. Okay, in the case of the MBA, of course, the opportunity cost is going to come from the need that, if you're going to take a full-time MBA, you're going to have to quit your job, right? The total cost of the project is 400, and you're going to increase your lifetime earnings by 700, right? But the NPV is not 300, okay? The NPV would be 300 minus whatever is your, whatever you expect to be the reduction in your current earnings, right? So if you're going to have to quit your job and you make $100,000 a year, okay, after taxes, then you're going to have to deduct 200 from the NPV. If you make more money, then of course the NPV is going to become lower, right? So that's why it's important when you think about doing a full-time MBA or any type of education. You have to think about you know, what sort of other opportunities I'm missing. You know, if you're working, right, as most people who take a full-time MBA are currently working, then you have to think about what you're missing in terms of your current salary. That's a very good illustration of this notion of opportunity cost. Okay? Then you had a question about R&D, right? In question 7, the R&D that you had to model is slightly different from what we considered in class, right? Which is the R&D to gather more information about an existing drug that is already viable, right? In the lecture notes, we considered an R&D to create a viable drug. Now you have a viable drug, but you have the opportunity to do additional research to try to increase the NPV of the drug, okay? Of course, doing the R&D is going to require you to wait as well, right? You know, on top of spending more cash, you're going to have to wait a year. So this is a combination of R&D valuation and the option to wait, okay? So the trade-off in this case is that waiting is going to cost you 10 million, okay? And it's going to reduce the NPV if the research is not successful, right? Notice that while the NPV is still 200 million next year is worth less than 200 million today, okay? Why? Because the company is foregoing the drug cash flow by 1 year. I mean, foregoing the drug cash flow in the current year by waiting, okay? So that's why, that's a very, again, it's a notion of opportunity cost. So if you launch today using the problem's numbers, you get an NPV of 200. If you launch tomorrow, right, if the research is successful, the NPV goes up to 250, okay? If you fail, you know, it's kind of the same drug, you're going to go back to the NPV of 200, okay? So you can use the formula that we used in class to compute the NPV, 30% times 250, 7% times 200, discounted back to times 0, you get an NPV of 185.45, okay? So since the NPV of R&D plus launch is lower than the NPV of launching today, the right decision would be to launch today and not do additional R&D, okay? Question 8 is a question about the option to abandon a project, okay? So it's a conceptual question to make sure that you understand this notion of, you know, what does it mean? What's the benefit of being able to abandon a project, right? One thing is that if the cost of abandoning a project is 0, then you would never wait, okay? Why? Let's think about it now. The benefit, of course, of waiting, as we discussed in the lecture notes, is that you can avoid the loss, right? So if the project becomes unprofitable, you know, in our case, the gold price goes down, then opening the mine is going to create a loss. If you wait until next year, you can avoid that loss, right? The benefit of waiting is that the cost of waiting is that if you wait, of course, you're foregoing the current profit. So by opening now, you get the current profit. If you wait, you're going to get 0 today, okay? So what happens? If the cost of closing the mine is 0, right, then what you can easily figure out is that, you know, you can eliminate the loss, right? If you open now and close tomorrow, right, you can eliminate the loss, right? So instead of a loss here, you get a 0, okay? And you also get the current profit, okay? And in addition, in the good state of the world, when the gold price goes up, the profit is the same as in the case of waiting, right? So now you have a situation where really you can get the best of both worlds, right? You can get the current profit and you can get 0 tomorrow if the gold price goes down, okay? So what this means is that if it was costless to open and, you know, start and abandon projects, then companies would never wait, right? And this is the solution in words, right? The idea is that if the cost of closing the mine is 0, then you can also achieve this payoff of 0 by closing tomorrow, right? So that's why I call this the best of both worlds. Finally, question 9 was about this notion of irreversible investments, right? So, and it's related to what we just discussed, right? An irreversible investment is the opposite, right, of a 0 cost of abandoning. Is an investment that once you start it, it's very hard to go back. Okay? So just using our current discussion, it's obvious that, you know, it is for these types of investments that the option to wait is going to have a high value, right? If it's very difficult for a company to go back and abandon a project, then it may be it pays off more to wait until to make sure that you have all relevant information before you commit cash to this investment. In this course, we've been talking a lot about how to create shareholder value, right? In particular, in Module 3, we discussed the concept of net present value and how we can use net present value to measure the contribution of a new product to shareholder value. Okay, so this we learned already. In this module, what we're going to talk about is mergers and acquisitions. Okay, buying another company that has made that valuable project is another way in which a company can create shareholder value, right? So you either make the cool product yourself, or you buy the other company that has made that. Okay, and in some cases you can actually create value by selling, right? If you sell the company to another owner that values the company more than you do, then you're also going to be creating value. So M&A is a very active market. It's a way in which shareholders can actually make money. So it's very important for us to discuss that as well. So one of our goals here is to discuss a few very important topics in M&A. Unfortunately, we don't have time to talk about everything. We could definitely do an entire class just on M&A. We don't have that much time, okay? So what we're going to do is to focus on a few specific issues that I think are the most important for us to consider, okay? So we're going to understand the key motivations for M&A. We're going to think about valuation, how to value them, and then we're going to think about pricing, how to price an M&A deal, okay? We're going to do mostly when we think thinking about deals between two companies, okay? An acquirer and a target. But we are also going to talk about leverage buyout. Okay? Leverage buyout is a major form of M&A deal in recent years, and as we're going to learn, there are some specific facts about leverage buyouts which make them different from a merger between two companies. Okay? So we're going to talk about LBOs, and we're going to try to understand how LBOs can create shareholder value as well. Okay? And then the other main topic we're going to discuss in Module 4 is uncertainty. So far, for example, if you look at our examples in Module 3, we have been assuming that we knew the forecast. We always have the forecast, we know what the cash flows are going to be, and then we do the valuation. Okay? Of course, in the real world, that's unlikely to be the case. Every time you create something new, every time you create a new product, every time you make an acquisition, there is going to be a lot of uncertainty associated with that decision. Okay? So we have to discuss the notion of uncertainty and how we address uncertainty when valuing an investment. That's going to be the other major topic we're going to talk about in this module. Okay? We're going to learn how to deal with uncertainty, okay? And how to incorporate that into our valuation. Okay? There are standard finance tools, there are standard techniques that we use to deal with uncertainty and make sure that our valuation takes that into account. And finally, what you're going to learn is that you can use these tools, okay? These tools that we have to measure uncertainty, we can actually use them to measure performance. So that's going to be an interesting idea we're going to learn at the end, okay? We're going to be able to measure whether a project or division is generating real economic value or not. And what you're going to learn is that the answer to this question is directly related to the previous question that we made, how do we incorporate uncertainty into valuation? So that's going to be a very interesting discussion that we're going to have in this module as well. In terms of specific objectives, right, we're going to start with M&A. We're going to talk about the concept of synergies, which is the most important idea in M&A. We're going to think about how to value synergies, okay, using NPV techniques. So that's going to use the same net present value technique that you already learned. And then we're going to think about how synergies determine the pricing of M&A deals. Okay. Then we're going to think about means of payment, right? Some mergers are paid with cash, some mergers are paid with stock. We have to understand, what's the difference What does it mean to pay with stock? That's another topic we're going to be talking about. Then we're going to talk a little bit about LBOs, specifically, the specific characteristics of leverage buyouts and how they can add value. Okay? After we do that, we're going to move and start talking about uncertainty. Okay? So we're going to learn how to perform sensitivity analysis, how to incorporate sensitivity analysis into investment decisions, and then we're going to learn a very important concept in finance, which is the idea of changing the discount rate to incorporate risk into the valuation. Okay? So what we're going to learn is that the discount rate that we've been taking as given is the key number that we're going to use to incorporate risk into the valuation. Okay? And then we're going to learn how to estimate a discount rate for a real-world company using the weighted average cost of capital formula. Okay? As we're going to learn, that's the way in which we're going to estimate the discount rate when you're valuing a project that is, when we are valuing a new investment by a real-world company. Okay? And then we're going to use this WACC, the weighted average cost of capital, to estimate economic value added, which is going to be our measure of performance. So as I said before, our measure of performance is going to be directly linked to this formula that we're going to use to incorporate risk into the valuation. So WACC and EVA are going to be very related concepts, as we're going to learn in this module. Let us talk now about mergers and acquisition, okay? And I want to start from what is probably the most important concept that we're going to talk about, which is the concept of synergy. The key idea is that a merger is only going to add value if the two companies are worth more together than they are apart, and the new thing that the merger creates is what we're going to call synergy, okay? So the idea, I like to think of this idea as 2 plus 2 equals 5, right? 2 plus 2 equals 5, meaning that when you put company 1 and company 2 together, if both are worth 2, somehow when you add them, you create 5, okay? The synergy in this example is equal to 1, right? The 1 is the new thing that you create when you put the two companies together. And going back to what we learned in Module 3, the synergy is going to be the NPV of the merger, okay? Remember that the NPV is the value that is created by a new investment. When a company makes a new investment, right, the net present value is going to increase or decrease, right? Sometimes the NPV could be negative. The net present value is going to change shareholder value, right? So if synergy is positive, then the merger is going to add to shareholder value, okay? We are going to focus mostly on mergers between two companies. We're also going to talk about leverage buyouts, but we can use the same logic to talk about other deals that we're not going to have time to discuss much in this course, okay? The first one is an asset sale. In some cases, a company may decide to buy just a part of the other company. So for example, in 2012, Microsoft bought patents from American Online, right? So rather than buying American Online as a whole, Microsoft decided to buy some patents that American Online had produced in the past. The idea is that this transaction only makes sense if the patents are worth more for Microsoft than for American Online, and mathematically you can express this idea as follows, right? Microsoft plus patents has to be bigger than American Online plus patents, okay? In that case, the transaction creates value. The other type of deal that is also very important in the real world, but we're not going to have time to discuss much in this course, is a spin-off. Okay? So what is a spin-off? A spin-off is a situation when a firm separates into two different parts. Usually it's two. Okay? For example, in 2011, Kraft decided to split into two separate businesses. The first one was called Mondelez, which focused on global snacks. Okay? And then the new Kraft was going to focus only on North American grocery business. So they split into snacks and groceries. Okay? When would such a deal make sense? When does a spin-off create shareholder value? When the new Kraft plus Mondelez is worth more than the old Kraft. right? So this, you can see this is a very simple, but at the same time very powerful idea that allows us to really dig deep and think about M&A deals, okay? So now what we need to think about is, when is 2 plus 2 equal 5, right? So why would a merger create value? The first argument we can think of is economies of scale, right? When two companies merge, they become bigger, right? That's what we call scale, right? And when companies become bigger, they may be able to cut cost per unit. They may be able to produce goods at a cheaper price, right? If you produce goods at a cheaper price, your profits are going to go up, right? An economy of scale could be as simple as cutting the cost of management, such as headquarters, okay? So if you put two companies together, suddenly instead of two headquarters, you just need one, right? And that is going to reduce the overall cost of the company. Of course, the idea of economy of scale could be more powerful than just cutting the cost of having two headquarters instead of one. Okay, but this is the first reason why a merger could add value, right? The second one is industry consolidation. This is a very common reason, a very common rationale for a merger, right? This is the idea that merger between competitors in the same industry is going to increase market power, right? If two airlines merge, for example, they can coordinate routes, right? They can give more options to consumers on one hand, but on the other hand, they can cut routes that are repetitive. They can cut routes that both airlines serve, right? And that may allow airlines to charge higher prices, right? And this example is more general. Every time two competitors merge, right, they are going to gain market power. And this is why this type of merger between competitors is a merger that the regulators are always watching, okay? When competitors merge, it's very likely that the regulators are going to have a look at this to make sure that the merger is not increasing monopoly too much, right? Regulators are concerned with consumers and other considerations, so these mergers are watched very closely, okay? The third type of rational motive for a merger is an economy of vertical integration, okay? So in some cases, the merger happens not between two competitors, but between two firms in different stages of production, okay? For example, recently, PepsiCo decided to buy PepsiCo Bottling Company, which used to be a separate company that was essentially doing bottling for PepsiCo. You know, at one point, PepsiCo and PepsiCo Bottling decided that they're going to become part of the same company, okay? Essentially, the idea that bringing a major supplier in-house in some situations, right, not in all situations, but in some situations is going to allow companies to produce at a lower cost and increase profits, okay? And finally, this is a rationale that is particularly important for private equity deals, for leverage buyouts, which is to eliminate inefficiencies, okay? Such as poor management. Poor management is a good example. If a company is poorly managed, right, if it has governance issues, as we discussed in Module 1, right, if the management is not acting in the interest of the shareholders, if the management is stealing resources from the company, that company is going to be a good target for an M&A deal, right? There is some value to be made just by coming in, buying the company, and reorganizing the management, okay? So we're going to talk more about that when we discuss private equity deals. And we also want to talk about some reasons for mergers that make less sense, okay? There are several arguments that are discussed in the press, that are discussed by some practitioners, that actually, when you really dig deep and think about them, they don't make that much sense, okay? The first one is cash, right? The argument goes as follows. So we know that companies hold cash. Some companies actually hold a lot of cash, as we discussed in Module 1, right? And cash earns very low returns, right? So typically, cash is deposited in banks, right? Companies buy treasuries. The interest rate on these instruments is very low, right? So let's say that cash is earning 1%, right? And if a company has a lot of cash, if a company has excess cash, it seems that acquiring another company must be a better use, right? You know, your cost of capital, it seems like it's just 1%, right? So, you know, you just have to generate a return greater than 1% for this acquisition to make sense, right? The argument seems sensible, but when you really think about it, it doesn't work, okay? In fact, there is a very famous academic study by a guy called Jared Harford. It's an old study, but which has been replicated and validated using more recent data, which shows that cash can create problems in the acquisition market, okay? Cash-rich companies were more likely to acquire, so having cash, tempts companies, makes them more likely to go out and make acquisitions. But what Harford finds is that these acquisitions were much more likely to destroy shareholder value than acquisitions that were done by companies with less cash, okay? He actually estimates that cash-rich acquirers destroyed 7 cents in value for each dollar of excess cash that they had. So if you had $1 of excess cash and you spend that in an acquisition, you ended up destroying 7 cents, okay? Just by using that cash to acquire another company, okay? Right? When you really think about this, why is that a bad idea, okay? What should matter is whether the merger generates synergies, right? Going back to where we started with, right? What matters is whether the merger is positive NPV or not, okay? And if a merger adds value, then, companies should be able to finance it, right? Even if you don't have cash to pay for the merger, right? You can go to the market, you can issue a bond, you can issue stock, okay? If the merger is good enough, you're going to be able to add value, okay? The lesson here is that, spending cash just because you have it is a recipe for disaster, right? I think we know that when we think about our personal lives, we know that, sometimes when we have too much cash, we end up wasting it. It seems that the same thing happens with companies, okay? When they have too much cash, in some cases, they end up wasting it, and M&A is a good candidate for that, okay? The other argument we're going to talk about is risk diversification, okay? There are companies around the world that have businesses in many unrelated industries. Those companies are called conglomerates, okay? For example, in the US, a very famous company is called General Electric. General Electric makes aircraft engines, as you can see there on that airplane. They also had a bank until recently. They make other products. They're what we call a diversified company, okay? So let's think about their argument. Does that make sense? So should a company buy another company in a different industry, right? Let's say, should a bank buy a company that makes aircraft engines to reduce risk, right? So shareholders care about risk. So if you buy a company in a different industry, you might reduce risks for shareholders, right? Does that argument make sense? The answer is no, okay? And why? Because shareholders can diversify risks on their own, right? If shareholders want to have stock both in a bank and in a company that makes engines, they can go out in the market and buy the stock. They don't need the company to do it for them, okay? So it's very unlikely that companies can create value just by diversifying a business like that, okay? In fact, the current trend in the US and in other parts of the world as well is towards focus, okay? Conglomerates such as General Electric are actually being broken up, okay? This is a recent news article that talks about the fact that GE is actually retreating from finance, okay? They are reorganizing the business and spinning off GE Capital, which is the bank, okay? And focusing more on the manufacturing operations. And that's just an example. It's a very general trend in the US that companies are actually increasing focus rather than increasing conglomeration, okay? So perhaps companies finally realize that diversifying risks for shareholders may not make that much sense, okay? And finally, let's talk about earnings per share, okay? So there's going to be a question for you, okay? So let's have a look at this example here. Suppose that you have two firms, two companies, okay? And company A is going to acquire company B, okay? So here you have the earnings, the number of shares outstanding, right? So pay attention here, okay? Earnings. So company A has earnings of 100, company B has earnings of 40, okay? And here you have the data for the merged firm, okay? So here's what, the third column tells you what's going to happen after the two companies merge together. Okay? So let's say this merger is stock financed. We're going to talk more about that later, but essentially what this means is that the new company is going to have a number of shares for the new company is going to be the sum of the number of shares for firm A and the number of shares for firm B. Okay? So the question I want to think about using this data is this a value-enhancing merger, right? Are there synergies here? Is this merger creating value for the shareholders of firm A? Okay? The answer is no. Okay? Look at this. This is a classic 2 + 2 = 4 case, right? If you look at the data, right, you can see that earnings were 100 for firm A, earnings are 40 for firm B. Okay? When you put the two firms together, the profits are 140, so you're just adding the profits. It's as if the firms were operating side by side. There is no gain, there is no synergy. At least it looks like there is no synergy. What does happen, and this is what might have tricked some people into thinking that this is a good merger, is that earnings per share is going up, right? So earnings go up to 140, the number of shares go up to 120 as we discussed, so earnings per share is going up, right? For the acquirer, firm A is the acquirer here, so it seems that firm A can increase EPS by 17% just by acquiring firm B. Okay? What is going on? I like to think this as an averaging effect. It's a weighted averaging effect. Okay? What's happening here is that a company with low EPS is acquiring another company with high EPS. Okay? So if a company with low EPS acquires another one with higher EPS, the EPS is going to go up because the EPS is going to become the average of the two companies. Okay? That's not very, companies should not create value just by doing a transaction like that. So this is another example of why earnings per share is the wrong metric to look at. Okay? And this actually goes back to Model 1 when we talked about EPS. Remember, there was a recent deal that we talked about where EPS was going to go down, but the deal was well received by the market. The stock price went up. Okay? In that case, as we discussed, the market seems to be able to overlook the fact that EPS is decreasing and increased the market value of the acquirer when the deal was announced. Okay? So remember that M&A is another area where we have to be very careful about earnings per share. What is the value of synergies? Okay, we just talked about the concept of synergies, but to price, to understand M&A in the real world, we also need to place a value on synergies. Okay, we have to find the dollar value, and what you're going to learn now is that doing this is just doing an NPV calculation. Okay, so it's going to be very familiar for you because it's exactly what we covered in Module 3, right? We learned how to do an NPV calculation, and that's the same thing we're going to do here to place a value on synergies. Okay? What we'll do is forecast cash flows from anticipated synergies, so you can think of those as the incremental cash flows from the merger, and then we're going to compute the NPV of the synergies by discounting, right? We're going to discount the incremental cash flows using an appropriate discount rate, right? So it's exactly the way we've done NPV calculations in Module 3, right? What I want to do is to use a deal that happened in the past, right? It's a relatively old deal, but it's a great one for us because we have very detailed data on management's forecast of synergies, right? Which is the merger between Hewlett-Packard and Compaq. So these two companies were in the computer business, okay? And what happened is that at that year, HP decided to acquire Compaq, right? So the merger was announced in September 2001, and it was completed in 2002. And at the time of the merger, the management gave to analysts a lot of details about where the synergies were going to come from, so we can use those numbers to try to figure out what is the NPV of the synergy in this case. Okay, so you have an article here that talks about this data, but what I've done is I pulled it out for you and am describing it here. Okay, so this is the data that we have. So what management talked about during that time was that there were going to be major cost savings. Okay, as we just discussed, in some cases mergers can allow companies to reduce costs. Okay, there were going to be major cost savings and improved profitability as a result of that. Okay, specifically, management was projecting a recurring annual pre-tax cost saving of $2.5 billion starting in mid-2004. That's very common, right? It takes time for a merger to be completed. Companies have to be reorganized, right? Typically, when management talk about synergy, what you'll see is that they will give a company some time to realize those synergies. Okay? So these cost reductions in the case of HP Compaq were going to come from reduction in the administrative costs. As we just discussed, administrative management costs is typically a good source of synergies when there is a merger, but also through other sources like R&D efficiency, marketing efficiency, the companies were going to become more efficient and hopefully reduce costs. Okay? But another very common effect of a merger is the erosion of sales. Think about this. Those are two companies in the same business. They used to be competitors, right? They are merging together. Some of the sales are going to go, right? They sell similar products. It's natural to expect that sales are going to go down a bit. In this case, actually, the expectation was that there was going to be a significant reduction on sales of $4.1 billion, again, starting in 2004, okay? So here you have the profit margin as well, which we're going to use to compute the value of synergy. You have some other data here as well that we're going to use later. Okay, discount rates, tax rates, and the rate of growth of the synergies. Okay, so let's go back here. Okay, and think about the how we're going to use these numbers. Okay, so we have the loss synergy here in 2004, right? And then we have to figure out what is the impact of this decreased revenue in the profits. Okay? So revenues are going to go down by 4.1 billion, but think about this. This is coming from a decrease, from a reduction in the sale of computers, right? So the company is selling less. That means that costs are going to go down as well, right? So the impact on the bottom line is going to be equal to the profit margin of 12% times the decrease in revenue. So this is the profit margin. Okay, so what's going to happen in this case is that profits are going to go down by 0.5 billion. Okay, and then we have the annual synergy, which starts in 2004, coming from the reduction in costs, right? That's 2.5 billion directly from the management estimate. So the total synergy cash flow is going to be 2.5 billion minus 0.5. So the company is going to realize an annual cash flow of 2 billion starting in 2004. Okay? So the question now that I want you to work with is, what is the net present value of the synergy? Okay? You have the cash flows, you know when the synergies start, and remember, this is just a regular NPV problem. Okay? And you should know how to work this out, so spend some time and try to figure out this problem on your own. Okay, so let's solve this problem. Here you have the data that you need, the cost savings, the reduction in revenue, right? So you have the annual synergy of 2 billion starting in 2004. We are taxing it because it's a before tax value, right? So the after-tax synergy is 1.48 billion, okay? But that only starts in 2004, right? So what you need to do to solve this problem is to apply the perpetuity formula, right? You have a cash flow of 1.48 billion, right? We're going to use the growing perpetuity formula, okay? which we learned in Module 3, because this cash flow is going to continue growing into the future at a 3% rate, right? The discount rate is 12%. So you apply the growing perpetuity formula, and as we learned in Module 3, this value is going to come here to 2003, right? If the cash flow starts in 2004 and you use the growing perpetuity formula, the value is going to go to 2003. With that, you can compute the NPV, right? So here you have the solution for you, okay? You have the growing perpetuity here, okay? And then we are discounting it back for 2 years, right? Because we have to bring it from 2003 to 2001, okay? So what we end up with is a net present value of the synergies that is equal to $13 billion, okay? So what is the idea? The idea is that this merger between HP and Compaq, according to the management, was creating $13 billion of synergy, okay? How are we going to use that? As you're going to learn now, we're going to use the valuation of the synergies to come up with a deal price, okay? What you learn is that there is a very close link between the value of the synergies and the offer price that HP can make to Compaq, okay? So here are some more data for you, okay? This is how much the companies were worth before the deal was announced. HP's market value was $45.8 billion, okay? Compaq was $20.85 billion. You have stock prices and shares outstanding as well, okay? So the question is, how much should HP pay for Compaq? Okay, given the synergy, given the value of Compaq, how much should HP pay? Okay? Think about what we learned. The value of the synergies is the total NPV of the deal, right? In this case, the deal is creating $13.1 billion in value, right? This NPV, this is the total value, right? And now we have two companies, okay? This is a difference between a new investment and an acquisition. This is the total NPV. The NPV has to be divided between the acquirer and the target, right? So let's think about that. What would be the NPV for the target, right? The NPV for the target is just going to be the deal premium, right? Is the offer price, is how much they get, right? So if you're a Compaq shareholder, you're going to get the price for your shares minus your current value, okay? That's going to be your NPV. The NPV for the acquirer is going to be what? It's going to be the synergy minus the deal premium, right? You're paying a premium for the target, but then you're going to get the synergy, right? Because you're buying this target company, okay? So here's a key relationship. For a deal to be positive NPV for the acquirer, the synergy has to be bigger than the premium, right? So the acquirer is going to pay a premium, you're going to get the synergy, right? So if the synergy is lower than the premium, the deal is going to be negative NPV, right? Even if the deal creates value, even if the deal reduces costs, generates synergies, the acquirer has to make sure that you're not overpaying, okay? And notice that when we look at data, the average premium that is paid for public targets is very high. It's approximately 30%, okay? So it has to be the case that M&A deals have to generate large synergies to make sense, right? Because you're paying on average 30% premium, so the value of the synergy has to be very significant, otherwise the acquirer would not make money, right? So here's another question for you. How much should HP offer to Compaq, okay, given what we just learned? Here's the answer, right? We came up with the value of synergies. This is what our valuation allowed us to do, is to figure out that the synergies were worth $13.1 billion, okay? So it must be, right? So then it must be the case that this premium that HP is going to pay for Compaq has to be lower than the value of the synergies, right? Compaq was worth $21 billion before that, okay? So the Compaq shareholders are not going to accept less than $21 billion. It has to be more than that, right? But it has to be lower than 20.9 plus 13.1, right? So the maximum value that HP can pay for Compaq is that sum, which in this case is $34 billion, right? If HP pays more than that, then you cannot generate value for your shareholders, right? Of course, Compaq shareholders are going to be happy, but the shareholders of Hewlett-Packard will not. Let's talk now about how to pay for a deal, okay? We talked about synergies, we talked about how to value synergies, and we talked about how to price a deal given the synergies. But now what we're going to learn is that acquirers can choose to pay either cash or stock, okay? So deals are not necessarily paid off with cash, as in this picture. In sometimes what the target is going to get is stock in the merged company. So now what we're going to figure out is what the key difference is. Okay? Let's go back to HP Compaq. Okay? Suppose that the final price is 27. We just figured out that the price had to be between 21 and 34, okay, given our valuation of synergies. So let's say the price was 27. I'm going to show you in a second what the price actually was. Okay? Let's say for now it was 27. Compaq had $1.7 billion outstanding approximately. So if you do the math, this is going to represent $16 a share. Okay? So think about this. If you're paying cash, you're going to pay $16 a share. What happens? HP takes cash out of its pocket, okay, and gives to Compaq shareholders, right? Compaq shareholders give their shares to HP, and they get $16 in cash. Okay, so paying cash is extremely simple. We wouldn't even need to be talking about it if there wasn't another way to pay for a deal. So really the most interesting thing that we have to learn here is that in some cases, companies are paying with stock. Okay? How does this work? It's actually an issuance. Okay? It's a stock issuance. What HP is going to do is to issue new shares, okay, and give the shares to Compaq shareholders in exchange for Compaq shares. So Compaq disappears, of course, right? Compaq is going to disappear, so the shares of Compaq disappear. In exchange for the shares of Compaq, the shareholders of Compaq are going to get shares of HP, and of course HP is going to become the new merged firm. Okay? A key variable in a stock merger is what we think of, what we call the exchange ratio. Okay? What is the exchange ratio? The exchange ratio is the number of shares of the acquirer that each target shareholder receives. So in this case, it's the number of shares of Hewlett-Packard that each Compaq shareholder is going to receive. Right? That's how HP is going to pay for the deal. Okay? What should be the exchange ratio then? Right? What is the exchange ratio? Let's go back to our $16 number. Okay? Let's say that the final price is $27 billion. And let's say then that HP is paying $16 a share, right? If you think about the math, for a Compaq shareholder to get $16, you have, and remember what you're going to get is you're going to get HP stock, okay? So the exchange ratio, right, the number of shares that you're getting, okay, times the HP stock price has to equal $16, okay? So let's see how the math works, right? Notice that to do this calculation, we have to make an assumption about the stock price, right? As we're going to see next, and I think we talked about this in the course already in Module 1, the stock market is going to react to the deal, right? But let's say that we use HP's pre-deal stock price to do this calculation, okay? We already learned that HP's pre-deal stock price was $23.21, okay? So, right? The way the math works here is that, if you want to get $16, you have to divide 16 by 23.21, right? And this is how you would compute the exchange ratio, okay? What does this mean, right? It means that if you own 10 shares of Compaq, okay, and then the deal is financed with stock, you would receive 6.9 shares of HP. Okay, that's what the math comes up to. Okay, it's a 0.69 exchange ratio. Okay, so if you own 100 shares of Compaq, just to make the number round, you would receive 69 shares of Hewlett-Packard. Okay, this particular merger was financed. Well, it actually happened to be financed by stock, so HP didn't use cash at all. Okay, and the exchange ratio was 0.6325. So it's not too far from what we computed. Right? So if a Compaq shareholder had 1,000 shares of Compaq, you got 632.5 shares. Okay? And then, of course, there are legal ways to deal with these decimals. Okay? So that's how HP actually paid for Compaq. And here comes something really interesting. We saw this graph already in Module 1. Okay? What happened when HP announced this deal, okay, the stock market reacted immediately, right? On September 5th of 2001, the stock market reacted to this deal, and actually what the market did is it sent HP's stock price down by 23 minus 18 by $5 a share. Okay, used to be 23. In the day after it started trading, after the deal was announced, HP's stock price went down to 18. Okay, so the deal was very poorly received by the market. Okay. And remember, Compaq shareholders are paid in stock. So what they are getting is stock. So let's try to figure out how much was HP's offer worth following the market reaction. Think about this. The actual value of the offer after the announcement was much lower, right? Instead of 23, okay, you have 18 here. The exchange ratio is still the same. Okay, so what Compaq shareholders are getting is actually 11.4, right? Compaq's stock price prior to the deal was 12.35, okay? So it really didn't make much sense, right? At that point, right, what should have happened to Compaq's stock price? After the deal was announced, Compaq's stock price should have gone down as well, right? Which is exactly what happened. The deal was announced at this exchange ratio. The market hated the deal so much that even the stock price of the target went down in this case. Okay? So Compaq's stock price also decreased. And the surprising thing in this deal is that the Compaq management actually managed to convince the shareholders that the market reaction was to be ignored. Okay? So the opposition to this deal actually came from within Hewlett-Packard rather than from Compaq shareholders. Okay? And this is an example that we can generalize, okay? And we can think about, what happens when mergers are announced. In the general, we have evidence about that in the finance literature, okay? M&A deals are very interesting because they give us a chance to look at how the market reacts, right? This is what we just did. We're thinking about HP Compaq. There was a management forecast, the synergies and all that, but then, the market is going to do its own calculation, right? And it's obvious that if the merger is positive NPV for the acquirer, as we already learned in this course, then stock prices should go up, right? If the merger is positive NPV for the target, which in the case of Compaq it wasn't that clear, right? Stock price of the target should go up. So let's see what happens on average, okay? So this is a graph that comes from a famous research paper on M&A deals, okay? What it's showing is that the stock price reaction for target companies, okay? So when a deal is announced, this is what happens on average to the stock price of a target, okay? Targets end up earning a significant premium on average, right? So when a deal is announced, the stock price of the target shoots up by, here you have a number between 15 and 20%, okay? So stock prices of targets are going up significantly. Notice also that there is a little bit of a trend here before the deal is announced. Of course, what happens in the real world is that in some cases there are rumors that ends up trickling to the market. So the target stock price may end up reacting a little bit before the deal is announced. Okay, that's why this graph starts, a few days earlier. It's not just a 3-day announcement return or a 1-day announcement return as we did with HP Compaq. Okay. What about acquirers? Acquirers actually, what you see is a flat line on average. Okay? So the acquired stock price on average doesn't seem to increase when a new M&A deal is announced. Okay? Of course, that doesn't mean that all deals are zero NPV, but on average, that's what we find. Okay? The bottom line is that what the research seems to suggest is that on average, mergers create value, but most of the value ends up going to the target firm. Okay? Right? So remember our discussion about synergies and premium, right? What this means is that mergers do generate synergies, right? So targets get, you know, a very high NPV if you want, right? Because their stock price is going up by 20% on average, but the acquirer end up paying too much. Okay, so all the premium goes to the target, and none of the premium stays with the acquirer on average, of course, right? So that's what the evidence shows. You know, so the negative reaction that happened to Hewlett-Packard is a little bit extreme, but there are many deals that are actually not successful for acquirers, at least in the short term. Okay? Of course, that, you know, the short-term stock price reaction may not be right, as we discussed already. You know, in the course, the market is trying to do this calculation, trying to figure out what's going to happen in the future, right? Is this deal going to add value or not? And you know, this is a very hard calculation to do, right? It's possible that the management was right, okay? Compaq, the management actually liked this deal. They wanted to be acquired by HP. They managed to convince the shareholders to go along, okay? So what can we do to try to figure out, right? The first thing you might be thinking is that we can try to look at long-term stock price reactions. Instead of just looking at the short term, how the market reacts immediately to a deal, let's try to see what happens in the long term. Okay? We can certainly do that. This is what you have here in this graph. Okay? So the deal, this is 2001 here at the left corner. So that's when the deal was announced. And here the blue line is HP. Okay? And then you have two other companies that you to compare the stock prices to. Actually, the red line is an index. This is the S&P 500 index. Okay? And here in the bottom, you have IBM. Okay? If you read the management description of the HP Compaq merger, they were mostly concerned with IBM and Dell. Those were the main competitors of HP at that time. Okay? So what do we see here? Right? This is 2002, you know, up to 2007. Okay? It seems that HP actually did pretty well, right? When you look at this on the face of it, right? HP did significantly better than the competitor. Okay? It seems that HP did pretty well in the years following the merger. Okay? Of course, you know, there is a problem with doing long-term stock price reactions. You know, it's very difficult to find a good comparison, right? What we would like to see is, you know, suppose the deal had never happened. Suppose HP had not acquired Compaq. Okay, what would have happened to HP's stock price? But that will, you know, this we will never know. Okay, right? So the only thing we can do is to compare to competitors, compare to the market. You know, in this case, it seems that at least there is no evidence that the merger was destroying value if we're looking 6-7 years ahead. Okay. We can also do qualitative analysis to think about this deal. So here I have two articles for you. Okay? The first one is from Fortune. Okay? And the article was actually about the fact that the deal was failing. Okay? So you can read here, you know, buying Compaq has not paid off for HP investors, not by a long shot. Okay? Which seems to be a little bit inconsistent with the stock price chart that you just saw. And you know, we can also find an article that says that the merger worked. Okay, this is the merger that worked, HP and Compaq. Okay, and you know, this article is talking precisely about the fact that this deal was very poorly received by the market, but in the long term, it ended up creating shareholder value. The bottom line is that, you know, we never know. Okay. This is a big problem with M&A research and trying to understand M&A in the real world, is that it's very difficult for outside observers and sometimes even for management to figure out if a deal worked in the long term or not. So sometimes, you know, in most cases, you have to rely on your intuition, and you have to you know, you can of course observe the short-term market reaction, but the long-term market reaction and this qualitative reaction to the deal is a little bit harder to interpret. Let's talk now about leverage buyouts. That's the second major type of M&A deal that we're going to discuss in this course. Okay? The first thing we're going to think about is how is a leverage buyout different from a merger between two companies, right? There are three specific facts about LBOs. The first one is that the payment is always in cash and typically financed by debt issuance. Okay? So that's where the leverage in the name LBO comes from. Right? So we saw in the HP Compaq deal that we just analyzed, for example, HP paid for the deal using stock, so Compaq shareholders got stock. In an LBO, the target shareholders are typically paid in cash, almost always. Okay? The second specific fact is that it's a case when a public firm is usually taken private. What that means is that all the shares outstanding of the target are bought out. That's where the buyout in the name comes from. And the third specific fact is that the acquirer in this case is not another company, is not a competitor, is not a company in a different stage of production. The acquirer in this case is an investment company. It's a company that invests money rather than produce something. Okay? And in this case, in the case of leverage buyouts, we call these investment companies private equity firms. Okay? So this is a structure of a private equity partnership, a typical structure. Okay, you have the private equity firm that is managed by the general partner. The general partner is going to be the people who are actually managing the companies, and then you have the limited partners that are providing capital to the private equity fund, and then the private equity fund is going to have a portfolio of investments. Okay, just listing the main characteristics of the private equity partnership here. So we have the general partners. Those are the people who identify investments and manage them. And then we have the people who provide capital. Okay, so that's going to be equity capital. There's going to be investments made by the limited partners in this company. And then what the general partners do is to use this equity capital to go out, buy companies, and try to make money. Okay? Of course, the general partners are going to make money as well. And the way that this happens is through this 2-20 fee structure. So the general partners keep 2% of the invested capital and 20% of profits. What that means is that, for example, if the limited partners provide $1 billion of equity to the private equity fund, the general partners get to keep 2% of that billion annually as a fee just to manage the fund. Okay, so of course there are big dollars involved here, and then the profits, this 20% of profits, that happens when the private equity fund has a successful deal, creates value. The general partners keep 20% of the profit. Okay, so that's how the partnership is organized. And when you look at the world these days, there are many famous, well-known companies that are managed by private equity funds. That's why it's important for us to talk about leverage buyout. Okay, companies like Dell, the computer company, Budweiser that makes beer, right, have gone through LBOs very recently and are now managed by private equity firms. Okay, so these are companies that now are private. You're not going to find data on stock prices for these companies, right? And they happen to be managed by these private equity partnerships. Okay, so let's actually give an example of the leverage buyout of Dell. Okay, so that's how a leverage buyout will work in terms of the numbers. Prior to the announcement, in January of 2013, Dell was trading at $11 a share. Okay? And if you know something about Dell, you will know that Dell was actually founded by a guy called Michael Dell, okay, who was the founder, and it's still the CEO of the company. He's still the manager of the company. At that time, he owned 15% of the company's share. Right? He had a very large ownership of Dell even before the leverage buyout happened. Okay? The total equity value of the company was $19.3 billion, and debt was $7 billion. So that was the capital structure of the company right before the leverage buyout was announced. Okay? And then you know, Michael Dell came with this proposal together with Silver Lake, which is the private equity fund involved in this deal, to buy out all the outstanding shares, right, other than Michael's. So Michael was going to keep, you know, he was going to remain as the manager and owner of the company, but all the other shareholders were going to be bought out at a 25% premium. Okay, so the offer was $13.65 to the other shareholders. And we can do the math here, right? Dell had 1.757 billion shares outstanding. So if you check this, the financing this deal required $20.4 billion. Okay, because it's 85. They only had to repurchase 85% of the shares, right? You have 1.75 billion shares outstanding, and you're making an offer of 13.65. So that requires them to raise $24 billion. Okay? So every time a leverage buyout happens, raising the capital is a big issue, right? And these are big dollars. And remember, the private equity fund cannot use stock to pay for this for this deal. They are usually private, so there's no stock to use, right? So how does the private equity fund finance the deal? With a debt issuance, right? That's the leverage, the leveraging the leverage buyout name. In this case, there was a new debt issuance of $15 billion, okay, that was provided by banks. And an interesting fact in this LBO is that Microsoft actually helped provide some of the financing as well, okay, some of the debt. So Microsoft invested in the debt that helped finance this deal. So they raised $15 billion of debt, and then Michael Dell raised, also put in some of his own cash, okay? At that time, if you read about this deal, Michael Dell was being questioned about, you know, is this really a good deal for shareholders? Is this going to work? So one way that he solved this problem is by, you know, paying with his own pocket. Okay, so put your money where your mouth is, right? And he actually took $750 million to pay for this deal. Silver Lake also put cash, of course. That's the equity. Remember, that's private equity. Silver Lake has equity that comes from the limited partners. They invested $1.4 billion in this deal. Okay, and then the balance was funded with the company's own cash. This is the analysis of how the company's financial structure changed with the leverage buyout. So here you have a simplified balance sheet that has debt, equity, and assets, both pre-leverage buyout and post-leverage buyout. Right? So as you saw in the data, before the leverage buyout, Dell had $7 billion in the debt and $19.3 billion in equity. So using this simplified balance sheet, you just add debt and equity to get to assets. So that means Dell has $26.3 billion in assets before the leverage buyout happened. What happens after the leverage buyout? The first thing to notice is that there is a significant increase in debt, right? So debt is going to go from 7 to 22 because the company is issuing an additional $15 billion in debt to finance the leverage buyout. So the private equity fund is issuing an additional $15 billion of debt that Dell is actually responsible to pay after the leverage buyout. That is supported by the assets of Dell. So this is added here to the balance sheet. So that is going from 7 to 22. What else is going to happen? Notice that there is a premium, right? So as the example tells you, the private equity fund and Michael Dell are paying a premium of 25% on the equity. That means that the value of the asset has to go up by that amount, right? So they are revaluing the company by paying this premium. It's a premium over the equity. So the way to add that to the assets is to recalculate the asset value, adding this premium, which is 25% times 19.3, the pre-LBO equity value, right? So 26.3 plus this premium comes out to $31 billion. So that should be the post-LBO. It's an estimate, right, of the post-leverage buyout asset value of Dell, What that means then is that if you have $31 billion in assets and $22 billion in debt, then you're going to have an equity value of $9 billion. Notice then that there is a significant increase in leverage, right? So if you compute the leverage here of the company, as we learned in Module 1, you'll see that leverage is going to go up a lot, right? It goes up from like around 30% to about 70%, even with this added premium. The other issue to note is that the equity went down significantly in dollar value, right? But this new equity is owned only by Michael Dell and Silver Lake. So you've bought out all the shareholders, right? You repurchase all the shares that were trading in the market. All the remaining equity is now owned by Michael Dell and Silver Lake. And so we come to a very important question in the discussion of leverage buyouts. So if you think about the example we just talked about, right, what we saw is that the asset value is increasing. For some reason, you know, the enterprise value of Dell is going up. The company is becoming more valuable, almost 20%. And if you think that this is strange, it actually is not. There is a lot of research in corporate finance that says that that's pretty common. Right? The average premium paid to target shareholders during the period of 1973 to 2006 is approximately 37% for private equity deals. So the median is 32, so it's very common to see premium of 20, 30%, etc. So that's standard in a leverage buyout. One way to think about this is the existing shareholders are really not going to sell the shares if the private equity fund cannot pay a significant premium, you know, very similar to an M&A deal. But here's the question. Where is this value gain coming from? Are there synergies in leverage buyouts, just like we discussed in merger and acquisitions, or is there something else going on? So here's a question for you to think about. And the answer is maybe, right? Notice that here there's no acquirer. That is the interesting fact about leverage buyouts. The acquirer is an investment company, is the private equity fund. Okay? So many of the rationales that we discussed do not exist for a leverage buyout, right? So increasing market power, vertical integration, right, are going to be hard to achieve because the acquirer is not in the same business. The acquirer is just an investment company, just an investment fund. Okay? So how can we have 2 plus 2 equal 5? Right? How can we have 2 plus 2 equal 5? These are the usual reasons that are cited. So if you ask private equity funds, if you read the literature, those are the reasons why we believe leverage buyouts may add shareholder value. Okay? Since there are no synergies, you know, real synergies between two companies, it has to come from some kind of restructuring. Okay? So the private equity fund either has to increase efficiency in the short term, right? So increase the operational performance of the firm by cutting costs a lot, right? So you cannot rely on economies of scale, for example, so you have to go there and really restructure this firm and cut costs. Or else, you know, you can try to engage in a longer term restructuring, a major change in strategy that might make sense in the long term, but may be difficult to do under the scrutiny of public markets. Okay? So if you read about Dell leverage buyout, that's actually the reason that was given to this particular deal, is that Dell wanted to engage in long-term restructuring to move away from just selling computers and engage in a different long-term strategy, but that would be difficult to do if you have to report earnings to public markets on a quarterly basis. Okay? So that is actually the specific rationale for the Dell for this specific buyout. And then finally, the other reason why leverage buyouts may add value is because in some cases the acquirer may be able to buy cheap assets. Okay? And here it's interesting to think about Warren Buffett, which, if you think about Berkshire Hathaway, which is Warren Buffett's company, it's a very famous investment company in the US, they work a little bit like a private equity fund, right? Not all deals are financed by leverage, but really what Warren Buffett does is to find companies to buy and in many cases not even change anything with the management, So in order for Berkshire Hathaway to make money, you have to buy undervalued assets. Okay, so buying cheap assets is another way that private equity funds can make money, right? Because private equity relies on all this restructuring, a very important question that has been discussed recently is whether private equity is actually good for the economy or not, okay? And when you look at the evidence, what you see is that cutting costs, in many cases, is actually equivalent to firing people. So it looks like, when you look at employment and private equity, it looks like employment goes down a lot when companies are acquired by private equity funds. There's usually layoffs, and as part of this restructuring to increase short-term profits, there is usually significant amount of layoffs. Okay, so there is a very interesting recent article that looked at this issue. Okay, by these authors here at the bottom from the University of Chicago. What they try to measure is what happens to employment following leverage buyouts using U.S. data. So this article uses data from the U.S. Okay. So, and what you can see here, the blue line is the employment trajectory for companies that are acquired by private equity firms. Okay? So you can see that employment was going up. Date 0 here is the date of the leverage buyout. What happens is that there is a significant decline in employment. Okay? But the interesting thing that this article did is to build what we think of as a control group. Okay? Try to think of a similar company that looked similar to companies that were acquired by private equity, but which did not go through a leverage buyout acquisition. And what you see in this chart is that employment also went down for those companies. Okay? So the bottom line really, when you think about this, is that, you know, employment does go down for companies that are acquired by private equity, but maybe they would have gone down anyway. Okay? It's the characteristic of the companies that are acquired by private equity that explains the drop in employment and not necessarily the acquisition itself. Okay? The other fact that this paper found is that, you know, this fall in employment is partly compensated by job growth in new establishments. Okay? So there is also this long-term restructuring aspect to leverage buyouts. So what they find is that if you look at a longer term, like 2 or 3 years, you see that private equity funds also create new establishments and then end up hiring people as well. The total net effect is a small decline. It is a less than 1% decline in employment relative to these control firms. Okay? So the bottom line of this article is this idea that, you know, perhaps private equity is not that bad for employment, and we may have been exaggerating this argument a little bit. Okay? Finally, let's go back to the Dell leverage buyout. Okay? When we studied HP Compaq, we tried to look at stock prices, right? What happened to HP stock prices in the years following the deal? Unfortunately, we cannot do this for Dell, right? Why? Because the company is private now, right? So if you go to Yahoo Finance and try to find data on the stock price of Dell, the data is going to stop in 2013. Because the company is private, the company is not trading in stock markets anymore. Okay? So the only thing we can do here is to look at the qualitative evidence, right? And here, so far, the qualitative evidence seems to be quite positive. Okay? So this is a recent article that I found, which, you know, is based on data that we cannot verify, but what the article claims is that Dell and Silver Lake already gained made a value gain of 90% only a year after the leverage buyout. Okay? Due to increase in cash flows, due to increase in performance, they actually made a bunch already. Okay? So that particular leverage buyout seems to be working well for the company. In the calculations that we've done in this course so far, it always seemed that we knew the right forecasts, right? When we were computing net present value, for example, we were analyzing investment decisions, we were starting from cash flows, right? And in our calculations, it always seemed that we knew what the cash flows were going to be in the future, right? When we were analyzing acquisitions, it seemed that we knew what the cost savings would be, for example. When a company acquired another company, we computed the net present value of the synergies, assuming that we knew what the cost savings would be in future years. Okay? The truth is that in the real world, we don't really know, right? There is uncertainty. There is fundamental uncertainty about what the cash flow forecasts are going to be. Cost savings, revenue increases, right? All of these numbers are going to be based on forecasts. So a very important part of valuation analysis is to learn how we deal with uncertainty. Okay? What do we do when we recognize that we actually don't know what the forecasts are? Okay, so that's our topic now. It is a very important, very fundamental topic in corporate finance. The truth is that the assumption we've been working so far is not really that we knew the forecast. That's what we're going to learn now. Really what we were doing is we were using the expected value. Okay? All the numbers in our timelines, in our valuations, in our acquisition analysis, they represented expected values. Okay? So in this lecture, we are going to learn what an expected value means. Okay? The idea is that we were using averages. We were trying to work with our best guess of what that number would be in the future. Okay? This is going to be true for all the model parameters we worked with. Cost savings, revenue increases, future investments, right? We were always trying to forecast, to calculate this average value. Okay? So our goal now is to learn how we deal with uncertainty. The uncertainty is going to become more explicit when we think about investments, and we're going to talk about how we incorporate this uncertainty into our valuation exercise. Okay? So the way I want to start is by actually going back to an example we talked about in Module 3. Okay? This is one of the project valuation analyses that we did. We had an example where there was an initial investment. The project was going to increase revenues and increase costs as well, right? There's some depreciation, all the numbers that you need to calculate the net present value of the project. Okay, so in particular, we had forecasts about how much revenue the project is going to add in the next 10 years. Okay, so now what I want us to recognize is that every time a company is doing this type of calculations, the company really doesn't know for sure that the cash flow at time 9, for example, is going to be exactly $6.3 million. Okay? We have to think about uncertainty, which is exactly what we're going to do now. The first thing we need to do is to figure out what we mean by these forecasts. What do we mean by the numbers that we had in our spreadsheets? Okay? And as we discussed already in the introduction, these forecasts should reflect what we think of as the project's most likely scenario. Okay? So for example, when the company was trying to analyze this investment, right, trying to think about this product, the marketing department may have forecasted the added revenues as the product of the market price times the additional sales. Okay, so the added revenues were $12 million because $12,000, right? Because the price was $4 and you're selling 3,000 units, so 4 times 3,000 equals 12,000. Okay, so in the production department was probably responsible for forecasting the costs, right? And the way that the production department probably forecasted the costs is by adding variable costs to fixed costs, right? So the cost per unit times the additional sales plus an amount of fixed costs, right? Every project is going to have some costs that don't depend on the amount that you sell. We call those fixed costs, okay? So this is just to go a little bit deeper on the numbers, right? So now let's think about uncertainty, right? The truth is that the marketing department is making a guess, right? The marketing department is trying to estimate what the most likely value is going to be for the sales, for example. Okay, let's take sales as an example here, right? To make this more explicit, let's work with probabilities. Okay, and the good thing is that at this point we already worked with probabilities in this course, right? So you already know how to do calculations with probabilities. Here is another example, right? Suppose that the chance that sales are actually $3,000 is 20%, okay? But there is also a 20% chance that sales are going to be equal to 1,000, 2,000, 4,000, or 5,000. Okay? So in this case, 1,000 would be the worst case scenario, right? Of course, having lower sales is not going to be good for this project. 5,000 is going to be the best case. Okay? And all the values are equally likely. Okay? So if you think about this problem, okay, the value that we that we used, right, in our evaluation, we used the value of 3,000. Okay? If you do a math here, which should be quite obvious, right, because everything is equally likely, you can compute the average value by multiplying the probabilities times the different possibilities. So 20% times 1,000 plus 20% times 2,000 plus 20% times 3,000 plus 20% times 4,000 plus 20% times 5,000. If you do the math, if it's not obvious to you, which it could, you're going to get exactly 3,000. Okay? So 3,000 is the average of all these different possibilities. There are 5 different possibilities, okay? But the one that we input in our valuation is always the expected value. The number you're going to see in your timeline is always going to be the expected value. Okay? So the first tool we're going to learn to deal with uncertainty is what we think of as sensitivity analysis. We call this sensitivity analysis. The idea is to try to figure out how sensitive the net present value is to fluctuations in these key parameters. Okay? Now we know that we have 5 different possibilities for the sales, and we know how to compute NPV, so it should be fairly straightforward to answer the following question, right? How does the NPV change under these different assumptions? And really, that is the goal of sensitivity analysis. What I will do is I will provide a spreadsheet, okay, that you can use, an Excel spreadsheet that you can use to do the sensitivity analysis, right? We're going to have to change assumptions, and it's really not that convenient to do this by hand on a pencil and paper. You can try, but the best way to do sensitivity analysis is by using a computer and a spreadsheet, okay? And so, for example, we can figure out that if sales are equal to 1,000, NPV is minus 16,900. If sales are equal to 5,000, the NPV is equal to 43,214. So consistent with our intuition, the higher the sales are, the higher the NPV is going to be. Okay? Here is a snapshot from the spreadsheet just for you to see. Like I said, you can get that on the website and use it yourself, right? For example, here what I'm doing is experimenting with the worst case scenario, right? What happens if our additional sales are equal to 1,000 units? This is highlighted in green. And then here in the bottom, you have the NPV and the IRR, the internal rate of return of the project, okay? The spreadsheet computes all the cash flows automatically, and then at the bottom you get the NPV and the IRR, okay? This spreadsheet might be useful for you as well as a kind of a guideline for how you would do project valuation, how would you compute net present value using Excel, okay? So it should be very straightforward to use this. Let us think now about a very important question, a fundamental question really, okay? How should you use the sensitivity analysis, right? So now, rather than having one number for the NPV, we seem to have 5 numbers, right? So it complicates our life. We learned in Module 3 that we should take a project if the net present value is positive. So now we have 5 different NPVs. What should we do, okay? Let me make this question specific. Should you reject the project because the NPV is negative under the worst possible scenario? The answer is no, okay? So you have to be really careful about how you use the sensitivity analysis, right? It's not, you cannot reject the project because the net present value would be negative if the worst possible thing happens, right? This idea sounds wrong, okay? And really, there is a very fundamental concept behind this, which is the idea that, to create value, a company needs to take risks. I think it will be impossible to find an investment that creates true value, that generates shareholder value, but that exposes the company to no risk. Okay? Everything that creates value is going to be risky. Okay? Value creation equals risk. That's the way to think about it. Okay? In terms of net present value, I bet if you're doing this calculation correctly, net present value will always be negative under the most pessimistic assumptions. Okay? So if something goes wrong, your NPV will turn negative. Right? The NPV of the project is still the number we computed in Module 3. There is only one NPV. Okay, so remember this, there is only one NPV. We do not have 5 NPVs. NPV is based on the best possible guess. NPV is based on the expected cash flow. So the NPV is still 13,152. Nothing changed. Okay? So how, if the sensitivity analysis is not changing the NPV, what are we going to use it for, right? That's the question you might have in your mind now. So why are we doing this, right? Okay? One way that you can use the sensitivity analysis is simply by getting more information. More information is better than less information as long as you know how to use it. Okay? It's very useful to know which variables are likely to affect the NPV, right? So for example, we've just learned that sales are a very important variable. Okay? So you have to make sure the marketing department didn't do a crappy job of forecasting sales, right? It's crucial for you to know how much how much you're going to sell. It's kind of an obvious statement, but we've just learned the NPV equivalent of that, right? If sales turn out to be low, the NPV is going to be negative. Okay? So one way that you can use the sensitivity analysis is to show it to the marketing department and then tell them, look, we have to make sure we get this number right, because if the sales is lower than a certain value, our project should not be started. We should not be selling this. Okay? Sensitivity analysis can also be useful for planning purpose, right? We can figure out, for example, what is the minimum level of sales that are required for the project to create value. Okay? And now you have the spreadsheet that I provided, so you can do it yourself. In our case, it turns out that sales have to be larger than 2,125 units. So that is your break-even level of sales. If you sell less than that, right, then the project is no longer positive NPV. Right? So think about that's a very useful number for the company to know, right? So now you can get your sales team, you can have a target for your sales team, right? You can tell the marketing department, look, this is the number that we have to hit. Are we sure we're going to hit? I mean, sure, we're never going to be sure. You see how dangerous it is? We always want to be sure, right? We don't like risk. But the truth is that every time a company takes a project, you are taking risk, right? So anyway, going back here, okay? We know now that our sale has to be larger than 2,125 units, okay? So we can use that for planning purpose. If we find out, 2 years ahead that our sales are not, 3,000, that they are more likely to be 2,000 units, at this point you might want to consider the option to abandon, for example, which is something that we talked about already, right? It might be the correct decision at this point to abandon the project. So you may want to redo the net present value calculation and try to estimate whether you should continue this project or not. Okay? So sensitivity analysis is very useful as long as you know how to use it. Now we have to talk a little bit more about risk, okay? We've just done our sensitivity analysis, right? And it might seem to some of you that the example we just solved suggests that risk is actually not changing the NPV, right? We laid down the risk in the sales of the company, but in the end we decided that the NPV is still the same, right? So it might seem a bit strange, where did risk go, right? Of course, this is wrong, okay? Risk is going to affect the value of a project. we like safety, right? We want projects to be safe. So the higher the risk of the project, the lower the value should be, right? This idea has to be true, right? So what we're going to learn now is how do we incorporate risk into the valuation. The reason why risks is hidden, is because we have been taking the discount rate as given. Okay, that's really the main reason why we haven't found out risk yet in this course. Okay, I've always been telling you the discount rate is 10%, is 8%, is 7%, right? So the idea, and this is a key idea in finance, is that the discount rate should reflect the risk of the project. That is the number that is going to capture risk for us. Okay? So what we're going to talk about now is how do we implement this concept. Okay? To understand this better, let's go back to Module 3 and think about the internal rate of return again, right? What we learned in Module 3 is that if the IRR is bigger than the discount rate, then the NPV is positive. Okay? So you have to compare the IRR of a project with the discount rate. If you're thinking about risk, right, what we're learning now is that the discount rate captures risk. So another way you can think about this statement is that the higher the risk of a project, if a project is more risky, right, then it's going to take a higher rate of return to turn this project into a good project. Okay? So to make a project positive NPV, right, if risk is high, you're going to need a high rate of return. Okay? So that's an intuitive way for you to think about this relationship, right? Measuring risk, it turns out that measuring the risk of a project, measuring the risk of a company, measuring the risk of an investment is one of the key topics in finance. In fact, you spend a lot of your time in an investments course when you study investments rather than corporate finance. A lot of the course is typically devoted to this topic. Okay? What we will do in the next few slides is to do a review. So our course is self-contained, and you know how to incorporate risk into corporate finance valuation. Okay? But if you would like a more in-depth discussion, what I recommend is that you have a look at Scott Weisbanner's investments course, okay, which is also available, and it does have a much more in-depth discussion of how we measure risk in finance, and which really is the same ideas we're going to use here to incorporate risk into corporate finance valuations. Okay? Let me give you the bottom line first, which you might remember if you took Scott's class already. Okay? The way that we're going to measure risk for a company project, for a company, is by using the weighted average cost of capital formula. Okay? If you haven't seen this, it's going to look foreign. If you have, it's going to look familiar. That's why I want to do a review of this, in any way. Even if you took Scott's class, I think it might be useful to do a review and think about the weighted average cost of capital from a corporate finance point of view. Okay? It's the name says it all. The weighted average cost of capital is a weighted average, right? You have the required return on debt, and then you are multiplying this by the fraction of the value of the company that comes from debt. Okay? It's debt over value, where value is defined as debt plus equity. Okay? And then you have the required return on equity multiplied by the fraction of the value of the company that comes from equity. Okay? So the E here is going to be the market value of equity. Okay? So it's just a weighted average. What I want to do in the next few slides is to do an example with you. Okay? And I'm going to use this example to review the key concepts. And as we've been doing in this course so far, I want to use data from a real-world company to do this. Okay? Specifically, what we're going to do is we're going to compute the WACC for PepsiCo as of June 2015. Okay? We need to do this for a certain period of time because, as you just saw the formula, the WACC depends on the value of the company, so we have to measure the value of the company and some of the market data for a specific period of time. But the ideas are the same. You can use the same principle, the same calculation to compute weighted average of capital for any company in any period of time. Okay? Let's start with the required return on debt. The data that we're going to use here is expressed here in this graph. Okay? It's the data on yield to maturities of PepsiCo bonds. Okay? So debt holders in this case, they own bonds, right? PepsiCo has issued bonds. So debt holders now own these bonds, and what bondholders get is the yield to maturity. Okay? So this graph shows the yield to maturity on PepsiCo bonds of different maturities, right? So you can see here the x-axis tells you the years, right? So here at the end, we see that PepsiCo has issued long-term bonds that mature only in 2040. Those bonds have a yield of approximately 4%. Okay? So before we use this data, we have to understand a little bit more about what the yield to maturity is actually measure, right? And it turns out that the yield to maturity is just the expected return on the bond. Okay? So you can think of the yield to maturity on a bond as the return, the percentage return, right? As we discussed in Module 3, the IRR is the percentage return. You can think of the YTM, the yield to maturity, as the percentage return that an investor would hold by holding the PepsiCo bond till maturity. Okay? So if you buy the bond today, okay, and the bond does not default, you expect to make 4.2% a year. And default is an important word here, okay? This calculation only works exactly if the company is far away from bankruptcy. Okay, we're not going to have much time to discuss this in this course, but remember that you can only approximate the required return on debt with the yield to maturity for a company that's far away from bankruptcy. So for PepsiCo, this would be a reasonable assumption. It might not be that reasonable for a company that has a really, really high leverage ratio that is approaching bankruptcy. As we discussed in Module 1, the leverage ratio gets too high, the company is going to go bankrupt. Okay? So really what happens is that if the bond defaults, you're not going to get 4.2%, so the true expected return for a company like that is lower than the yield to maturity. Okay? So here's the question for you. We just figured out that the IRR of the long-term bond is 4.2%. Okay? So you buy if you buy the 2040 PepsiCo bond and hold until maturity, your expected return is 4.2%. Let's think about NPV, right? That's the question. What should be the NPV of this investment? The NPV should be 0. Okay? The 0 NPV idea, as we discussed in Module 3, will turn out to be a very powerful, a very important idea in corporate finance, or in finance in general. Okay? It might seem strange, right? Why is the NPV 0? Right? We haven't done any calculation. I just showed you how to do calculations, spreadsheets, formulas. How do I know the NPV is 0, right? It seems like that I have a crystal ball here. Okay? Really what I'm using is a market equilibrium argument. Okay? Think about the following. Suppose the NPV was positive. Okay? The NPV of, picking up, and think about what would it take for you to buy a PepsiCo bond? Okay? If you had the money, right? All you need to do is to pick up a phone, call a trader, or go to your computer and buy a PepsiCo bond. Okay? You should not be making money by that, right? It's very easy to do that. So if the NPV is positive, many investors would be picking up the phone. All the traders would be buying PepsiCo bonds, right? They would be calling their brokers. They would be, just buying and buying and buying, right? And we know from economics, basic economics, that if there is a lot of demand for a product, if there is a lot of demand for a financial asset, the price should go up. Okay? And if a price of an asset goes up, future return should be lower, right? If you pay more for PepsiCo bond today, your return is going to be lower, right? So if the NPV is positive, everybody would be buying the bond. Same thing, right? If NPV is negative, everybody would be selling the bond, okay? So the only possible equilibrium in the market for PepsiCo bond is one where the net present value is 0, okay? For a financial asset like a bond that is very simple to understand, that everybody can buy and sell, NPV equals 0 is a very reasonable assumption. Okay? Why are we going over this? Why is this an important idea? Because we're going to use this to estimate returns. Okay? This really is a beautiful idea in finance. Okay? We just learned, right, that, you know, zero NPV is a reasonable condition for many markets, right? What this means is that, remember module 3, right? If the NPV is 0, the actual return, the expected return, should be the same as the discount rate, the required return. Okay? So if the PepsiCo bond NPV is 0, what this means is that we can use the yield to maturity to approximate the required return on that. The return that we measure in the market, okay, is just the return that investors demand to invest in a PepsiCo bond. It's the required return, okay, right? So that's a very useful idea because we can use that data to input in our valuation and figure out what the required return on that is, okay? One more point here, I prefer to use a long-term yield to maturity for corporate finance, and we know already why, okay? Since we started this course, I've been pushing this idea that corporate finance applications have a long horizon, okay? We're always thinking about the long term, right? So my suggestion is that we always try to estimate the long-term cost of that, the long-term required return on that. What this means for PepsiCo is that we are going to use the 4.2% number, which is the yield to maturity on a long-term bond. So rather than use 2, 3, 4, 5-year maturities, we're going to take the longest possible maturity that we have available in our data, okay? But really, the key idea is the zero NPV idea and how we can use that to estimate required returns using expected returns, using actual expected returns. So now let's move on and try to estimate the required return on equity. Okay, we just did the required return on debt, right? And what we learned is that we can use yields to maturity to approximate the required return on debt, as long as the company is not is sufficiently far away from bankruptcy. Okay, so that's the idea that we just learned. The first thing to notice, though, is that we're not going to be able to do the same thing for equity. Okay, we do not have yield to maturities on equity. Okay, why? Because equity really has no promised cash flows. Okay, when you invest in an equity security, unless it is preferred equity, which is really more like a bond, what you're getting is you're getting the residual cash flows after the interest payment is after the company pays interest to bondholders, then it's going to pay cash flows to equity holders. Okay, so there is no notion of promised cash flow. Equity holders get whatever is left, and of course the hope is that even after you pay interest, there's going to be a positive, there's going to be a large cash flow to equity holders. In some cases it could be zero, right, if the company becomes bankrupt. But anyway, the point is that there is no notion of promised cash flows to equity, which stop us from estimating a yield to maturity on equity. So this concept does not exist. Okay? What we are going to use is a very important finance model, okay, which we call the capital asset pricing model, right? This is a model that you study in detail in an investments course like Scott Weisbanner's course that we just talked about, right? Here we are going to have a quick and intuitive discussion of how to apply the capital asset pricing model to a corporate finance application. Okay, so here's the model, right? It is the sum of a risk-free rate, which we are going to take as the yield to maturity on a government bond, right? So the security in the economy that has the least risk is a bond that is issued by the government, right? Why? Because the government can always use taxes, right? The government can always tax people, can tax companies to make sure that it has enough funds to repay the bond, right? That argument doesn't always work, but if we're thinking about markets like the US, right, which are established, mature, then it's reasonable, and there is some evidence on that the securities that probably have the least risk are bonds issued by the US, by the government, in this case the US government, right? So that's why we use that as the risk-free rate, and then there is going to be a risk premium, okay? For a company, the risk premium is going to be the beta times the risk premium on the stock market. Okay? So if you remember the CAPM, and this sounds familiar, great. If you don't, we're going to have, like I said, a quick and intuitive discussion of why the CAPM works and how we use it in corporate finance. Okay? The most valuable thing is intuition. So really what you should take from our finance courses is an intuition of how the CAPM works. Okay? So let's start with the market. We're actually going to start by figuring out what is the required return on the market. Okay? The way we do that is by ignoring beta. As we're going to learn next, the beta is going to capture the relationship between stock returns for the company and stock returns for the market. Okay? If you do that, then the beta goes away from this formula. The yield to maturity plus the risk premium on the market are going to give you directly the required return on equity. So we just have to estimate two things. Okay? Let's start with the yield to maturity on government bonds. Right? I told you that we're going to use securities issued by the US government in the case of PepsiCo, right? And here is the data for June 2015, right? It's another reason why we always have to think about cost of capital for a given time period, because yields to maturity are going to change, right? The risk-free rate on the economy, the return that you get from buying a government bond is going to vary over time. Okay, so in June 2015, it turned out that the 30-year government bond was returning 3%. Okay, and as I said, my recommendation is to always take the longest possible maturity. So what I'm going to do here in the formula is use 3% as our risk-free rate for this calculation. Okay, if the risk-free rate, if the yield on the 30-year bond goes down to 2%, we would change that to 2%. If it goes up to 4%, we change that to 4%. Okay? So that should be easy. All that this requires is for you to open the newspaper and get a table like that. Okay? Or go to Yahoo Finance, Wall Street Journal. There are many sources where you can get this data. Okay? The risk premium is a lot more complicated. Okay? This is a huge topic. Measuring the risk premium on the stock market is a huge topic. It has already given like a Nobel Prize to economists who study this and discover some of the most important facts. It's one of the key objects that we study in economics. I mean, not only finance, more broadly, it's one of the key topics we study in economics. Okay? So here we're going to have a very intuitive and practical discussion of the risk premium. Okay? The concept is that the risk premium on the stock market is the additional return that an investor would demand to put your money in the stock market rather than putting in a government bond, which is safe, right? The government bond will very likely give you that 3% return, unless something really unexpected happens, which we believe it's not, right? But investing in the stock market is obviously risky, right? The stock market can give you a very high return, can give you a very low return, right? How do we estimate the risk premium on the stock market? Let's think about that. Going back to what we already discussed, let's think about this question. What should be the net present value of investing in the market? Suppose you take your money and put it in the stock market. What should be the NPV? Right? A reasonable guess is that the NPV should be close to 0. Right? We can use the same argument that we used before, right? If the NPV is positive, then a lot of people would start buying stocks. The price of stocks might go up. If the NPV is negative, people would sell, stock prices would go down, stock returns would go up. Okay, so again, we can think of this as a market equilibrium story, right? But with the stock market, your intuition is probably telling you, it's the right intuition, your intuition is telling you that the NPV on the stock market is less likely to be 0 than the NPV on a bond, right? The bond is a simpler asset, it's easier to value, right? So if the NPV deviates from 0, it's very easy for participants, for investors, for analysts to figure this out and bring the market back to equilibrium. For the stock market, it's more complicated, right? If the stock market tanks, for example, right, there is a big crisis in the world, stock prices go down, people naturally become afraid, right? They might take the money out of the market instead of perhaps investing more, right? So, risk is going to complicate this calculation, okay? We're going to talk more about that in a second. For now, right, remember the idea we discussed. If the NPV is 0, right, we can use actual returns, we can use realized returns to estimate required returns. Okay? So that is the idea that financial economists use when they look at historical data, historical returns on the stock market to measure expected returns, to measure required returns. Okay? So here what you have is the average return on stocks and bonds between 1928 and 2012. Okay? So treasury bonds on that period returned on average 5.38, right? So you can see that this number is larger than the 3% yield that they are returning now. Okay? Common stocks returned 11.26%. Okay? I stopped this in 2012, but the number wouldn't change much if we had 2 or 3 more years. What we find from the historical analysis is that the risk premium, the difference between the stock market and the treasury bonds, is approximately 6%. Okay? So let's go back to the NPV equals 0 idea. How can we use this 6% to estimate the risk premium, right? The assumption we have to make to use the 6% is that the NPV of investing in the stock market during that period was 0, okay? If investors were on average getting a 0 NPV by putting their money in the stock market, right? If the IRR is the same as the discount rate, then that 6% is exactly the compensation that investors demand to put their money in the stock market. Okay? So we can take realized returns and use them to estimate required returns. Okay? But as we just discussed, this assumption is less likely to be reasonable for the stock market. Right? And it's very interesting when you look at what practitioners and academics are doing these days. Okay? Most of the evidence that I see suggests that we are not actually using a risk premium of 6%. Okay? So most academics and practitioners are using a lower risk premium when estimating future expected returns on the market. Okay? Why? Because the idea behind this is really that the 20th century was probably a great period for the U.S. economy, right? There was a time when the U.S. economy grew a lot. The U.S. really became the dominant country in the world. So perhaps the NPV was not 0. Even if we take an entire century of stock market returns, investors might have derived a positive NPV, right? In that case, the 6% might be too high. See, if you use 6% as the risk premium, you assume that gives investors a 0 NPV, right? If the NPV was positive, that means the 6% was an excess return, right? So what I suggest, the bottom line, what I suggest is that we use a number lower than 6%. I actually see many practitioners using 4% as the market risk premium. I suggest we use 5%, right? Mostly for conservativeness, right? So you don't want to lower the risk premium too much because that is going to reduce the cost of capital. It matters for corporate finance applications. I suggest we use 5% as our risk premium on the stock market. Okay? So now comes a question for you. It should be simple to do this. Suppose we are doing this calculation in June 2015. What would be the expected return on the market, right? So how much do you expect the market to return next year? Okay, suppose we are in June 2015. How much should the market return between June 2015 and May 2016? Very simply, all you need to do is to add the 3% yield on the government bond with the 5% risk premium, and you would get an 8% return. Okay? So that is our 0 NPV return. You see? If things go, on average, right? If things go as we expect, the market should return 8%, and that should give investors exactly a 0 NPV. That's why we can use that as a discount rate. It's a required return. Okay? Notice that here, okay, in this formula, we are using 3%. You always start from the current T-bond yield. Okay? Don't take the historical one. For bonds, as we just learned, we have great data on current yield to maturities, so we know we have a good estimate of what the bond is likely to return in the next 30 years. We should always use that instead of historical bond yields. Okay? So we do 3% plus our assumption for the risk premium, and we get 8%. That is our estimate for future market returns if we do this in June 2015. Let's go back to the company now, right? Our original goal was to estimate the cost of capital for PepsiCo, right? So the first step is going to be to figure out what the required return on equity is, right? Before we can go back to the cost of capital formula, we have to figure out what we do for the cost of equity when we move from a company, from the market, right, which we just did, to a company like PepsiCo, okay? The new feature, of course, is the beta in the formula, right? It's the same formula we just used for the market, except that now we have a beta. So what we need to think about now is what does beta measure, okay? Again, this is a very important concept in finance, right, that you talk about in an investment course in greater detail, okay? But here's the key idea. Really what it means is that beta measures risk for the company, okay? That's the idea to remember. High beta means high risk, okay? Why? Right? Because if you think about beta, and in the next few slides, I'm going to give you an example of how we estimate beta using real-world data. Okay? If you think about beta, what beta is going to measure is how the stock returns of the company correlate with the stock returns of the market. Okay? So let me give you an example. If the market goes down by 10%, okay, and PepsiCo goes down by 15%, right? Then investors are going to dislike that a lot, right? It's a time when they are losing money, right? It's a time when investors are becoming less wealthy. The overall market is going down. All your investments are decreasing in value, right? PepsiCo is going down even more, so that means PepsiCo is a very risky stock, right? So 10%, 15%, right? In this case, if you think of PepsiCo stock return, it would be an amplified version of the fluctuation in market returns, okay? The other example also works, right? If beta is less than 1, then that's a situation when PepsiCo does not fluctuate as much as the market, right? Maybe if the market goes down by 10%, PepsiCo goes down by only 3%, right? In that case, PepsiCo is going to be less risky, right? It's providing almost like a hedge to investors. They are losing 10% on most of their investments, but PepsiCo turns out to be a relatively safe one. Okay? So this is the concept behind beta. So what I want to show you is how we actually estimate beta for a company like PepsiCo using data. Okay? I'm going to use data for the period of 2000 to 2009, and then I will show you a beta that is computed by Capital IQ using more recent data. Okay? So I'm going to do this for 3 different periods of time, because when analysts compute beta, they typically use 5 years of monthly data. Okay? We want to have sufficient numbers of data points to figure out how the stock moves with the market. At the same time, you perhaps don't want to use too many years in the past, because the company can change over time. Right? So the compromise in this case is to use 5 years monthly data, so you have 60 data points. Okay? Here is an example. This calculation is using a statistical analysis tool called a regression. Okay? But really, it's very intuitive. What the regression is measuring is the relationship between PepsiCo stock return and the market return. Okay? So here you have all the data plotted. On the y-axis, you have the PepsiCo return. In the x-axis, you have the return on the market, which here is proxied as the S&P 500. Okay? And just by looking at this plot, right, what it seems to be the case is that PepsiCo stock is not that highly correlated with the market, right? If you look at these points, there are many cases here where the market goes down by more than PepsiCo, right? And there are cases where the market goes up, but PepsiCo doesn't really follow. What this means is that the correlation between PepsiCo and the market is not that high. Okay? The regression, for those of you who understand the regression, what this is doing here, these tables, this table and this table, what they are doing for you is reporting the summary statistics from a regression of PepsiCo stock return on the market return. okay? And here is the beta, is the intercept on the market stock return, which here in this case is 0.35, okay? Right? So this is significantly below 1, consistent with our intuition, in our visual intuition, that these returns are not very highly correlated, okay? That's what we found for the earlier period. We can also do this for the later period of 2005 to 2009. If you look at the plot, now it seems that the correlation increased, right? This line became more positive. That's the regression line here, right? It became more positive, right? The slope went up. You actually see here in the regression, the beta in this case went up to 0.5, okay? It's still not a very high beta, right? But it's higher than it was between 2000 and 2004, right? So this is what we found out doing our regressions, okay? Remember that beta is a statistical estimate. Every time we do this, we are estimating a beta using statistics, using a regression. You can see for PepsiCo, we came up with 2 different betas, right? Of course, they refer to 2 different time periods, but you have to remember that there is uncertainty in this estimate as well, right? If you look at that regression, for those of you who understand confidence intervals, right, that gives you the range for which we are 95% sure that the beta is in that range, right? So the 95% confidence interval for PepsiCo beta ranges from 0 to 0.75, right? So this means that if you want to be 95, if you want to be almost sure that you know the beta, you have to give yourself a very large range, okay? So that's the problem we have to deal with, right? Before we do that, let me give you a more recent data. We're not doing the regression in this case. We could do it, right? This comes from Capital IQ. Or Yahoo Finance would give you similar data, right? As it turns out, beta is such an important number for corporate finance applications that the same sources that will give you financial data, right, that will give you balance sheets, accounting statements, cash flow statements, market values, will typically also give you data on an estimate of beta, okay? As I just discussed, the beta from Capital IQ, if you take it for June 2015, for example, it's going to reflect data for the last 5 years, okay? So it's starting in the June 2011 to June 2015, okay? This will be the relevant data for to compute this specific beta. So you can get beta from the internet, okay? So how do we use this data, right? We have 3 different estimates. We have this confidence interval, right? For sure, our data suggests that PepsiCo has a fairly low beta, right? Remember our initial discussion, okay? If beta is below 1, that means the stock return of the company is dampening the movement in the market. This is definitely the case for a company like PepsiCo, okay? All of our estimates came, close to 0.5, okay? Right? What I recommend that we do in practice is that we use a range for betas, okay? To recognize the fact that beta is a statistical estimate and that we are very uncertain about what the actual number is, rather than using a number, we end up using a range, okay? And my other recommendation is to shrink the beta towards 1, right? So what do I mean by that? Let me give you the meaning first, and then we'll talk about why we are doing this. So for example, for PepsiCo, I suggest that we use a value of 0.5, right, which is in the range of the betas that we got, but a range between 0.4 and 0.7. Okay, so you can see that the range is getting closer to 1, right? If the range was a symmetric range around 0.5, we would be using 0.3 to 0.7, right? So we always use a range that is shrunk, that approaches 1, right? Why? Remember that the beta is what's going to measure how risky the company is relative to the market, right? So if the beta deviates a lot from 1, if it's close to 0, if it's very large, then your cost of capital for the company is going to be very different from the market, okay? Since we are estimating beta using statistical analysis, I think it's a good idea not to give that much weight to beta and use this shrinkage idea to do that. Okay, so what I suggest is we use a range, but a range that is shrunk towards towards 1. In the case of PepsiCo, we are using 0.4 to 0.7. Okay? So what does this mean? That if you use 0.5, right, which is our best guess, okay, what you're going to get is a cost of capital of 5.5%, right? So it's the same thing we did for the market, except that we are multiplying the market risk premium by the beta, which we estimated to be 0.5. Okay? If you use the range, okay, you're going to get cost of capital between 5% and 6.5%. Okay? And by the way, there is no correct way to do a range, right? This uses a combination of our statistical analysis with common sense, right? And really, this idea of shrinking the beta towards 1 is a common sense idea, right? So use the combination of your regressions, of the standard deviations with common sense to figure out what a reasonable range for beta is. In this case, it would imply a range of 5% to 6.5% for the cost of equity. Okay? So think about the following question to make sure that you understand how we use beta in finance. Okay? So this is the estimate that we got, right? Suppose now that the market return ends up being 8%, right? As we learned, that's just right on our expectation, right? The market does just as we expect, okay? But PepsiCo returns 7%, okay? Market 8, PepsiCo 7. Should a PepsiCo investor be happy or not? First reaction you might have, right, is no, okay? The market returned 8, PepsiCo returned 7, so the investor is losing money. That would turn out to be the wrong answer, okay? Remember, high risk, high return, right? We are pretty sure that PepsiCo's beta is lower than 1, right? So PepsiCo does not have to return 8%. PepsiCo is less risky than the market, okay? That's what we just learned. Even taking that range into account, right, we're going to find out that PepsiCo is less risky than the market, okay? So we estimated the reasonable range for PepsiCo required return on equity would be 5 to 6.5, okay? So what that means is that an investor should be happy, right? Even if the beta is 0.7, which is on the high end of our estimate, the investor is still making more. The actual return is still higher than the required return, okay? So the investor should be happy, not sad. We have made a lot of progress so far, right? I gave you the weighted average cost of capital formula, or the WACC short, right? And we have estimated almost all the numbers that we need, right? The required return on debt, 4.2, the required return on equity, 5.5, right? But there is one more set of numbers that we need, which is the ratios, right, that tell you how the company is financed, right? And by the way, we also need taxes, right? But if you look at Module 2, we were doing a financial planning of PepsiCo. We already figured out that 25% is a reasonable estimate for the tax rate of PepsiCo, okay? So what we need to find out now is how PepsiCo is financed. And let's go back to Module 1, okay? You need to use the market value of equity, okay? If you want to measure leverage, how much leverage a company has, right? The right way of doing it is by using the market value, okay? It's very tempting to do this using book values, right? If you take standard data sources like Morningstar, okay, in many cases they will be reporting capital structure data for you, right? There's even, using these nice pie charts, right, as the one you have there, right? We can think of the company as a pie, and then, who is eating the pie, right? Debt holders and equity holders are eating the pie. These pie charts are kind of cool to represent capital structure. The problem is that if you look at the underlying data, which is here, okay, that pie is representing book values, okay? The equity value here in the pie is 15 billion, but when you look at the actual data on the market value of PepsiCo, right, the market cap is $138 billion, which is a lot more, right, than the book value. We talked about this already in the course, right, when we were discussing leverage. The book value of equity is a poor proxy for the value of the equity because it ignores the future, right? Most of the value of the equity for a healthy company like PepsiCo is going to be in the future, and the book value completely ignores that. So that's a problem, and the way we fix this problem is by using the market value, right? So let's just go here to recap how we do this very quickly, right? We have here data on that. We're going to use the market value, right? So our DV is simply going to be 30, the market value of that, divided by 30 plus 138. Okay, so here's the market value of equity, not the book. You should find a leverage ratio of 19%. A debt over debt plus equity ratio is 19%. Okay, so 19%, right? If D over V is 19, obviously E over V is going to be 81%. Okay, so it should be easy to do, but if you, I bet if you hadn't taken this class, you would end up using book values to estimate this. So that's the point I really want to emphasize. Okay, so here's the entire calculation, right? We have the WACC, which is 5%. Okay, what we're doing here is multiplying the cost of equity by the contribution of equity to the firm value. Okay, so before we talk about the interpretation of the WACC, let me make a few points here. The first one is that, you know, it is very important to use market values, right? Think about this: the cost of debt is lower than the cost of equity, right? The required return on debt is lower than the required return on equity. So if you were using book values here, you would end up with a lower cost of capital. It's not what you want to do, right? You would be biasing down the cost of capital, as we're going to learn next when we measure performance. That's a big problem. Okay? The second point is that you have to remember this is not a magic number. We do not have a crystal ball. This depends on estimates. In particular, the WACC is very dependent on the beta, right? If the beta goes up or down, the cost of capital for the company is going to change. So here is a little table for you, right? We were working with a range of 0.4 to 0.7 for the beta, right? That range is going to imply a range of approximately 4.5 to 6% for the cost of capital. Okay? So if you want to be conservative and use 0.7 as the beta, the cost of capital would be 6%. Okay? In any practical application, you do want to do the sensitivity analysis when estimating WACC. Okay? It's simple. It should be relatively straightforward to do, and it's going to help a lot when you are using cost of capital to value projects, to do performance evaluation and things like that. Okay? Talking about projects, let's learn how we use a WACC. Okay? So here's a question for you, right? The WACC is the discount rate for the company, right? That was our starting point, right? We talked about the fact that we're going to use the WACC to estimate the discount rate for the company. Okay? So the way to interpret it is that it's the required return on projects that have risks similar to the company. Right? So let's see, just to make it clear that we all know how to use it, consider the following example. Suppose that PepsiCo is developing a new soda, right? Which, you know, should be similar to the company as a whole, right? What is the minimum IRR? Going back to Module 3, think about IRR, but now think about what is the minimum IRR that PepsiCo would need to generate to make the soda positive NPV. Okay? What is the required IRR, the required rate of return in this case? Now we know the answer. Okay? The answer is that the IRR has to be greater than 6%. Right? The cool thing we just figured out is that now we can actually estimate that number, right? The 6% is not falling from the sky anymore. The 6% is the cost of capital, okay? It's not a perfect estimate, right? Like all estimates we use when we do finance, we have to use statistical analysis, common sense. You know, it's not a number we know for sure, but it's better than just guessing, right? So we know that the WACC is not 10%. That we know, we can pretty much be sure of that, right? there is a possible range for the WACC. 6% is a reasonable estimate, right? And plus, given our analysis, 6% actually turns out to be a conservative estimate for the cost of capital for PepsiCo, right? Because we are using the high end of our beta estimates. The bottom line, going back to Model 3, right? We need the IRR to be greater than the discount rate, right? If the IRR is greater than the discount rate, the NPV is positive, right? So what this all means is that for a new soda, for a project that looks like PepsiCo, all it needs to do is to generate a return greater than 6%, and we are pretty sure that this new soda is going to be positive NPV. The other very important use of the cost of capital is to allow us to measure performance. Okay? We can now try to answer this question: how do we measure whether a company or a division of a company is generating sufficient profits? Okay? Think about the following. Suppose you have already invested $1 million in a project, okay? In a certain investment, right? How large would annual profits have to be for this project to be creating value, right? So remember the idea that for a project to create value, right, the rate of return has to be greater than the discount rate, right? And now we have an estimate for the discount rate that comes from our cost of capital, right? So the answer has to be that the minimum profit that the project has to generate is the WACC times the $1 million, right? The WACC is a percentage return, right? If you multiply that by $1 million, you're going to get a dollar value. This dollar value should be a benchmark for the company, right? So if it's PepsiCo, we just figured out that the WACC should be lower than 6%, right? 6% is a conservative estimate, right? So what you would do is you would multiply 6% times 1 million to figure out what is the minimum amount of annual profit that a PepsiCo project should generate, okay? The general concept that we're going to introduce here is this notion of EVA, which we call economic value added, okay? So economic value added is just going to be profits minus WACC times the amount of capital that is invested, either in a company or a division or a project, okay? And now we're going to go back to Module 1, where we talked about how to measure profits and how to measure assets, right? A very important notion is that we discussed in Module 1 is that if you want to measure profits for the company as a whole, you cannot use net income, right? You have to use operating income. You have to use a measure of profits that is before interest payments, right? In this course, the measure we are using is called OPAT, which is operating profits minus taxes. The same measure that we're going to use here to estimate EVA, okay? What EVA is going to give you, right, is the difference between OPAT and the WACC, right, which, as we learned, is the minimum percentage return times the operating assets, which are going to be an estimate for how much capital is invested in that company, right? So the EVA in the end is going to measure whether the company is generating real economic profits after accounting for the required return, right? After accounting for the minimum profits that the company should generate, okay? So why are we using this notion of operating assets, right? First of all, the definition. What we mean by operating assets is the difference between book value of assets and cash, okay? Going back to Module 1, think about the following. Why are we using book, okay? We already saw the answer, right? In this type of applications, when we are measuring current profitability, right, what you want to do is you want to measure the capital that is invested in the company right now, okay? You don't want to include future profits in your measure of assets, so you definitely do not want to use market values here, right? If you're using market values, really what you're doing is comparing current profits to future profits. You know, we do that when we compute valuation ratios, not when we're trying to measure performance. Okay? Why are we excluding cash? We are excluding cash because cash is clearly not invested in the business for most cases. Okay? Right? Cash is invested in, there's a financial asset, right, that is invested typically in treasury bonds, bank deposits. This is not money that is directly invested in the business. So when computing EVA, it's good practice to remove cash and short-term investments. Okay? There's the word generally there, right? Because in some cases, the cash might be an operating asset, right? In some cases, the cash is required to run the business. You can think of a supermarket, for example, that needs some cash to give change to consumers who come to buy the goods, right? So in that case, cash is part of the business. It is invested in the business. But you know, as this example shows, for most real-world companies, cash is going to be invested in financial assets, so it should not be included in operating assets. Okay? So let's go back to PepsiCo and try to figure out whether PepsiCo is generating sufficient profits to cover its cost of capital. Okay, that's the notion of EVA, right? We estimated the WACC at 5% with a reasonable range of 4.5 to 6. So we can use this percentage required returns now to measure EVA, right? All we need to do is to measure OPAT and operating assets, right? And you should know how to do this already. We did this a lot in Module 1, right? OPAT is just the difference between operating income, EBIT, minus taxes. So OPAT for PepsiCo in 2014 was $7.8 billion. Okay? Operating assets, very easy. Just take the total assets and deduct cash. Okay? Our estimate here would be $62 billion. Okay? And then our assumption when we do this calculation is that all the other current assets are invested in the business, right? And if we go over the list here, for most of them it's reasonable, right? Receivables, we learned in Module 2 that receivables is an investment in the business, right? Net PPE, goodwill, right? Which, if you know some accounting, you will know that goodwill comes from the effect of previous acquisitions on the balance sheet, right? Intangibles. So it looks like most of these assets are actually invested in the business, except for cash. Cash is definitely, most likely to be invested in financial assets like bank deposits and treasury bonds. Okay? So that's why we came up with this number. That's why we're using 62 billion instead of 70 billion to estimate operating assets for PepsiCo. Okay? Given this analysis, we can do the EVA, which is reported here in this table, right? So you have, for each beta, remember we are working with this range for cost of capital, right? For each beta, we have a certain required return on equity, we have a WACC, and that gives you the EVA, right? So even if you take our most conservative estimate, which is a WACC of 6%, what we find out is that PepsiCo is generating about approximately $4 billion of pure economic profit in 2014, right? So that's the difference between OPAT and the WACC multiplied by the operating assets. We just learned how to estimate cost of capital and how to use cost of capital to figure out whether a company is generating economic value or not, right? That is very useful, and it seems actually quite easy. But here comes a problem, okay? Most real-world companies are going to have different divisions, right? You're not investing only in one type of product, you might be investing in many different products. That's true even for PepsiCo, right? Most of PepsiCo's investments are related to soda, right? Soft drinks, but PepsiCo also has other food business, right? The general point is that if a company has different divisions, the company-wide cost of capital is generally not the right discount rate for all of them, okay? Remember the initial idea. Discount rates have to reflect the specific risk of each project, right? In this case, the discount rate has to reflect the specific risk of each division, right? And if a company has many divisions, then all hell breaks loose. The answer may be no. Maybe that the company-wide cost of capital is not doing the right job, right? So now what I want to talk about is how would we do it, right? If we have this problem, right? If the division is different from the company, how can we do this calculation? Okay? The example I'm going to use is Altria, which is a conglomerate that produces mostly tobacco. Okay? Most of their business is to sell cigarettes, smokeless tobacco and cigars, mostly cigarettes. That's the big business, both in the US and abroad. Okay? But they also have some other smaller divisions. In particular, they have a wine division that we're going to talk about here, and also some financial services. Okay? This is the wine division of Altria. It makes wines in Washington State. The division is called Saint Michel Wine Estates, which you might have seen before, especially if you live in the US. These are broadly, so these wines are sold very generally in supermarkets and all that. Okay, so you might have seen them. So these wines are made in Washington State, okay, and they are made by this company called Saint Michel Wine Estates. They also own some other wineries around the world, but this is the big business. Okay. What we want to do then, suppose, if we are Altria, right, the CFO of Altria has to figure out whether the wine division, Saint Michel Wine Estates, is generating economic profit or not. Okay? So how do we do that? How do we compute EVA for the wine division, right? The first thing we need is data on profits and assets separated by division, right? And this data might be difficult to come by. Companies are not necessarily required to report this data, so some of them do, others don't. Okay? If you are inside the company, you're definitely going to have that information, right? Even at a more granular level, right? Even for specific projects and all that. Okay? In the case of Altria, they were nice and they actually report data separately for the wine, for different divisions. In particular, we are using here the wine and the tobacco division. We have operating profits and assets separately by division. What we don't have is cash separated by division here, okay? It turns out that Altria does not hold that much cash, so we're just going to assume for this calculation that cash is equal to 0, okay? Remember that in general you want to deduct cash from your assets to figure out operating assets, okay? We do have OPAT. So all we have to do is to tax your operating profit. If taxes are 30%, then your OPAT should be $57.8 million. Okay? So in 2014, the wine division of Altria generates $57.8 million in profit, right? And the question that the CFO is trying to figure out is, is this enough, right? Is this a sufficient profit for the wine division, or should we be looking for more? Does the division have to perform better? Right? Think about the following. That's really going to get to the fundamental question we are talking about in this session. Okay? We can get beta for Altria. That's very easy, right? Just go to Capital IQ or do a regression. Okay? You'll find out that Altria also does not have a very high beta. Similar to PepsiCo, Altria's beta is 0.5. Okay? We can use the range and all that. The bottom line is that Altria will have a lower beta. Okay? Maybe between 0.4 and 0.7 like PepsiCo. Is this the right beta to use? If you're trying to answer the question we just posed, which is to figure out the performance of the wine division, is that the right beta? Okay? Which risk is this beta reflecting? The answer, to put in very simple words, is that 0.5 is a tobacco beta. How do we know? Because most of the company is tobacco, right? If you look at the market value of Altria, it's going to be driven mostly by the tobacco division, right? If you look at the table that we just worked with, most of the assets are invested in tobacco, most of the profits come from tobacco, most of the equity value is going to reflect tobacco. There is no guarantee that if we use 0.5, we're actually going to be measuring a wine beta, okay? So now what we need to think about is then how do we do it, right? And it's really very important because EVA it's useful to figure out EVA for the company as a whole, but EVA is even more useful when you think about individual projects, when you think about divisions, right? You can use EVA for executive compensation, for example, right? If the wine division is doing great, then the chief manager of the wine division might get paid more, might get more stock, for example. But to determine that, you have to figure out the cost of capital for the division, okay? And we cannot directly measure it, right? Why? Because the wine division does not trade separately in the stock market. You cannot find a stock price for the wine division. There's no way you can estimate the beta, even if you have the most sophisticated statistical tools in the world, you're not going to be able to estimate beta because you don't have the data, right? So there are two approaches that we use here in corporate finance. One is to take a range of similar companies, right, and use an industry beta, right? So that's a beta that is going to be averaged out across many firms in a related industry. The second one is what we call a pure play approach, which is to try to find a similar company that is publicly traded. Okay, so let me give you an example here for Saint Michel, for Altria's wine division. Okay, we can start from a beverage beta, right? A beverage beta is definitely going to be better than a tobacco beta, right? Using this table here, you'll see that the beverage beta, using 35 companies in this case, is 0.995, right? So it's a beta that is a lot closer to 1 than the tobacco beta. Okay? We can also try a pure play approach, right? Which is to, in this case, we're looking for the wine beta, right? So what we need to search for is a company that mostly makes wine, right? A company whose main business is wine and that is publicly traded in the stock market. In this case, we are lucky. We can use a company called Constellation Brands, okay, which produces wine all over the world, including the US, Australia, and many other parts, okay? And we can get data for Constellation Brands. We can go to Capital IQ or Yahoo Finance, for example, and you will find that the beta is around 1. The beta is 1.02 in this case, okay? So think about this, right? We had the option of using the tobacco beta, right? We had the option to use the tobacco beta, but it actually turns out that the beta, a wine beta, a wine WACC would actually turn out to be higher, right? Because remember, the higher the beta, the higher the WACC, right? So if we use a beta of 1 here, we're going to end up with a required return on equity of 8%, right? Instead of 6.5%, which we would have obtained if we were using the tobacco beta. Okay? So just a couple more data points here to compute the WACC, to go from required return on equity to the WACC. We have to add the debt to value and the cost of debt, right? We take those from Altria. Okay? Those are company-wide values. Okay? Again, there could be a difference in the cost of debt from the wine division to the tobacco division, but it's less likely to be the case, right? Going back to the idea we discussed before, right? Debt securities are safer, right? The equity gets the residual cash flows, so the cost of debt, the required return on debt, for the tobacco division should be closer to the required return on debt for the wine division. And here we don't have good data to get a better estimate, so let's just use that, okay? As it turns out, Altria does not have a lot of leverage anyway, so that's not, even if we are getting these numbers slightly wrong, it's not going to throw off our estimate that much. Okay? So if we apply the WACC formula, we're going to find a cost of capital of 7.4%. Okay? So the cost of equity, the required return of equity is 8, the cost of capital is 7.4%. Okay? And now we can go back and estimate EVA, right? Using, for example, 7.4, right? We would deduct, we have the OPAT, right? We have the operating assets. We deduct the WACC times operating assets from the OPAT. We get an EVA of minus 6.3 million. Okay? What does this mean, right? It means that looking at that year in isolation, 2014, the wine division did not generate sufficient economic profits, okay? The required profits would be 7.4% of the assets, which are bigger than the OPAT minus taxes, which is our estimate for the profits that the wine division actually generated. Okay? And go back to what we've been discussing. Which mistake would you have made if we had used the tobacco beta, right? Suppose we used 0.5 instead of 1 for the beta, right? You would have ended up with a higher EVA, right? Essentially, you would be underestimating risk, right? Because beta measures risk. So 0.5 is very different from 1, right? Because you're using a low beta, you would have ended up with a lower WACC, and you would be overestimating EVA, right? So for the company, it matters a lot. If you're using EVA for performance evaluation, for compensation, you have to try to get it right. So even if this calculation isn't perfect, it's definitely better than if we had used 0.5. Okay? How would we use EVA, right? So suppose that we had checked this calculation and really made sure that all the numbers are solid, right? And that we find out that the wine division is in fact generating negative EVA. Okay? What does that mean? Should we go ahead and restructure this division? Should we sell it off, right? What should Altria do? Okay? Here you have to be a bit careful. Okay? Notice that when we measure EVA, we are measuring current profits, right? EVA, by the definition, tells you if a company generates economic profits in a given year, or if a division generated economic profits in a given year. Okay? So what might be happening is that perhaps the wine division is expected to grow a lot, right? And to generate higher profits in the future, right? So having negative EVA today doesn't mean you have to sell off the wine division, right? What it does mean is that you have to make sure the wine division, the performance of the wine division is going to pick up, okay? If that never happens, right? If EVA never turns positive, then at some point a restructuring is necessary, right? Essentially, this means that that division is not creating economic value. Something has to be done, okay? So it's very useful information for a CFO, for a CEO, for the company as a whole to use EVA and be able to figure out whether a division or a project is contributing economic value or not. In the first part of this module, we talked about mergers and acquisitions. In particular, we talked about the concept of synergies, which is the right reason for companies to engage in acquisitions, for companies to engage in M&A. Okay? We also learned how to distinguish good reasons from bad reasons. So we talked about several bad reasons why companies sometimes engage in M&A. We learned how to recognize them and how to avoid them. Okay? We also learned how to calculate synergies using net present value techniques. Calculating synergies is just another example of NPV that we also used in Module 3 to figure out the value of a new investment. Okay? Then we used our synergies to determine the pricing of M&A deal. We learned how the pricing of a deal, how much you pay for a target, is related to our valuation of synergies. We then talked about the difference between stock-financed mergers and cash-financed mergers. We learned what stock-financed means, right? And then we started talking about a very important cash-financed merger, which is a leverage buyout, right? We talked about the specific characteristics of leverage buyouts and how leverage buyouts can increase shareholder value, okay? That was the first part of Module 4. The second part of Module 4 looked at uncertainty. Right? We learned how to incorporate uncertainty and risk into our valuation analysis, right? First, we talked about sensitivity analysis. We learned how to do it and how to use it, okay? And then we talked about the fundamental idea in finance that we can use discount rates, right, to incorporate risk into valuations, okay? We talked about the weighted average cost of capital. We talked about how to estimate it for a real-world company, okay? And then we used the weighted average cost of capital to estimate performance, to measure performance, right? The way we did this is by estimating economic value added. We did it both for a company as a whole and for the division of a company, okay? And finally, we talked about how to use EVA for performance evaluation, for compensation purposes, and to decide whether a division should be restructured or not. I want to talk a bit about the objectives of assignment 4, the assignment of module 4. Okay? There are some open questions, right, that allow you to discuss some of the key ideas of the module in your own words, as with the other assignments. But for this assignment, there are some specific problems that I want to discuss. There are 2 mini cases, okay? And then there is a numerical problem that focuses on the calculation of a WACC and EVA for Coca-Cola, okay? The mini case on question 1, the objective of that is to allow you to practice this key concept in M&A, which is the notion of synergies. Okay, so this mini case is going to allow you to calculate synergies for a specific deal that happened in 2009 between Kraft and Cadbury. Okay, and you, as we did in the lecture, you will also need to think about how the valuation of synergies affect the pricing of the deal. And then the other mini case is going to test your knowledge of beta. Okay? It's a mini case where you're going to be asked to estimate the beta for Yahoo, but it's not a numerical question. I'm not asking you to go out and do statistical analysis. It really is a qualitative question to think about what you would need to do to figure out the beta for Yahoo. The specific observation here is that Yahoo has a large equity stake on another company, the Chinese internet company called Alibaba. Okay, so think about how that will affect your calculation of beta. This exercise will be useful for you to think about beta. Okay, and finally, we're going to practice the calculation of cost of capital in EVA by looking at a PepsiCo's competitor, in this case, Coca-Cola. Okay, it's natural that we are looking at a competitor. That's going to allow us to compare both numbers across companies, compare Coca-Cola to PepsiCo in terms of cost of capital and EVA. Okay, to do this assignment, all you need are the lecture notes, okay, and the assignment questions. In particular, the data that you need is going to be in the assignment already. You need some accounting data for Coca-Cola and some data to do the Kraft and Cadbury case, but it's all going to be in the assignment for you. Make sure you provide your answers in a readable format, as with the other cases, okay, as with the other assignments. And when answering a numerical question, as with the other assignments, I recommend that you use a word processing program to make it easy for people to read. If you do use pencil and paper, make sure that you can make your answer accessible to others. And I will provide my own solution, okay, as with the other assignment. Make sure you work on your own, okay. Before you see my answer, try to provide your own solutions to the assignment. That's the way you can take the most out of the assignment. And then, of course, you can look at mine and to make sure that you practice these concepts and get what you need to get out of the assignment. So here we assumed that the annual cost savings would start in 2010, right? It's 625 million, but we have to deduct taxes, so you end up with an after-tax cash flow of 406 million, okay? And as we did in the lecture notes, we are going to assume that these cost savings are going to continue into the future. If you think about it, that is a reasonable assumption, right? If a company cuts costs, this cut in cost is going to affect profits both today and in the future. Okay, the growth rate that we are assuming here is a growth rate of 2%. So the cash flow is going to grow from 406 to 414 in 2011, and then we have the dots, meaning that this is going to go on into the future, right? And as with other valuations we did in this course, right? When we see the dots, we are thinking of growing perpetuity formula, right? We have to apply the perpetuity formula to the cash flow. So we have 406. Right, discounted by 8% minus 2%, which is the growth rate, okay? And remember, every time you apply the growing perpetuity formula, you're going to bring the value one period before, okay? So this value here is going to come to year 2009, right? So that's why here in the formula you have the growing perpetuity minus the integration cost as the net present value of the synergy, okay? So that is the calculation that you would need to do. And here what you see is that the NPV of the synergy in this deal is estimated to be $5.6 billion, okay? Now, let's recall a very important principle we learned in the lecture notes, okay? For the acquisition to be positive NPV for the acquirer, right, the synergy has to be greater than the premium paid to the target, right? So now let's figure out the premium, right? So here you have the price that Kraft paid for Cadbury, right, minus the price of Cadbury prior to the deal announcement. Actually, this is the offer value, right? It may not be the price that Kraft actually ended up paying. We're going to talk about that in a second, okay? But just looking at that data, the premium that Kraft offered was 30.5%. If we express that in dollars, right, given that Cadbury was worth $12.8 billion prior to the deal, we would get a premium of about $4 billion, or 3.9. Okay? So in this case, since 5.6 is bigger than 3.9, right, as long as the management is right, that means Kraft is generating a net present value of $1.7 billion from the acquisition of Cadbury. Okay? Now let's go back to Module 3, right? Since the NPV is positive, what should have happened to the stock price? Kraft's stock price should have gone up, okay? But that, of course, is only going to happen if the market agrees with the management, okay? The market, of course, has to be doing the same calculation that the management is doing, okay? But if you read this mini case, in fact, what happened is that the stock price decreased, right, from 28.1 to $26.4, okay? A decrease of 6% when the merger was announced. So Kraft, rather than gaining about $2 billion, Kraft ended up losing $2.4 billion of value, okay? So the market view of the merger did not agree with the management's view, which is a very common situation, right? The market in this case thinks that the synergy that is associated with the deal is lower than the premium that Kraft is paying, right? The management thinks that the synergy is bigger than the premium, so the deal is positive NPV, but the market disagrees, okay? The synergy is not that large. The synergy ends up being lower than the premium, therefore the market decreases Kraft's stock price, okay? So really, it's a very simple analysis, and it's all based on premium and synergies. And this reflects a common problem that we talked about in Module 4, right? Acquirers tend to pay too much to targets, right? What we learned when we went over the notes in Module 4 is that targets tend to gain, a significant increase in their stock prices when a new deal is announced, but acquirers on average don't gain anything. There are many M&A deals in which the acquirer's stock price goes down. Kraft is another example of that, okay? In fact, an interesting thing we're going to talk about now is that the market reaction actually suggests that the market expects Kraft to pay even more, right? Because the stock price of Cadbury actually went up to 7.91 pounds when the deal was announced, which is higher than the value of the offer, right? So the only reason for that has to be that the market expects Cadbury to get more than 7.45, right? So at some point, right, Cadbury's stock price has to go up, to more than 7.91. Otherwise, the market reaction would be irrational, okay? What happened in this case, it's very interesting that, in fact, the market seemed to have been correct, okay? On September 12 of 2009, Cadbury rejected the offer, okay? And then what happened after that is that Kraft tried to make the offer work. So first in November, they announced a formal tender offer to the shareholders of Cadbury. This initial offer was on the same terms of the initial friendly bid, but that was immediately rejected. Cadbury was obviously trying to get a better price, and in the end, in January 20th, 2010, the companies ended up agreeing to a deal, but the offer was sweetened. It was a much sweeter offer for the shareholders of Cadbury. Kraft ended up paying a premium of 48% instead of 30%. Okay? So the market was probably correct to estimate that Cadbury was going to end up receiving a higher offer down the line. Okay? So that was question 1. Let's move on to question 2, which is part of the questions where you for which the goal is to allow you to discuss the course concepts in your own words. Okay? So this question is about cash and mergers, right? What we learned in this module is that cash-rich companies do tend to acquire more, right? They become more acquisitive, they make more acquisitions, but these acquisitions are now not necessarily good for shareholders, okay? So remember this idea, having cash to spend, right, is a wrong reason to engage in an M&A deal, okay? Managers would avoid many mistakes if they remember this simple idea, okay? That's what I wanted you to discuss in this question. Question 3 was about leverage buyouts, right? It's a situation where a company is being targeted by a private equity fund, okay? Remember, what we learned in class is that in order for private equity funds to generate value, they have to restructure, right? There is no usual synergies, right? Because private equity funds are managed by an investment company, you know, so it's not the case that there are horizontal synergies or synergies from vertical integration, right? So private equity funds have to rely on restructuring, cost cutting, right? Or perhaps to buy companies that are undervalued, okay? So if the CEO does not want to be acquired by a private equity fund, what he or she can do is to try to do the restructuring herself and increase shareholder value before the private equity fund can come and make the offer, right? The other thing we learned in class is that private equity funds have to use leverage to finance deals. These deals are cash financed, okay? So if the company is highly levered to begin with, it's going to be more difficult for private equity funds to do the acquisition. So the other reaction that the CFO or the CEO can consider is to increase the leverage of the company to make it more difficult for the private equity fund to make the acquisition, okay? Let's move on to the beta case, okay? So this was a simple qualitative case where what you're asked to do is to figure out the beta for Yahoo, okay? And here, the tweak is that Yahoo's business, you know, is just a small part of Yahoo, okay? Which seems like a weird statement until you look at the numbers. Most of the equity value of Yahoo is actually driven by Alibaba, okay? $30 billion out of the 35 corresponds to the value of the stake in Alibaba, okay? So whatever the beta is, right, if you get the beta from Capital IQ, or if you take stock prices and compute a beta, what you're going to get is an Alibaba beta. This is very similar to the tobacco and wine beta example that we discussed in class, right? Here, Yahoo's beta really is an Alibaba beta, so if you want to estimate Yahoo beta, you're going to need to use other methods, right? So we talked about a couple methods in a class. You could try to use an industry or to look at comparables. You know, for example, you could try to get betas for eBay, American Online, Google, other companies that have similar business as Yahoo, okay? The other thing you could try to do is to use a formula. We didn't talk about this in the lecture notes, but it's good to talk about it now. It actually turns out to be the case that betas average. Okay, so the beta of 1.11 for the company as a whole can be thought of as an average between the Alibaba beta and the Yahoo beta, okay, where you have the market values as weights, okay? So Alibaba is worth 30 of the 35, the equity stake in Alibaba, right? So all you would have to do is to use this formula. The problem is that Alibaba went public very recently, so it's not going to be easy for you to come up with a good beta estimate for Alibaba. So in this case, you might end up having to use a comparable method. That would have been an appropriate answer to this question. Okay? Finally, on question 5, I gave you data to allow you to estimate the calculation of, to practice the calculation of weighted average cost of capital using Coca-Cola instead of PepsiCo. Okay? The interesting thing here is that the numbers look exactly the same, right? So if you did this right, you know, you should have obtained exactly the same numbers that we obtained for PepsiCo in class. Even the capital structure is the same, okay? So it seems that Coca-Cola and PepsiCo have very similar cost of capital. Does that make sense? Okay? If you think about it, yes, right? These companies are in fact very similar. They are both very large multinational companies that are in the same business, right? They have beverage, they have other food products, okay? So, you know, their WACCs should actually be similar, right? If we had found a very large difference, then it would be, you know, a bit puzzling, and we would actually have to think about why is PepsiCo so much riskier than Coca-Cola, why is Coca-Cola so much riskier than PepsiCo? So I think the answer here actually makes a lot of sense, okay? And then we could use the WACC to estimate economic value added. If using the data that I gave for you in the case, you should have obtained these numbers, okay? The EVA for Coca-Cola in 2014 should have been 4.5 billion. And again, the numbers come out to be very similar to PepsiCo, okay? So Coca-Cola would have been 4.5 billion, PepsiCo would have been 4.6 billion, okay? This is what we did in module 4 in the lecture notes, okay? You can go back there to check, right? So WACC is very similar, EVA is very similar, right? What does that mean, okay? It simply means that these companies are very similar to each other, right? They are both profitable companies that are generating economic value added. They have the same cost of capital, right? So it's really very difficult to distinguish between Coca-Cola and PepsiCo just based on these numbers that we calculated. In this course, we learned a lot about how companies make financial and investment decisions. In this summary video, I want to go over the key concepts that we learned, really to emphasize what are the key ideas that you should take away from this course. What are the key concepts that you should not forget, okay? The first one is this notion of shareholder value, right? The idea that companies make decisions, financial and investment decisions, that maximize the stock price. And we talked a lot about the fact that maximizing the stock price is not a perfect objective, but it is better than many alternatives, in particular, maximizing current profits. Okay? And remember that maximizing a stock price might create conflicts between shareholder value and social welfare, okay? That companies may need to address in some way. Okay? So shareholder value is not a perfect objective, mostly because of that. Companies live in a society where they might have to balance shareholder value with concerns about stakeholders, concerns about the environment, and other important concerns. Then we talked about the language of corporate finance, okay? As we discussed in our course, accounting statements are like a book, right? But you have to learn how to read the language, how to read those words, okay? Accounting is the language of finance. So in our module 1, we learned how to use accounting statements to measure fundamental corporate finance concepts such as liquidity, leverage, profitability, and how to read a cash flow statement, okay? We learned this, and we also learned how to avoid the most common pitfalls, okay? Such as, you know, using book value of equity and other related issues. So remember that accounting is the language of finance, and now you should know how to read that. And we also learned how to write the book of corporate finance, right? Forecasting future financial statements is like writing our own book. Okay? We learned how to do some basic forecasting, and then we used our forecasts to project and manage a company's long-term and short-term liquidity needs. Okay? This is a very important job that the chief financial officers, that corporate treasurers, real-world managers have to deal with on a daily basis, and I believe that now you should know more about how companies make these financial planning decisions. Then we went to net present value, which is probably the most central concept in corporate finance, okay? net present value is a very important calculation that allows us to measure the contribution of a new project or a new acquisition to shareholder value, right? What this means is that as long as we can compute an NPV, right, then we have a number that allows us to make a decision about an investment, a decision about financing, or any other corporate decision. If a decision generates positive NPV, if NPV is positive, then it will increase shareholder wealth, which means that the company should go for it. Okay? We learn how to use this principle to discuss investment and acquisition decisions and to think about the pricing of M&A deals. On top of NPV, we talked about two additional tools that we use in investment analysis in corporate finance, which are the internal rate of return and real options. The IRR is the percentage rate of return of a project. Okay? So now you should know how to compute the IRR, and you should also know that we cannot compute the IRR in some cases. Okay? The cool thing about the IRR is that IRR and NPV should be equivalent in most cases. Okay? If the IRR is greater than the discount rate, then the NPV should be 0. So we can think in terms of positive NPV, but we can also think in terms of comparing the rate of return of a decision with the discount rate on that decision. Okay? In addition, we learned that many investment decisions such as research and development or weighting have to be evaluated using a real option framework. Okay? On top of computing NPV, we have to think about which options are associated with these projects. And we learned in our course, we learned how to use decision trees to compute the right NPV when investments come attached with real options. Okay? Finally, we learned how we measure risk using discount rates. Okay? And we learned how to use these discount rates to evaluate performance. Right? So we estimated discount rates for real-world companies using the weighted average cost of capital formula, and then we learned how to use the weighted average cost of capital to measure the performance either of the company as a whole or the performance of existing investments of the company. Okay? So now you should be able to think about how to introduce risk into investment analysis and how to use the weighted average cost of capital to measure performance. Okay? And remember that practice makes perfect, both with guitar playing and also with corporate finance, right? As we finish this course, you should keep applying the ideas that we learned in other business courses and also in real-world situations. The corporate finance principles that we learned should make you better able to understand how companies should make investment and financing decisions. Thank you for taking this course. I really appreciate it, okay? And I hope to see you in a future course.
At Geese College of Business, one of our strategic priorities is to democratize education. We do that by delivering our IMBA, IMSA, Executive Education, and Business Minor online. That is not business as usual, and it is certainly not the online education of old. We put our very best faculty in the online space. They actively engage with students from around the world, face-to-face in a digital classroom. Faculty and students collaborating together infuse these programs with the personal attention that enables students to reach their full potential.
The IMBA program through the Geese College of Business is so incredibly innovative. The ability and accessibility to reach a whole new audience of students and let them learn on their own time has been phenomenal. And being able to collaborate with people across the globe and to learn from top-notch professors has been completely revolutionary.
When you're interacting and teaching in a live session, you can kind of see the student's environment. And while I'm teaching here at night in Champaign, it's daytime wherever they are in the world, some of them. And so it sort of slaps you in the face immediately that there's a completely different perspective.
You might think, oh, it's more removed, it's more distant. But in fact, my experience in an online class has actually been surprisingly intimate and connected. In a classroom setting, you might have 50, 60 or more students in a room at one time, and so I'm scanning around looking at people. But in an online, I'm looking at one place and the student's looking right back at me. And that's surprisingly a direct experience.
I was shocked at how much it felt as good or better than when I was sitting in class in my undergraduate days. Everyone has their cameras on their computers. There's a chat feature, so you can also type in a question and the professor can answer your question that way.
I think the cool thing is that you can truly participate from wherever you are. These systems work on your desktop, on your cell phone.
We were traveling in the middle of nowhere back from Indiana, and on the Wi-Fi still on my iPad, I was able to connect through Zoom with classmates in Dubai and Tokyo and California all at the same time. Even being in a remote place, on the go, the accessibility and the exposure that I was able to get was phenomenal.
Getting my MBA makes me feel empowered because I don't need to stop being myself. I don't need to stop working. I don't need to stop being a mother. I don't need to stop having my life. And that is everything.
Our online programs are designed to be career-curated learning experiences. Our leading-edge course material is structured the way that professionals apply these concepts every day. Leadership, communication, and critical thinking skills are built into the core, empowering our students to put their purpose into practice at the highest level.
One of the most impactful things is just your ability to take the skills that we deliver and take them back to work on Monday. I've heard a couple of stories where students have talked about the skills that they were able to build over a couple of weeks, and then they were able to immediately bring that skill set back into their job and make an immediate impact.
I would recommend GEE's IMBA program for anyone. This is both if you're starting questioning your career, to if you're a professional and you want to hone your skill, this is it. This is the place to be.
At Geese College of Business, we are truly revolutionizing how online education is delivered. This isn't just a few PowerPoint slides and a reading assignment. Our faculty and students thrive in this one-of-a-kind global classroom. Relevant, timely discussions about current topics from around the world keep content fresh and exciting. The next generation of business leaders will come from all corners of the world, and now they converge here at Geese Business.